A very happy morning to everyone. I request, we are starting the meeting now. I request everyone to keep your phones on silent mode so that we have a good experience of the meeting. Happy morning to all participants and dignitaries. My name is CA Rahul R. Gandhi.
And I am CA Siddharth Jabri.
On behalf of National Financial Reporting Authority and
Karnataka State Chartered Accountant Association.
we welcome you all to
NFRA Audit Workshop, Essential Habits of Effective Auditors.
It's fantastic to see esteemed members of who have gathered here today. We are about to dive into a topic that's shaping the future of our profession, which is audit quality. Around the world, regulators and standard setters are raising the bar, and the big question is, how do we bring those best practices into the Indian audit environment? Today's discussion is about bridging that gap between the global standards and real-world execution. We will draw insights from international oversight bodies, look at enforcement trends, and most importantly, focus on practical steps you can take to strengthen the audit quality, stay ahead on regulator readiness, and protect public interests. So let's make this interactive and have actionable strategies that will make real difference. Let's get started. Now I request Shiv Prakash Viraktamat, President, KSCAA, to escort Shri Nitin Gupta, Chairperson, NFRA, and Shri P. Daniel, Full-Time Member, NFRA, onto the dais, please.
I request the dignitaries on the stage to start the workshop with the lighting of the lamp. For lighting of the lamp, I request CA Mohan Lavi sir, CA MP Vijay Kumar sir, and CA Shyam Madhyani sir to join the dignitaries on the dais. Thank you. Thank you for lighting the lamp, sir.
I now request CA Shiv Prakash Viraktamat, President KSCAA, to welcome Shri Nitin Gupta, Chairperson NFRA. Sir, I am honored to welcome Shri Nitin Gupta, having over 39 years of experience with Government of India, focusing on tax administration, compliance reforms, data analytics, and financial governance. He has led prominent roles as a chairperson of Central Board of Direct Taxes and Director General at Competition Commission of India, leading important regulatory reforms and enhancing governance. A round of applause, please.
Now it is my pleasure to introduce you to all Shri P. Daniel, full-time member of NFRA. Before that, I would request Vice President Sunil Bandari of KSCAA to present a bouquet to Shri Daniel. Shri P. Daniel, a 1989 batch officer of the Indian Defence Estate Services, has served the Government of India for more than 35 years with distinction. He assumed the role of full-time member at the NFRA on 23rd July 2025. As both a chartered accountant and a cost management accountant, Shri Daniel has held prominent leadership positions within the Central Vigilance Commission and Defence Estate Organizations. His extensive expertise encompasses vigilance, administration, financial management, estate management, municipal governance, and systemic anti-corruption reforms, both domestically and on international platforms. Welcome, sir.
Now, I request CA Shivprakash Viratmat, President KSCAA, to welcome the gathering. I am honored to welcome the current President of Karnataka State Chartered Accountants Association, a fellow member of Institute of Chartered Accountants. He brings rich experience in valuation, advisory, and corporate finance. He is also a partner at LKSS and Associates, advising businesses on strategic and financial matters. Sir, please.
Respected Chairperson of NFRA, Shri Nitin Gupta ji, respected full-time member of NFRA, Shri P. Daniel ji, senior officers from NFRA, esteemed speakers, senior chartered accountants, and dear professional colleagues. A very good morning to all of you. On behalf of the Karnataka State Chartered Accountants Association, it is my privilege to warmly welcome you to this NFRA audit workshop on essential habits of effective auditors. We are honored to host the leadership of NFRA here in Bengaluru today. KSCAA, established in 1957 with around 4,300 life members, is one of the oldest and most vibrant professional associations of chartered accountants in the country. Over the years, KSCAA has remained firmly committed to technical excellence, professional integrity, and constructive engagement with a wide spectrum of stakeholders, including the union government, the state government, and various statutory and regulatory authorities. Our engagement extends beyond representation to meaningful policy participation. In this context, KSCAA was invited by the Special Parliamentary Committee of the Lok Sabha on the new income tax bill to present its views and suggestions, an acknowledgement of the association's credibility and constructive role in national tax policy formulation. We are humbled to share that a significant majority of our recommendations were accepted by the committee. Through such dialogue, advocacy, and capacity building initiatives, KSCAA positions itself not merely as a representative body, but as a responsible and proactive stakeholder in strengthening the overall financial reporting ecosystem. Today's program is significant for all of us. The collaboration between NFRA and KSCAA reflects a shared belief that strong regulation and a strong profession are not opposing forces, but partners in building public trust. Audit quality cannot be achieved by standards alone. It is achieved when standards are internalized through professional habits, judgment, and ethical conviction. The theme chosen for today, essential habits of effective auditors, is therefore timely. Let me today begin by going back to the very basics of our profession, the common thread that binds us all. In modern economies, financial information is produced by one group and relied upon by many others, such as investors, regulators, employees, and lenders. On one side are management and directors who generate this information and do not always have sufficient incentive to present it fully, fairly, or without bias. On the other side are users of financial information who often do not have the wherewithal, time, or ability to privately appoint experts to independently verify what is presented to them. This creates a classic agency problem. The birth of a profession which can be trusted without being bothered by incentives, relations, etc. So the people who can be trusted are known as auditors. Trust, therefore, is the bedrock foundation of our profession. Audit exists because trust is required at a collective level, not at an individual level. Individual users rely on audited financial statements not because they personally assess an auditor's competence or intentions, but because the audit process itself is collectively recognized as a legitimate professional institution. In that sense, trust has been institutionalized, allowing many individuals to rely on information they have not personally verified. Trust is fundamentally a perception at the user level. It exists in the mind of the person relying on the information, and the expectations on auditors have expanded considerably. Therefore, audit quality today is not just about compliance with standards on auditing. It is about professional skepticism, robust audit documentation, risk-based thinking, sound judgment, and above all, the courage to do the right thing. These are defining the credibility of our profession to gain trust. NFRA's role in reinforcing these trusts through guidance, oversight, and engagement is crucial. Programs like today's workshop help bridge the gap between regulatory intent and practical execution, and they enable practitioners to align themselves with global best practices and evolving regulatory expectations. Highlight of today's program is the direct interaction opportunity with the chairperson and the full-time member of NFRA through the Q&A session. I would like to place on record our sincere gratitude to the chairperson NFRA, Shri Nitin Gupta ji, and the entire NFRA team, expert speakers, for their time, effort, and commitment to engaging with the profession. I would encourage all participants to make the most of this opportunity, ask practical questions, share ground realities, and engage in open and constructive dialogue. KSCAA assures NFRA our continued support in enhancing audit quality, building awareness among our members, and upholding the trust reposed in the chartered accountancy profession. We are also fortunate today to have with us partners and professionals from large audit firms, Big Four and SMP firms. We also have members present from across regions, different states and Mofussil areas of Karnataka. KSCAA firmly believes that the collective strength of our profession lies in knowledge sharing and collaboration. In this spirit, I would like to place an open invitation to large firms and Big Four firms to partner with KSCAA in conducting practical, hands-on workshops where proven audit practices, methodologies, and quality frameworks may be demonstrated and adopted by the wider fraternity. Such collaboration will not only help elevate audit quality across the profession, but also serve as a meaningful way of giving back by strengthening trust. This is also a moment of reflection and responsibility for fraternity as a whole. That time has truly come for all of us to pull up our socks, to continue update and hone our audit skills, strengthen documentation, adopt best practices, and place uncompromising focus on audit quality. As the Indian economy grows by leaps and bounds, from $4.18 trillion today, being the fourth largest in the world, to estimated around $30 trillion in 2047, when we will be the third largest economy, with GST collections at 11.4 lakh crore in 2021 to doubling in 2024-25 to 22 lakh crore. As capital markets deepen and public participation in financial assets expands, for example, the demat accounts were around 4 crore in 2020, which is 21 crore in 2025, which is estimated to be that 30% of the population will hold the demat accounts in 2035. Around 1 lakh demat accounts are being opened on a daily basis. The number of new IPOs which got listed in 2025, 100 main board IPOs, raising around 1.75 lakh crore. 2026, it is estimated around 200 main board IPOs with a fundraising range of around 2.5 lakh crore to 4 lakh crore. Increased regulatory scrutiny will be the norm rather than the exception. In this evolving landscape, the role of auditors becomes critically important, not merely as compliance professionals, but as custodians of corporate health and public trust, especially where large amounts of common public money are at stake. Now, if we accept global lens, then I believe we must also be willing to have global standard conversations, honest, structural, and forward-looking. Today, before I close my thoughts, I wish to raise 3 such issues as constructive inputs towards strengthening the trust in the audit ecosystem. First issue, auditor remuneration. Globally, regulators acknowledge a simple truth: quality has a cost. No jurisdiction prescribes audit fees, so is India. I firmly believe that the market is the greatest leveler. Over time, markets reward credibility and punish weak practices, whether of companies or auditors. However, to retain quality, retain best talents, the cost has to be reasonable, ensuring to weed out not serious practices, which is overall in the interest of the ecosystem. The second issue is audit concentration, not from the lens of firms, but from the lens of systemic resilience. Globally, regulators are increasingly concerned about excessive concentration because it creates, 1, reduced choice for audit committees, 2, fragility if capacity exits the system. This is about systemic risk to the market as a whole, not at an individual level. Third issue is opinion shopping. It is often discussed purely as an ethical failure, but global experience shows it is also a market design issue. An auditor, being part of the system, is structurally insecure and is more vulnerable to pressure, even if personally ethical. All the above cannot be answered at an individual level. We have to meet in occasions like this to collectively find answers by building frameworks that can restrain practices which can be collectively detrimental to the auditing ecosystem. As an analogy, if we all stand under the same umbrella of trust, every mistrust is a puncture to the shade we enjoy. And NFRA has equal responsibility in protecting the trust of the auditing profession. I am confident that today's deliberations will leave us with clear insights, renewed responsibility, and strengthened resolve to raise the bar of audit quality. I once again welcome you all. Have an enriching day of learning ahead. Thank you.
Thank you, President, for the wonderful welcome address. Now I invite Chief Guest, Shri Nitin Gupta ji, to deliver the inaugural address.
Good morning to you all. Mr. C.A. Shiv Prakash, President, Karnataka State Chartered Accountants Association. Mr. P. Daniel, full-time member at NFRA. Office bearers of KSCAA, dignitaries of the dais, ladies and gentlemen. At the outset, I would like to express my gratitude to the office bearers of the Karnataka State Chartered Accountants Association, who is hosting this conference along with us. I am thankful to the Chartered Accountants of the Karnataka State for making this event happening and probably successful at the end of the day, we can say. First of all, disclaimer of a regulator that whatever is being said by me here is not the view of the NFRA or its EB, and it is the personal view. So in the present day of aspirational India, which is reaching new milestones, as Mr. Shiv Prakash was also referring to, and what we are looking at Viksit Bharat in 2047, accountancy profession has a meaningful role to play, and it is the profession which is going to take us forward in the times to come. Therefore, I will bring to your attention some of the developments in the independent regulatory framework of accounting profession. At that stage, I would like to acknowledge the role of the chartered accountants in our nation's growth and development during last 7 decades or so. I may take you to the memory lane. A century ago, in 1925, a parliamentary committee, External Capital Committee, recognized the chartered accountant profession as one of the 2 professionals which are needed for India's industrial and economic growth. So chartered accountants are a very, very important component for the India's growth, and in that, if we look at different areas like taxation, which is called the blood supply for any economic development of a country, the finances which are raised through direct taxes and indirect of larger public good. The second area where you do come up is the statutory order of companies, banks, insurance, and cooperative societies, etc., which is a public interest duty, a public profession. We did a quick check on the significance of audit of large PSUs in India. Out of the top 250 listed entities by market cap, around 40 large entities are audited by Indian firms. Some of them may be attending this workshop. The third significant component is that India is now slowly developing itself into a skill capital of the world in financial reporting services. IT services had been the major force in the late 90s and early this part of this century, and now we are having a new phenomena which is global capability centers, GCCs. Many of them may be functioning at Bangalore. So with this, we can understand the role which you chartered accountants play in the development of our country, in the economic development of our nation. So far as KSCAA is concerned, as I was told, it is established 6 decades ago, and now it's a formidable force with over 4,500 members. Now, Shiv Prakash was referring to the, is it on? Okay, it's not coming here. So, he was referring to the India's story in the new millennium and the growth of the capital markets, which has taken place in the recent past with the number of demat accounts which have risen to the IPOs, main board IPOs, which have come up more than 100 and so. All this is intertwined with what our GDP growth rate has been, and which is 8.2% now, and what it has been in the past few years. S&P had averaged our growth rate at 8.8% during fiscal 2022 to 2024. So this vibrancy in our capital market and growth of capitalization, market capitalization in last 5 years, doubling the market capitalization to around 45 lakh crores in 2025 is a real indicator of what way we are growing and what way we are progressing. Let us understand that the capital market is the heart of modern, transparent, and vibrant economy, and we have to grow on that path and that path is going to give us a lot of challenges and will require a better corporate governance and also high quality financial reporting. Mr. Shiv Prakash has very beautifully summed up and made my task easier that the two ends, one is the accounts preparer and the user of the accounts, they have a very important role to play. And when user is looking at the thing, in what way he is able to feel confident, in what way he is feeling, yes, that is, the accounts are true and fair, and in what way they contain disclosures which are relevant for the purposes of the user, be it the lender, be it the shareholder, be it the investor, or the even a partner in the value chain. So that sort of development of that trust is most important. And if we want to build the culture of equity in India, probably work which shall be globally comparable, high quality financial reporting framework. Both are very, very significant, both are very, very important, and we have to see to it that we progress effectively in these areas. And in this perspective, chartered accountants who are engaged in audit practice are the guardians of public interest and therefore assume the sheet anchor's role in that critical component of enhancing trust and ensuring integrity of the financial reporting framework. I'm not going to the 5 lines of defense, but external auditors are those who generate that trust and enable and maintain the high quality financial reporting. Like audit quality is therefore very important, and we have to maintain that audit quality, improve the audit quality so that we are able to generate that trust which is very much needed. Now, how do you measure the quality of audit and interpret it? What are the tools for doing this? The common tools are firm-wide recurring inspections and evaluating findings therein by grading the inspection findings. I think inspection will be covered by my colleague Mr. Daniel in the later part of the discussions. Computing deficiency rates, etc. Some other tools can be audit quality maturity models, firm and engagement matrices, and so on. But at the regulator level, we think that to understand the corporate governance and audit quality, we can rely upon the rear view mirror test, determining as to how many corporate and audit failures have taken place, what has been the restatement of the financial statements and the enforcement cases in the recent past. Just to bring home, I'm sharing a slide on the screen which gives some high-profile corporate audit failures in the USA, because what we are today is what USA had been in the beginning of 19th century. Earlier, 1920 and 1940, Krieger and Toll and Mackison and Robbins were two very famous cases which were instrumental in creating new ecosystem. And then at the dawn of the new millennium, what we saw was Enron, Arthur Andersen, WorldCom, scam, and that failure led to huge economic losses of the tune of $8 trillion US, and that led to the reform in the form of Sarbanes-Oxley Act of 2002. Now, this slide gives it's not the case that these scams or failures are not taking place. These are taking place consistently. And as I told you, one is this scams, the other is the restatement of the financial statements. Then if we look at the position in the USA, the number of restatements which have increased from 92 in 1997 to 225 in 2001, just before the Enron crisis happened. And then the number of restatements started reducing, and during the last 3 years, these are comparatively more. We just can take a clue out of it. So far as India is concerned, the data is not available. So I cannot say about the India side of it, but this is the way things are there. If we come to the Indian experience in last 25 years, Indian economy and investors also witnessed certain scams and audit failures in the last 25 years, and we suffered enormous wealth destruction in the first 2 decades of this century. Some of them were gigantic. This slide captures the scams from 1955 of Haridas Mundra, which you might be aware of, and then we go back, we come forward, and then comes the 2007-8 when Satyam Computers scam broke out. And then while we were gradually improving and tried to face that problem of twin balance sheet, then in 2018 there was a scam at PNB of 14,000 crores. Then there were series of such failures which we could witness. 2018 Island FS 91,000 crore, DHFL 34,000 crore, CCD 3,500 crore, and then Yes Bank. All these were a thing which speaks about the corporate governance failure as well as the audit quality which we could see. Now all this 2018 things, India responded very sharply, and we could implement a robust independent regulator, a provision similar to PCAOB under Sarbanes-Oxley Act was already there in the Companies Act to establish an independent regulatory authority called NFRA, and it was therefore constituted in 2018 in the aftermath of this PNB scam. Now how NFRA is doing is the young regulator, but just let me give you some background facts and figures. Indian audit market has huge companies, around 18.5 lakh companies incorporated under the Companies Act. Listed companies, around 5,000 to 6,000 active listed companies, but 80% of the market cap is in around 250 companies in large and mid cap category. Out of these, NFRA domain companies are around 7,000, mainly the listed companies, and the balance are unlisted one, but because of the Rule 3, they are in our domain. As far as the auditors are concerned, as per ICAI data, there are around 90,000 audit firms who are eligible to undertake the audit of companies, whether PIEs or otherwise. Audit is mandatory for all companies in India. NFRA domain companies, as the data we have, around 2,600 audit firms are auditing these 6,000 companies or so. Just a high-level data of NFRA 2 filings for 24-25. As the auditor companies within NFRA domain are required to file an annual return by 30th of November. Around 1,100 firms have filed NFRA 2 and 225 audit firms have issued around 580 modified audit reports, maybe qualified or adverse, etc. Now, as we are talking of the regulator, I'm talking about the regulatory approach as well, and globally, the regulators are known to follow 3 approaches. First is the enforcement approach, where disciplinary actions are undertaken and that they take precedence. The second one is the supervisory approach, where inspections are intended as a preventive measure. And the third one being the mix of these two. Use of these tools and weightage to these depends upon the prevailing audit quality, the corporate governance, number and magnitude of such scams which we are talking about, and audit failures. One cannot say what approach one has to follow because these have to depend upon the things which are prevailing at that time. These are dynamic. As our nation witnessed gigantic corporate scams, as you can yourself see, which shook the public confidence and trust in the financial statements, and the audit profession itself was at the being questioned. NFRA had to focus on regulatory tools to fix the accountability of auditors guilty of professional misconduct, so that the confidence and trust is restored amongst the stakeholders in the financial reporting framework. The other tool, which is inspection, is being followed. We are in the third cycle now, since 2022 being the first year when we started the audit firm-wide quality inspection as a regulatory tool, and it is being ongoing for the current year, current financial year, I would say. Standards and codes are comprehensive set of globally comparable standards and codes are very relevant for the objective of transparency and building trust and bring India at the competitive edge in the world. So, some critical aspects just I would like to draw your attention to. You might be aware of these cases which are appearing, but just to give a flavor to you that how these can be seen. First is the DHFL case, and this is a slide where there was 11,000 crore was siphoned off by the promoters through fictitious branch and fictitious loans. These were not existent branch and the money was siphoned off. The disciplinary orders do indicate that there was a complete disconnect between the principal auditor and the branch auditor. The similar modus operandi of fraud which was noticed in the 2008 Satyam computer scam and perhaps copied from 1930s Mackison and Robbins fraud in the USA. Another case is of Coffee Cafe Day, where the promoters used an accounting jugglery of issuing bank checks without having adequate funds in the group entities just before the year end to hide the true nature of the transactions with the related parties and especially loans and borrowings. It was a repetition of a famous case of 1968, ICAI versus PK Mukherjee, where the auditor failed to report similar accounting jugglery to misrepresent the loans taken by Anand Bajar Patrika from the Employees Provident Fund Trust. We need group audit, global standards on group audit and joint audits, and we normally have been following the international standards to be implemented in India to make our companies competitive and get better recognition in the world market. Now it is time to remember what the respected ICAI President CA A.H. Dalal had said in 1989-90, and I am just quoting, quote, "The society has given a distinctive professional standard to the chartered accountants who, as auditors, examine and report on economic information relating to organizations in which millions of people have a stake. It is therefore our constant endeavor that our members maintain high standards in auditing." See the vision which Mr. Dalal had in 89-90, when India has not opened up its economy. It happened in 92. So that vision, what he said, is still having relevance today, equal relevance for all of us to follow. Failure to identify risks in related parties and applying professional skepticism to evaluate business rationale or purpose of those transactions was evident there, and now it's also evident. Coming to another case, probably, let me see. This is the Reliance Home Finance Limited, another web of companies which have been used to siphon off the funds and we have already taken actions. Around 34,000 crore was involved in this scam. So what is important as a regulator for us is that we develop and keep on promoting awareness about the contemporary risk-based audit approach, and we have been complying with the said objective by different initiatives. First is the audit workshop, which is today's outreach event, being the third in this series in the current financial year, to upskill the Indian audit professionals, particularly the small and medium practitioners. Many of such audit firms are engaged in the audit of the largest companies in India. This, we believe, our audit workshop will not only usher in a paradigm shift in the audit quality of PIEs in India, but has potential to enable the global opportunities for our audit firms. The second, which we are taking through, is the audit practice toolkits. So far, we have issued 2 audit practice toolkits on a sample basis, and I think there is some discussion on those in today's session as well. Webinars have been another medium and we recently had one webinar. Video recording of the same is available on our website for those who could not attend that webinar previously. We intend to do more webinars for the benefit of our audit fraternity in the next 2 months or so. And the last but not the least are the circulars, which we are regularly issuing. In the last 1 month, we have issued 2 circulars, the latest being, I think, two or 3 days back on the communication, effective communication. So that's where we are. I'd like to comment upon the observations made by Mr. Shiv Prakash, and he was referring to 2 or 3 things about audit remuneration, which probably as a regulator, as of now, in the given legal framework, nothing can be done at our land. But let us, you may keep on bringing that thing to the notice of the Ministry of Corporate Affairs, because that is the right forum. Audit concentration, like so far as the regulator, as a regulator, we are, as I have given you an account of what we are doing, you can see that yes, for the small and medium practitioners, we are trying to impart as much as possible the elaboration on the AS and SAs and what should be done that is beneficial to all. As far as the government is concerned, there is a lot of talk going on MDP, and a lot of discussion is underway. So let us see in what way it turns out. So these are the 2 things which I would like to comment. But before I conclude, let us remind ourselves about the words of wisdom from our Honorable Prime Minister. In July 27, he said, "Follow the path of integrity in discharging critical societal role of audit of financial statements," unquote. So what Honorable PM has said is again very vibrant and relevant today. With these words, I wish to thank you all who have gathered here to make the NFRA's initiative successful, and special thanks to KSCAA for hosting Auditor Capacity Building Initiative. We at NFRA look forward to active collaboration with the most critical line of defense in protecting the interests of investors, public, and capital market in general. Together, we can rejuvenate the epithet partners in nation building conferred upon the esteemed chartered accountants by our illustrious President, Dr. Abdul Kalam. Thank you. Jai Hind. Thank you.
An insightful address. Now, I request CA Sunil Bandari, Vice President, KSCAA, to give a vote of thanks.
Good morning all. On behalf of KSCAA, it's my privilege to thank Sri Nitin Gupta, Chairman NFRA, for graciously delivering the inaugural session. We are truly honored by your presence and insightful guidance. Thank you, sir. I also extend my sincere thanks to Sri P. Daniel, full-time member NFRA, for being with us today and supporting this important event. Thank you, sir. My heartfelt thanks to CA Shiv Prakash Virakmat, President KSCA, for sharing his valuable address. I also like to thank all the participants, speakers, NFRA members, senior fellow professionals, past presidents of KSCAA, and members of Executive Committee of KSCA. Thank you all. And
Thank you, sir. Without much Without much ado, we move to first technical session of today's, which is audit strategy documentation. What does it mean in real life? I now invite CA Vidyadhar Kulkarni, a chartered accountant with 35 years of experience in financial reporting, consulting, and banking, both in India and overseas. He serves as principal consultant at NFRA and has contributed to regulatory reforms, global best practices, and professional knowledge sharing. His career includes leadership and advisory roles at ICAI, RBI, Indian Banks Association, and major institutions like UBS, Standard Chartered, Emirates, NBD, EY, and Deloitte. Sir, I request you onto the dais, please. A round of applause, guys.
Good morning, everybody. I would like to acknowledge the presence of eminent professionals and Chairperson NFRA Nitin Gupta ji and Sri P. Daniel sir for full-time member. In this session, I'll be very quickly 5 minutes. I'll introduce this theme for this workshop. Then I'll hand over the floor to Amitesh Datta to take over the important topic. See, one of the things which most important to address is like what is this reasonable assurance? We all keep talking about audit means reasonable assurance, reasonable assurance. Like for example, an article clerk comes and say, for example, the article assistant comes and asks us, sir, the auditing standard says reasonable assurance, acceptably low level. How to do it? Hang modudidana. In Kannada, if you ask me, people know, some of students will say, hang modudidi standard is saying to reasonable assurance. How to do it? Unfortunately, we in India, we have this principle-based standards, so which does not give much prescription. But on the contrary, if you look at it, there is guidance available in the US. AICPA, long back in 1970s, when they issued their standard, SAS 39 it was called, now it is the PCOB standard called AS 2315, which talk about the audit sampling. In there, they said that yes, reasonable assurances we can keep talking about and keep justifying it in a philosophical way. But if somebody has to put it down on practical, what is the way? They actually said it's actually when you want to think in terms of a quantitative terms and apply in your audit practice, it is actually when they said that in case of a substantive test, if you are going, they talked about, you can say that 5% risk of incorrect acceptance. Means auditor can accept up to 5%. On the other way, what it means, many of us we have studied the statistics, 95% confidence level, right? It's okay. So 95% confidence level, right? That is the outer level you need to keep it. But of course, as you all know, we do different kind of a tests. We do substantive test, we do analytical procedures, we do test of controls. Yeah, in respect to those areas, you can bring down that. So that's why you can sometimes bring it down to a 10% incorrect of acceptance, or 90, that means 90% confidence level. So some of these things actually, when we come to the sessions of ROMM sampling, etc., you will be able to see those. So these are the things actually in India, which in our practice actually that the guidance is lacking, and that is why its practical implementation actually is weak in our case. But at the same time, when this guidance is available globally, we should take that guidance. So that is the objective of this brief 5 minutes introduction I wanted to do before we actually start talking about the other topics of audit strategy document and ROM, etc. So with this, just I'll stop here. Now I'll hand over the floor to Amitesh Datta.
It is my pleasure to introduce you the first speaker, Mr. CA Amitesh Datta, audit professional from Pricewaterhouse. CA Amitesh Datta, a partner of PricewaterhouseCoopers and affiliate firms in India with 29 years of experience. He is responsible for boosting the quality of productivity and efficiency in audit practice of the firm and believes in embedding trust, transparency, and technology as a way forward. Over to you, sir. A round of applause, please.
Thank you NFRA and KSCAA for hosting this workshop. In the interest of it being a workshop and in the spirit of it being a workshop, I would request that it be a little interactive because what I would do is I'll try and provoke some questions from the participants and hopefully we'll make it more a two-way street rather than me just talking out here and try and make it a little more interesting. Okay, so while the presentation is coming up, just a show of hands, how many have read this sample audit strategy memorandum document that has been published by the NFRA back in November? And it was also, I think, circulated as a pre-read, right? Some more hands? I can see a few here. Okay, there's some at the back. Great. Great. All right. So let's get into it. So what we'll do is that document which was there, which is meant to be a memo, it's actually meant to be an audit working paper, and it's a sample document. What we'll do is in the next about 40 to 45 minutes, we'll go through that document and I'll try and lay emphasis on few of the areas where I think we should think about a little bit more on how we actually bring that into when we do the audits of companies. Let me start by asking, there were some hands which said they've read the document. What's the difference? Because the auditing standard makes a big difference between audit strategy and audit plan. Would somebody like to volunteer what's the difference between an audit strategy and an audit plan? Okay, there's a word. Is there a mic? Otherwise it won't work. Maybe if you can keep a few mics around because I'll keep doing this in a bit.
Hi, sir. Good morning. This is Shravan. I'm a partner with CNK. So I tell in my office, whenever a client asks us to do the audit ASAP, as soon as possible, I also tell my staff, let's do it ASAP. That's audit strategy and audit plan. I mean, in that chronology, right? So audit strategy is all about the strategy planning, scope, timing, etc. Put it simple. Audit plan is all about the nature, timing, and extent, how it is going to be executed. I mean, both these are very dynamic processes, dynamic documents, not just at the beginning of the audit, but you'll have to continue monitoring it, continue making necessary changes, and both go hand in hand. I mean, in the same order. First is strategy and then the plan. Yeah.
Absolutely, spot on. Thank you so much. Thank you. Yeah, as you said, there is a distinction that the auditing standards also make, and absolutely like you said, audit strategy is really provides the scope, direction, and it's almost like a preliminary risk assessment, right? It's like an overall understanding of the company that you gain and you do a preliminary risk assessment, and then you get into an audit plan, which is far more detailed. It then talks about what control testing you will need to do, what substantive testing you will need to do. So it's the audit plan, if you can think of it, it's actually the execution of the audit strategy and a more detailed and more fine-tuned risk assessment. So just remember that because the standards actually require both, and you will need to have both. What we're talking today is audit strategy, which is really the directional, the high level, the preliminary risk assessment that we're going to talk about today. So this is an example, it's there in that memorandum as well. What it demonstrates, if you look at the strategy side, it's really just it gives an overall and a holistic view. It says that you need to get an understanding of the industry, the control environment, the competition that your particular client works in. And then, if you see that second para, it makes a very preliminary risk assessment to say that you need to focus on revenue. Again, these are all examples, so don't take this as gospel truth, and this is not something that will be there everywhere. It's just examples and it's just samples, so just for illustration purposes. Whereas if you see audit plan, it's actually a step-by-step procedures, the audit procedures that we perform for a day-to-day audit, which is really the execution of the strategy and to mitigate the risk that we see in the audit and to bring it to a acceptably low level. Now, this is very important. The reason why I spent a little bit of time is because what we're going to talk now is audit strategy. So it's really that directional, high-level, preliminary risk identification kind of expectation that we will have, and that's what we're going to talk about right now. Okay, in terms of scope of the engagement, again, this is very basic, so I won't spend too much time on this. I'd like to make 2 points here. In the scope of the engagement, you need to make sure that you capture what is the financial reporting framework. Very often we take that for granted. And as you know, even with the NFRA entities, we actually have 2 frameworks that are possible. Most of it will probably be in Indian, but it is also possible it will be the old Indian GAAP. So please make sure that when you prepare your strategy document and you prepare the scope of the engagement, you definitely capture what is the financial reporting framework, because that will be the starting point of how you're going to do the audit. Is it Indian or is it the old Indian GAAP? The second piece which is there is that not all companies that we audit have a consolidated financial statements. Some of them we would do just the standalone financial statements audit. There again, please capture that to say that the scope is either just standalone financial statements or it is standalone plus consolidation. That capturing of scope is very important because upfront you're actually saying what are the boundaries and what is the framework. The auditing standards obviously are going to be the SAs, the standards on auditing that we have in India. So again, this is just a sample work paper which is there. I won't spend too much time on it. This is a basic one. As we go on, I'll spend a little bit of time on the other topics. But it essentially, lists down, it's just a sample work paper. It could be different, it could look different. You could write it differently, you could use different English. But essentially it should capture, as I said, those 2 critical pieces in the scope of the engagement. Please stop me if you've got any questions anywhere, right? Because I've got 45 minutes, so I'm on the clock. So I'll keep going. And please stop me if you have any questions. All right. The next part, and this is, it's actually a logical sequence. If you think about it, once you've captured the scope, once you've understood what the scope of the engagement is, the audit engagement, you then will move on to having planning meetings. And typically planning meetings will be 2 types of planning meetings. The first planning meeting that you will have is within the audit engagement team. And typically there, what definitely one should encourage is, as professionals, is the entire audit team actually attends those planning meetings. Definitely the senior people, the engagement leader, the engagement quality review partner, the engagement manager, and if possible, all the team members. Sometimes I know it's not possible if you've got large teams, but if possible. The idea of those meetings that you have, the team meetings that you have, typically is actually for the more experienced individuals, the more experienced auditors, to share the knowledge with the less experienced auditors within the team. Because that's very important. Unless you pass on that knowledge, unless you do that coaching to the juniors that are there in the team, the audit team is not going to work as a cohesive force and as a teamwork, as a collaborative force. And that's very important, and essentially there you talk about the importance of professional skepticism, independence, materiality, what are the responsibilities, and as well as the timeline for the audit in terms of the interim and the year end. The next logical one, of course, is the meeting with the client. And here again, in the meeting with the client, typically what you would like to achieve is if you're doing a continuing audit, not the first year audit, you would like to typically take updates for the year. And what does that mean? Typically that updates could be updates on operations. Have they established new subsidiaries? Have they established new lines of business? How is the company doing vis-a-vis budget versus actual? What's the performance of the company, right? And again, more importantly, and as the gentleman rightly said, it's not an ASAP audit. What are the timelines? How much time do I have to complete the audit, right? Set that up front, set the expectations up front, document it. Typically, I would suggest, again, this is not something that the auditing standards say, but you should ideally have a practice of minuting that, put those minutes into your own working papers, as well as probably share it with the client. So at least you know that there is an understanding between both parties as to how that audit is going to be conducted, what are the timelines, and then what is it that you're going to do in terms of communication with management on the one side, and separately communication with those charged with governance. And there is a new circular that has come out, so obviously there is a lot of food for thought there on how we are going to enhance those charged with governance communications that we have.
Planning meetings which you were talking about, the sequence A and B, internal and external. The external should come first and then the internal.
That's okay. Yes. You could do it either way.
But doesn't it make more sense for us to...
Absolutely. I don't think there is any hard and fast rule. You could do it either ways. I see your point. Yes, obviously, if you are expecting a lot of updates in that year, things have changed at the client, it's not a first year audit, you would want to get that update and then come back and talk within the team. Absolutely, makes sense. I mean, A and B is just illustrative. That's okay. Again, this is more like, it's just a template, and this template typically is what you can use to prepare the minutes of the meeting. Both the meeting which is internal, and as well as a similar template which you can use for the external client meeting as well. Okay, one more question. This says overview and business and industry environment, including laws and regulations. We are auditors, right? Why do we need to understand the business of the company? Why do we need to understand the industry dynamics of the company? Why? You can scream that out because that's all that we do. Yeah, somebody said ROMM. I'm assuming everybody knows what that is, and there is a session later as well, risk of material misstatement. Anything else? Why do we need to understand the business? What purpose will it serve? Why am I going to waste my time understanding business of the company? I'll look at auditing standards, accounting standards, go and perform my audit procedures, I'm done, right? Anybody?
Maybe a cyclical business.
Okay. To understand if it's a cyclical business, so you will then tailor your procedures accordingly. Yeah, that could be one of the reasons. Yeah.
The company has performed as compared to the industry, then there is something alarming. So just to get the feel of it.
So if you're saying, if you look at the peer comparisons, the competitive company comparisons, if it's completely outside, out of whack, completely as how your audit client has performed, then obviously it's a red flag. Yes. But there's one important piece. It goes back to that first ROMM that was said.
Understanding the business helps us in identifying the risk where we need to focus on. Because if you're not familiar, you just entered this hotel, and if you do not know where you have to go, because we have to come to the first floor to attend this training. If you're not familiar with the business, what is the approach you are going to plan to identify the risk and mitigate those?
Absolutely, absolutely. So think about it this way. We all know, we all talk about audit risk, right? But there is another dimension, business risk, operational risk, compliance risk, regulatory risk. That's what our clients actually manage. Business risk, operational risk, compliance risk, regulatory risk, you name it, there could be many more. And more often than not, once we get an understanding of those risks, there will be a direct connection to identifying audit risks. Sometimes maybe indirect, but more often than not, when it's regulatory, laws and regulations, compliance, more often than not, it will be direct. Sometimes business risks, operational, may be indirect, but you will always find a connection. And that's the reason why it is very important to understand the business of the company, the industry in which it operates, the competitive landscape, the peer comparison, right? As ma'am there said, if my client is showing me numbers which doesn't make sense when I look at the peer comparison, obviously it's a red flag. And that will actually build into that, that entire process of identifying where are the risks of material misstatement, which is ultimately the audit risk for which I will perform the audit procedures.
A question here. Now, from the auditor's perspective, because ultimately we are not concerned with business risk, etc.
Right.
From the auditor's perspective, what should he worry about? Should he worry about whether the company has put its registered office name properly in the balance sheet? Because I find that you can say that accounts, you can give an adverse opinion, it doesn't get picked up by the regulators. It's only when you say that the company doesn't have using an accounting package which is having that audit trail, they file 3 lakhs. Or if he has not put a DIN number, he is saying. So from an auditor's perspective, because ultimately auditor doesn't want to get caught by this thing, is it sufficient if he just sees these 3, 4 things and forget about all these things? Nothing happens over here because ultimately, it's what should I say? So ultimately, whether the client is able to manage all the business risks, that is more important than how it that is the reality of the situation today.
Absolutely, I agree with you. We are not concerned with business risks. We don't need to, in our audits, we don't need to address business risks. There's absolutely no need. However, when you understand the business risk, and if that starts a thought process, it's all about thought process, right? It's all about professional judgment, ultimately professional judgment and skepticism. If that thought process of understanding a business risk starts a thought process to say, oh, is there an audit risk that I need to address? That's the connection that I was trying to make. I agree with you. I mean, registered office is not there. Yeah, it's a non-compliance under the Companies Act. Registered office nameplate is not there. No, but what financial statement impact it has is a question mark, right? But I agree. Not all business risks are our problem, but when you can or you should make a connection, let me put it that way, those are important to understand.
Another way to maybe look at it, somebody like based on the industry environment and these factors, you can actually try to, when you do your analytical review of financial performance, etc., you can actually look at it. The industry is showing negative growth and all that, but the financial revenue numbers have increased in a big way, or the other way it may have happened, something like that also very useful when you are actually doing that. That what is, some people say actually, the auditor, you are just auditing the numbers which the company has given. You have not actually set your expectations. That what could have been this kind of a number, should it have been, last year it was so much, because of industry, like that. So that's also one way of looking at it.
Yeah. Thank you. We'll come to that topic as well.
Amitesh, if I can just very quickly come in there. So in terms of why understanding business is important, right? There's another easy take on it, which I know we keep talking to our teams. Knowing the business is what leads you to know, okay, what the operations are, and then operations will lead to transactions, transaction lead to accounting then leads to auditing, right? So in this whole cycle of, or the objective of risk of material misstatement, right? What could go wrong? To know what could go wrong, that's a chain that you need to follow.
Absolutely.
Otherwise, we perhaps will not be in a situation to really do what we're expected to do.
Yep. Thank you. Thank you.
And also about the going concern, we need to know the business risks to actually report the going concern.
Sure. Yep. Okay, again, just a sample document. I mean, just to illustrate the point, I mean, you'll have industry factors, regulatory factors, competitive landscape, if there is a change in accounting policy, you document your understanding. Typically, you would get this understanding from external sources as well, not only just management or not only just your own audit files. If there are external sources that you're using, please put that into the file as well, because obviously you've picked it up from that external source. And then the last column that you see is really a very high level. What could be the impact on the audit? Again, because you're still at the strategy level, you're not going at a granular level and saying what is really the risk or material misstatement here. That comes a little later in the audit plan, but here this is a very high level analysis. Okay, something that Kulkarniji was just mentioning again, very critical overall analysis of financial performance. Some people call it risk assessment analytics. Some people call it preliminary analytics. Typically, the objective of this, when you do it at the start of an audit, typically the objective is that to identify unusual trends, to identify abnormal variations. Because more often than not, what we've seen is where there are unusual trends or abnormal variations, typically those could be high-risk areas and those could be also susceptible to a misstatement. May not be material, materiality comes later, but could be susceptible to a misstatement. And therefore, you need to be able to pay more attention if there are any of these unusual trends. And how would you pick them up? When you're doing it at this stage, you would typically take the numbers, maybe it's 9 months numbers, 10 months numbers, listed company. They've got 9 months numbers which have been published, even though on limited review, but they are published numbers. You could look at a profit and loss trend. You could look at net profit ratios. You could look at gross profit ratios. You could do all sorts of reasonableness tests. You could do balance sheet movements, what we call typically as analytical variations. Those will actually show if there are any unusual trends. Now, also remember one thing, that when you're doing this analysis, as Kulkarniji was saying, that what is very important also is that once you've understood the business, once you understood what is going on during that year, you also set up your own expectation. What am I expecting to see? So for example, if I know that the company hasn't done well, revenue has shrunk, I'm expecting to see a deterioration in revenue, right? There may be a corollary to that, not always there, but there may be inventory may be down, receivables may be down. So that's what I'm expecting. Again, if that does not happen, if it goes the opposite direction, maybe it is a red flag. And then we need to think about it. Do I need to look at that a little further? Do I need to get more information on it? We don't jump to a conclusion saying, oh, maybe there's a material misstatement somewhere, because these are just preliminary analytics that you're doing. But at least it's highlighted. It's highlighted, needs to be discussed within the audit team. That's where the professional skepticism comes in to say, okay, what more do I need to understand this trend, to understand this variability? And that's the real objective of doing this analysis at this point in time. Typically, it should be done at a standalone financial statements level. If you're doing a consolidated financial statements audit, you should also do it at that level to get an understanding at the consolidation level as well. Again, just a sample template which one could use, as I was saying. You set up an expectation of what you've heard from the company, whatever research you've done. I mean, these days, you've got AI, Gen AI, ChatGPT. You just go type in, you ask for industry trends, you ask for comparative comparisons, it'll give it to you at the click of a button. And you could actually use that, but be careful, of course, there could be hallucinations, but you could actually use that to set up some sort of expectations. You could bounce that off with the company, with the client, to say, this is what I'm seeing, this is what I'm hearing, but you are telling me something different. So how do I then marry both, and how do I see, how do I need to then read it? Okay, now another important area, and of course, as you all know, there is an opinion, there's an audit opinion, a separate audit opinion on internal controls over financial reporting, which we all issue. Therefore, it becomes very, very important to get a very good understanding of the company's internal control systems. Now, when we talk about internal control systems, more often than not, there are going to be sophisticated information systems, IT platforms that are inbuilt into that, right? That's what we typically see nowadays. When we look at that, you start with saying, okay, let me try and understand it at a higher level, which is really the IT general controls level. Then you drill down into understanding the application controls or the business processes. And within the business processes, you could typically have automated controls if the company is using sophisticated ERPs. You could have manual controls, or you could also have something what is called as IT-dependent controls. So one will need to get a good understanding of the entire internal control framework that the company is running. And that starts with actually understanding the control environment. If you read the guidance note on the internal control over financial reporting audit, typically what it says is that if a company does not have a control environment, a robust control environment, which we test and we are happy, the rest of the control activities don't matter actually. Because that's the foundation, that's the bedrock. And therefore that control environment that you see on the slides, what policies, procedures do they have? What SOPs do the company have? What is the risk assessment framework? Do they have internal audit? Do they have any form of risk management divisions? Right? All of that comes together to build a very robust control environment. And that's really the bedrock and the foundation for building the entire internal control framework. Now, what is also important out here is, as I said, the IT applications. Now, it's pretty widespread, right? I mean, I think all NFRA companies that we would audit typically would have some sort of IT applications for their accounting softwares, right? Either it would be very sophisticated or it could be less sophisticated, but there will be some sort of software accounting application that they will use for the financial reporting, for the general ledgers. There could be other modules. You could have separate modules for sales. You could have separate modules if it's a manufacturing company for production, for inventory. So all of that, if they are financially significant, and if they ultimately end up emanating financial transactions and then ultimately end up into a transaction in the general ledger, one will need to understand what those IT applications are. One will need to understand how complicated they are, and do we need information system experts or specialists, whichever way you want to view it, depending on how you take it, external or you have it within your firm. Do you need those experts with you as part of your audit team? Because some of these sophisticated ERPs, let me tell you, I think unless we ourselves as auditors are experts in those information systems, it's probably very difficult to understand. And then now it's getting even more complicated because some of our clients have started using AI for transactions. So it gets that much more difficult to be able to audit it in a very robust manner. So now, therefore this understanding is very important. This understanding will actually help you with the internal controls opinion as well as with the financial statement opinion, because obviously the financial statement numbers will come out from this IT platform. Any questions here? Because this is actually a critical part, and as we move forward, these are the areas that are going to become more and more sophisticated, and these are the ones where there will be cutting edge technology that is going to be used. And we will have to then train ourselves to be able to understand how some of these transactions happen and how some of the processing happens. Any questions around this?
So basically, you had mentioned about the internal controls, what we have to verify in the IT controls. So when it comes to this area, my fundamental question is that how are we going to ensure that your data is not tampered? So my insisting point is more on the audit trail, because how we as professionals will be knowing that whether something is hampered or not, because our clients will be downloading the report and giving it to us, and most of the clients are saying that, so we need at least more than a month time period to download all these reports, or maybe we need to talk to our IT team and get back to us. So if the client themselves, who are interacting on a daily basis with their IT teams, are not able to give the data, how we as auditors going to be auditing the audit trail in a short span is my question, sir.
It will be a scope limitation. Simple.
Got it.
Simple. If you are saying that
Yeah.
your client is not able to extract that data for themselves.
Okay, sir.
That's what you're saying, right?
Yeah, because the data is very voluminous.
I
sir.
know, I
Yeah.
understand. So let me take an example without taking any names of clients. Some of the largest companies, right, where it will be like millions and millions of transactions, they are able to generate that data, they are able to produce that data, they are able to show whether they have an audit trail or not. That's a new phenomenon that has come in, right? That will evolve over a period of time. But ultimately, they are able to generate that data for our testing purposes, for their own purposes. So if a client is telling you that because I have voluminous data, I cannot generate it, I actually would say, how are you going to perform the audit?
No, exactly. So in fact, we gave up on it. So.
Yeah, I mean, you don't have a starting point.
Yeah, exactly, sir. So, what if, okay, we get a voluminous data in our audit trail, and what is our role in that?
Sorry?
So let's say if the client gives the audit trail and it is running through multiple row items, let's say it is more than 1 lakh as a row item. So what is our role as an auditor? So what are we gonna?
So I think that is where, so if you ask me,
Yep.
I will not be able to test that because I am not an information systems expert. I'm a basic auditor. Okay? So that is where I will need my information systems expert, specialist, to come in and tell me what are the tools, what are the technologies that I need to use to be able to audit that kind of voluminous data. Right? There are ways.
Okay.
There are definitely ways.
Because
it is being done.
Yeah. My question is this, sir. Let's say for a big four like you, maybe it's easier. Whereas it comes to mid-size and small-size firms. So what are we should be looking at when it comes to this audit trail? Because mainly NFRA and the institute will also be worried about that area.
Big size and small size and all. See, some of us, let's not say that we are small and we will not follow this process. Because some of the entities like ONGC, Indian Oil Corporation, huge ones, we are the one who are also doing. So that is the workshop's idea is also to bring to our attention that these are important matters you need to actually include, scale up. And like Shiv Prakash said, that remuneration and the cost, so they need to be built in, taken care of. And about your IT related the data and how to address that, etc. Probably in the ROM session, if you have you seen the ROM, our document?
No,
No, we issued it, but I'm not holding you for that. But if you see it, we'll cover there the access control, IT general control, ITGC controls, all those things which if you follow that, and like Amteshwari rightly said, you definitely need for when if you are doing, audit of IOC, etc. You definitely need to bring in an IS expert into your team, and that's when you will be able to really do that reasonable assurance audit. Otherwise, you will be doing a scope limitation. So in ROMM stage, probably we can
next session.
Yeah, next session we will see that.
Maybe a request to the president also. So he's asking for, I guess, enabling tools. When you have such voluminous data, how do you audit it? How do you look at audit trail? Maybe that's something that the association can think of for the profession. To say that is there other ways that we can support the profession. To say how do you bring that about. Okay, this slide I'm not covering. It is there in audit strategy, obviously, because as I said, audit strategy will touch on it. This will be touched in greater detail in the next session, as Kulkarni was saying, when you talk about control risk, inherent risk, risk of material misstatement, with an example. So this one I'm not taking right now. It will be taken in the next session. Again, just another example of how you could document your understanding of the internal control systems. If you see, when you say component, typically these are, if you're as old as I am, and if you go back to the old COSO framework, there are new COSO frameworks now. And if you look at that control environment, risk assessment, control activities, information communication, monitoring activities, these are very, very traditional, classic components of an internal control framework. And this is what we need to understand and ultimately get comfort on. And then, of course, the control activities bit is where I was saying where we give the internal controls opinion. We do more testing on that, the test of controls, to be able to issue the internal control opinion. Now again here, I think this is one part probably we all do, again as part of, trying to start the audit, trying to get into the planning stage of the audit. Obviously we will consider what are the significant accounting and auditing impacts for that year. I mean, for example, I'm pretty sure one of the accounting impacts which everybody is thinking about is the labor code, right, which is going to hit us in this last quarter itself, right? That is going to come in, so that will have an accounting impact. If you're talking about auditing developments, there was a reference to the those charged with governance circular that has just come out. I think that was 7th, probably it was released. That is going to have a significantly big impact on how we've been doing these communications. We'll have to start rethinking. In fact, what I like in that, sir, is you've actually told the companies also what they need to do. So which is what I like. You've told the companies what they need to do. So that's a good thing. We can go back and tell them, look at the circular and start doing those. Thank you for that. So yeah, so I think I think we would do these because we are very conscious about what are the new accounting policies maybe that come in. Is there any new accounting that the company is adopting? And that also we need to talk about and we need to capture in this audit strategy document. Yeah, we've spoke about this little bit, the information systems auditor. The other piece which is very important is more often than not, because the Companies Act requires it for certain size of companies, they need to have an internal audit department. Now, while we may or may not want to rely on what they do, right, definitely we should understand their scope. We should understand what are their findings, because we cannot ignore that. Just because we haven't found it, if the internal auditor has found something, we definitely need to see, do we need to pay attention to it? How does it impact either my financial statement audit or my internal controls audit, or for that matter, even CARO? It could even impact CARO, right? So you will need to get those internal audit reports, you will need to study them, you will need to see what are the impacts, if any, that are there on your audit strategy and your audit plan, and bring that into the entire documentation of how you're addressing that. We spoke about information systems. I'm not laboring that point anymore, but believe me, this is going to become, this is already is, and it is going to become a large part of, if you talk about the number of hours that we spend on audit, as our clients are automating, as our clients are becoming more so sophisticated in the way they process transactions, I think the information systems audit is going to become more and more critical, right? And therefore, we will need the right specialists and experts to be able to help us get through that. Experts, specialists and experts, the other ones, the typical ones you will have is actuaries, because clients will use actuaries for all the retirement benefits. There could be valuation experts if there are fair value measurements that happen. There could be tax experts if there are transfer pricing studies and things like that that are taking place. So all of this will be on the client side, right? And as you know, if the client is using an expert, we will have to, under the auditing standards, look at the competence and objectivity. And then if we don't have that expertise, right, we will then need to bring in an expert on our side as well, right? So for the simple example that I will take is valuation. Valuation is, I heard that, sir, I think you are a valuation expert. I don't hazard any guesses on valuation, because every valuer I go to gives me a different number. So valuation is not something that we do. Yes, we understand cash flows, but I think there is a lot more to valuation than just DCFs and cash flows, so that there you might need help. So all of these you need to think through, all of these you need to really document your thought process as to why you're bringing them in, and what is more importantly, their scope of work, how they're going to support your overall audit. Again, just a sample document. What is important here is the competence, capability, independence. If management is using an expert, this is something that we must do, because this is a requirement of the audit standard, as all of you would know. Right? That's something that we will have to do. Okay, materiality. And this is an area where we can say professional judgment, right? Nobody can question me. But I think while we can say nobody can question me, right, unless, there are laid down parameters on how you get to that materiality. And I think that is what is important, that thought process of professional judgment. If that is not documented, then somebody who's looking at your file is never going to understand how you came to that materiality number. And the standard is very clear, 320 is very clear on what types of thresholds you need to set up 320 talks about quantitative thresholds, but it also alludes to qualitative thresholds as well, and I'll take an example of qualitative a little later. But you start materiality with saying, what is the appropriate benchmark? Most of us say that for profit-oriented entities, it could be either PBT or it could be revenue. For, let's say, asset-based companies, it could be total assets. Sometimes, in very specific situations, you could even take net worth. So the standard actually allows you, but what it says is that whatever you choose as a benchmark, you must have an articulation of that rationale in your file as to why that is the appropriate rationale in your particular case. Once you have that benchmark, then you set up essentially 3 quantitative thresholds: overall materiality, performance materiality, and then something which is called clearly trivial threshold. Now, there are certain indications, there are some global best practices on what is the rule of thumb that you use for overall materiality. Typically, you wouldn't go beyond 5% if you're saying 5% of PBT. If you're taking revenue, typically you wouldn't go beyond 1% or expenses beyond 1%. Again, these are illustrative thresholds. These are there. Some of these are there in the standard itself. But again, it is for us to be able to think through what is right in our case and what is right for that particular audit, and document the rationale and put it in the file so that that justifies why we have taken that materiality for the purposes of the audit. So you take the overall materiality. Performance materiality typically is a haircut from that overall materiality, right? So if you have overall materiality, let's say as 100, just as an example, you would take performance materiality at either 50 or 75, simply because performance materiality is another way of looking at covering aggregation risk, right? Overall materiality is the maximum tolerable misstatement that I can withstand. Beyond that is a material misstatement and probably a qualification. Now, if that is overall, then you need to, when you do your testing at the financial statement line item, you will necessarily have to do it at a lower level, because multiple misstatements could then easily exceed, the aggregation risk that is there could easily exceed your overall materiality. So which is why when you do your scoping, when you do your, when you see how much you need to test, what is the extent of testing, you will typically use performance materiality. And then finally, of course, it's the concept of the clearly trivial threshold, which is nothing but saying that a threshold which is below which actually you don't care about that misstatement. And that's something where typically you will have an understanding that even those charged with governance think of it in the same way, right? Because again, this is our judgment, but it will obviously need to be bounced off with those charged with governance to say that, look, this is what we think based on our experience and how we understand the client, right? What do you think?
Here's a question on, if you are the central auditor of a company or a bank, and one small branch auditor brings out a particular problem, do you close the audit just with the amendments which come from him, or do you have to telescope it across the organization?
So I'm presuming that in that case, you are the principal auditor, and therefore you would have scoped in probably a component, and you would have also calculated what would be the appropriate materiality for that component, right? Is that the case?
In a bank branch audit especially, everything happens within, even before you get your appointment, the audit is over. Or before it sinks in. Okay. And so there are some fellows, like our firm, which says, okay, forget about everything. We don't care about the circular. We sit there hard, then we wait for the, telephone calls to come from the everybody. Then finally we'll remove you as auditor. That time we say, okay, we'll send audit report. And we would have found some things which nobody else has found. Or we presume nobody else has found. And then the audit is over. And we don't, and even everybody is working under time stress, because the board meeting is fixed first, and then the time for the audit is also determined accordingly. So when you're a principal auditor, and especially when you come to the trivial threshold, how do you deal with it if a particular branch brings out certain aspects which are not considered across by other auditors. And the possibility is there, it could be there, even in a particular type of, let us say, agricultural branches. And these branches are not done by the top auditors, or the smaller SME branches. Again,
Now I've understood the question.
yeah.
Yeah, so I guess first thing is that if you found, or let's say if you found an error, right, or if you found a misstatement, right, and if you're looking at that misstatement in the context of clearly trivial threshold, and it is above that, I'm assuming it is above that, right? If it is above that, you will have to accumulate it across the board, across branches, right? Now, to your second point, you'll have to accumulate and see to what extent the misstatements are there, and does it then touch the overall materiality. Then you have a material misstatement. That is one part of it. The second part of it, which you said is very interesting, you're saying maybe in one branch they've found it. Now, you think, as an auditor, knowing the business, it could actually exist in other branches as well. I personally feel, this is my personal view, you have an obligation, regardless of timeline, to go down that route and see whether it exists. Yes, it's difficult in real life. It's difficult to have that conversation with the client. But the way I would think about it is, if you believe that you found something in one place, in your example, in a particular branch, and it could be that it is there in other branches because it's the same kind of business, same sort of an issue, you would definitely have to go down that route regardless of timeline.
I want to add one small thing here. As far as the public sector bank audits in India are concerned, it is actually sort of a different kind of a environment you are working. Ideally, the principal auditors who are there, they should have set a limit, materiality, etc., and that all should have been communicated to the branch auditors. Like, this is the materiality. But that, for the timing, I think, I'm not sure whether it is happening. But yes, when the report goes to the, like Amtesh says, the central statutory auditor with this, they should be looking at it the way he has said, and see that whether is it something across the organization is happening, should they actually extend and look at other branches. But the primary thing there is in the public sector thing is that we need to actually fix that, the bigger level thing, that who is responsible for doing this materiality limit, etc., and giving the instructions and intimating them, etc. So if you see some of our orders on DHFL, etc., we noticed that there was virtually, like Chairperson said, there was no conversation at all between the branch auditors and others. So this is a sort of, I would say that slightly different risk which we are carrying when it comes to the public sector because of the large number. Yeah.
Talking about triviality, we had a question regarding, okay, an audit trail is given with nearly a million corrections. Let us say...
Oh, million corrections?
Yes.
And going backwards correction?
In a year, suppose you use a tally software, and with wonderful accountants, they will keep on, they'll keep on making, as and when somebody gives them a better way of passing the transaction, it will get, they go back and make the correction, and you get a big list of corrections. Now, what the regulators have forgotten to tell us is that the rules, accounting rules, very clearly say if you are maintaining in electronic mode, there should not be any alteration to the database.
Absolutely.
So then what do you do as an auditor?
No, I think the one part of it is the size of the data. The other part of it is, if you're saying it's a systemic issue where you see that there are multiple or many alterations and many edits that are happening over entries and transactions over a period of time, I would actually say that's probably a fraud risk, right? And you might have to go down that route. I understand the enormity of it in terms of the size of the data, but there will have to be a method in which you will have to end up testing that, right? And there are ways to test that. I mean, a little short of time, but there are ways to test that actually when you come across that kind of an issue. to say that you're finding that there are multiple alterations to, let's say, the original transaction, the way it was processed or the way it was posted, right? There are ways and there are techniques that you can apply in terms of substantive testing as well as reasonableness tests in which you can pick up red flags. You will not be able to do 100% testing, because that's not our mandate in any case.
No, the mandate is you have to report whether proper books of account as
Absolutely.
required by law have been maintained.
Absolutely.
And if, forget 100, 1 million, only one alteration is made to the database, are you in a position to say proper books of account have been maintained?
Okay, maybe we'll take that.
Yeah.
Okay, I'll quickly move on now. I think we've covered most of it. Consolidated financial statements, Kulkarni just opened. I was not aware that in banks this doesn't get done. In public sector banks at least, it doesn't get done. But yeah, there is a lot of guidance now which is available. Yes, in India we still have SA 600. We don't have the ISA 600 revised. So therefore there is a big difference in the way in which we look at it. I'm not getting into right wrong at this point in time, but if you take SA 600, you read it in letter and spirit, you overlay that with the NFRA circular and the SEBI requirements, there will be quite a few requirements that are there for the principal auditor which will emanate from there, right? And just a simple reading of that will give you that. So for example, in terms of what components do you scope in? What is the level of comfort that you need on the components? Do you need to understand a consolidated risk assessment? Do you need to give them materiality, the point that was just being made? So those are there. Yes, I know that this is a little bit of a contentious topic right now. I won't get into it, but I think you do a holistic reading, you look at the NFRA circular, the direction that is there, those things will need to get done, and then it comes very closer to the international standards. Not there fully, but comes closer to the international standards. Okay, finally, after all this that you've done, there typically should be a summary, because the idea was that this was a preliminary risk assessment. So you will have a summary of what are the risks that you've identified on a preliminary basis at the standalone financial statements, at the consolidated financial statements, and that will also then need to get into this audit strategy documentation. This is just an example. You could do it financial statement line item wise. What are the risks that you've identified? What was the basis? What could be the possible assertions that are impacted? And then of course an assumption of is it a significant risk or a normal risk? And then this will feed into the audit plan as you make the audit plan, which will be the detailed audit procedures and the detailed risk assessment. Yeah, and this is the project management piece, which is essentially the roles and responsibilities as well as the hours that one needs to have. That's all I had. Thank you so much. I don't think we have time for questions, but happy to chat. I'll be here for a little bit more, so we're happy to chat. Thank you.
Sir, I must say it was engaging as well as interesting session. I now invite Shyam Tank, Executive Director, I now invite Shyam Tank, Executive Director, NFRA, to present Memento to the speaker, please. From round of applause.
As engaging as we expected, yeah.
Amitesh sir, just 2 more minutes. Now I request CA Abhilasha Chaturvedi, Chairperson of Corporate and Allied Lawyers Committee, KSCAA, to present the memento to Amitesh Datta from KSCAA.
Members, we have a couple of announcements. One is the annual conference which is coming up on 27th and 28th of February. Do register.
Thank you.
Outside you can scan and register. And one more announcement.
Second, if any of you are not members of KSCAA, please do register and become a member of KSCAA. There is a 25% discount for the new members for the upcoming annual conference. Thank you. Now we break for tea. We reassemble back in 15 minutes by 11:40. Thank you.
Thank you. it into two parts. Now we'll be having first part having 1 hour, second part will be for half an hour.
Request everyone to assemble back in the hall.
It gives me great honor to welcome CA Ajit Vishwanath, who is a chartered accountant, bringing over 20 years of experience and a partner in BSR & Co. LLP. In his present role, Ajit leads the technical team responsible for forming point of view on auditing and accounting matters for his firm and also leads audit of companies in the financial services sector. Ajit sir, on the dais please. Round of applause gathering.
On करना. Yeah. Thank you. Thank you for the introduction. I first would like to thank Karnataka State Chartered Accountants Institute Association and NFRA to provide me this opportunity. Today we will cover, the NFRA had released this document on risk of material misstatement. We will spend some time discussing that and exploring the various facets relating to the risk of material misstatement. But before that, I would like to go around and ask a general question, not relating to auditing. Say, and this is the land of Royal Challengers Bangalore, I'm sure there are a lot of Royal Challengers Bangalore fans, RCB fans. Can RCB fans raise your hand, those who follow RCB? Yeah. So say, imagine you got the opportunity to coach RCB this season, in the upcoming IPL season. I would like to understand from you, how would you approach this job? Would you turn up on day one of IPL and start coaching your team? Or would you do things differently? If anyone can raise hand, use your mic and tell me what would you do? Just a general question, you can just have, what would you do as a coach? Say you are appointed today, how would you approach this job? Anyone? Someone has raised their hand. Thank you. First,
Hello.
thank you for
Thank you.
responding.
We would understand each player's strengths and weakness first, and then tailor it to accordingly.
So, which players? Your players, competition's players?
Both.
Both.
Yeah.
Will you then want to have a say on who the players should be in your team?
Yes.
Okay. Would you study your opposition?
Very much. Yeah.
Okay. Would you then determine who's your competitor for the title? Who's your risk?
Yes. We'll do
Right?
complete analysis for all the teams then.
Right. And therefore, you will go through an elaborate process before you actually play the tournament, right?
Yes. Before we jump into it.
Audit is exactly similar, not very different, right? Like, just like how you are thinking about coaching an IPL team and you are thinking about how you will plan for your competition, how you will identify who's your main competitor for the trophy, you will think of your personnel, who should be in my team given the competition, given the pitches, you will study the pitch as well, etc., right? The same way, when we talk of audit, and Amitesh also spoke about this a bit, when you plan for your audit, when you strategize for your audit, you think of various elements relating to the audit, right? You think about staffing. Staffing is a very important element of your audit plan. Who should I have? Do I have the people with the right experience to deal with the audit, right? You think about various other elements relating to the audit as well. One of the important elements of that audit planning stage is identifying risk of material misstatement, right? Let me kind of take you through the slides as well. So risk of material misstatement has broadly two parts. One is inherent risk. Inherent risk is the misstatement that could occur absent controls. And the second is control risk, that a statement could persist despite controls, right? You have to consider both inherent risk and control risk when you are determining risk of material misstatement. Now, if you think about it, you have to after having determined the risk of material misstatement, having determined your inherent risk, having considered the control risk, effectively control risk you also have to factor in the outcome of your IFC testing, whether it is effective, it is operating effectively or not. You would then go on to identify the significance of the identified risks. You would proceed to think about what is the likelihood of occurrence, other qualitative factors, and so on. Now, if I were to kind of take you forward, Amitesh spoke of this. What some of the risk assessment factors or some of the risk assessment procedures operate at an entity-wide level, some of them operate at a caption level, right? Similar to the risk of material misstatement. The risk of material misstatement can occur at a financial statement level, it could occur at a caption level. So therefore, your procedures, the risk assessment procedures, are also directed both at an entity level and at a caption level. So if I were to kind of walk you through some of these risk assessment procedures, understanding of the entity and its environment, understanding of the internal control framework or what is existing within the company. When you accepted the audit, you would have done an evaluation of the client or the company and evaluated the business, you would have evaluated the promoter, you would have looked at various other factors. You would then factor that in. Has that changed? You would consider that. So remember, while you did the assessment at the time of accepting the engagement, that information is still relevant year on year because you have to keep updating it. Say there is a change in shareholder, there is a change in promoter, you have to keep updating it. There is some public domain information of what went wrong with a company, income tax rate. You have to factor that information on a periodic basis, even though you assessed once at the time of client acceptance. You have to then move on to analytical procedures. When I say analytical procedures, that would involve analyzing year-on-year financial statements, that would involve comparing it with its competitors, benchmarking its various metrics, ratios, and evaluating, is it in line with competition, is it different, how is it different, were there any one-offs, what are the analytical reports or analysis which is there in the public domain, what does it say. You consider all of that information and then you conduct a risk and planning discussion, which is essentially a discussion amongst the engagement team. And if you remember, Amitesh also spoke of this, that this is the discussion where the more experienced team members share their knowledge, pass on to the less experienced team members, and you agree on the plan which is going to be executed throughout the audit. This also includes talking about what are the risk of material misstatement relating to the audit, which we'll cover in a bit more details. But that is the discussion where all of this culminates into deliberation and debriefing amongst the team. And of course, there is inquiries, both internal and external. This was also covered by Amitesh in terms of inquiries of senior management, inquiries of external stakeholders, as the case may be, right? If I were to summarize this, the job of an auditor is not easy, right? For you to be able to perform all of this, practically speaking, you need to have as much understanding as the promoter of a business in the same sector. Why do I say so? Because you need to understand what are the emerging trends. You need to understand what are the pressures, what are the expectations of shareholders from this, what are the regulatory framework which is impacting the business, how does competition look, right? What is the expectation from say analysts every quarter before the results come in? Like all of you must have heard of NVIDIA, right? Almost the entire global economy and the stakeholders look forward to NVIDIA results. If NVIDIA sales goes up, everyone is happy, stock market is happy. If NVIDIA results go down, AI bubble, everything is coming down, stock market crashes, right? Now, as an auditor, you cannot be oblivious to these elements which are around the entity, right? If someone kind of thought that audit is just about ticking the documents and checking the documents and issuing an opinion, we must be able to explain that it is much, much more beyond just testing supporting documents. It is obtaining a deep understanding of the company's business. It is obtaining a very thorough kind of thought process on what is impacting the shareholders, what is impacting the CEO, what is the CEO compensation linked to, right? If you remember fraud triangle, one of the elements of the fraud triangle is knowing what incentives are offered to the KMP so that what would drive their thought process, what would drive their actions. So therefore, in essence, as part of your planning process and information and knowledge which you have acquired through the past audits, one must consider all of that before taking a decision on what are the risks of material misstatement. So that's very important. And the other point I would call out here, which I feel is very important, is that given the complexity of carrying out an audit, there are as many auditing standards, there are interdependencies amongst various steps which we do. The timing of performing these procedures is as important as the procedures. So for example, if I am signing off on an audit for 31st March on 30th April, if I were to perform this risk assessment towards end of March, right? Even if I did everything properly, it would not give you the outcome which you would like, because there are so many dependencies on this step of risk assessment, which you will need to kind of factor in before you plan your substantive procedures, before you plan your test of controls, before you plan your key audit matters. There's so many dependencies. It's very important that the relevant step is performed at the right time, well in advance of the year-end timeline or when you are issuing the report. Of course, it is also true that even if I perform this in November appropriately, say for example for a 31st March, there's also responsibility on us as auditors that we keep revisiting this in response to any event or information which we come across in relation to the company. So just for example, I performed a risk assessment in November. Now labor code came through. Before I performed on first week of November, I audit an IT services company and labor code came through. Now it has a significant impact on the financial statements. So should I not revisit my risk assessment and think through how I will address the risk of labor code, whether it is a key audit matter, if there is a significant charge expected on account of remeasurement, should I relook at materiality, or do I keep it as a one-off? There are so many questions which one has to think through. So therefore, one should not look at risk assessment as a point in time activity. While we begin risk assessment at a point in time, and that should begin well in advance, but it's extremely important that we are constantly reviewing our risk assessment to see whether there are any update required or not. Right? I'll pause here in case there are any questions, any comments anyone would like to make. Okay. Right. We spoke of risk of material misstatement. What we've done here, and this is borrowed from the illustrative document which the NFRA has put out recently. These are 3 or 4 examples of how risk of material misstatement look like, right? If you look at this, the first one is revenue is recognized for arrangements that do not meet the definition of a contract under the standard. The second one is revenue is not accurately recorded because transaction price is not appropriately determined, and there are allowed performance obligations satisfied at a point in time. So the couple of common things which you would see here, most of these are linked to financial statement captions, right? So these are around revenue recognition. So therefore, various elements of revenue recognition, but specific in terms of which aspect of revenue recognition. And risk of material misstatement could arise due to error or due to fraud. And that is an evaluation which one has to go through. Now, one of the important terms in context of risk of material misstatement is assertions. Because the first step after we identified the risks of material misstatement, we need to determine which is the relevant assertion, right? So if you look at the screen, assertion is representations by management that are embodied in financial statements as used by auditor to consider different types of potential misstatements that occur. But for us, in context of risk of material misstatement, we have to consider relevant assertions. And what are relevant assertions? It's a financial statement assertion that has a reasonable possibility of a misstatement that individually or in the aggregate would cause the financial statements to be material misstated. And obviously not all assertions are going to be relevant, so which is an important factor. So if I were to recap the step, we performed all the procedures which we spoke of in the first slide. We performed inquiries, we considered public domain information, we did a financial statement analysis in terms of evaluating what are the trends, etc. Then we filtered down to the risk of material misstatement, because we are talking of revenue as a caption. So let's move forward with that. We identified those 4 risks of material misstatement, and then we are now going to determine which assertions are relevant for those. So even in the auditing standard, these are the assertions which are called out, which one must consider in context of balance sheet captions, in context of transactions during the period. So if you look at transactions events during the period, the ones which are relevant are occurrence, completeness, accuracy, cutoff, classification. And if you look at account balances at the period end, there's completeness, there's existence, rights and obligations, valuation and allocation, and they are separate for presentation and disclosure. So when we identify risks of material misstatement, it is our responsibility as auditors that we identify which specific assertion, which is the relevant assertion for that risk of material misstatement. Because without that, our analysis is incomplete. So our risk assessment has to capture which specific or what are the relevant assertions for each of the ROMMs which we have identified for us to move forward. And then we spoke of risk of material misstatement having 2 elements, inherent risk and control risk. Even Amitesh spoke of it. And I defined inherent risk as the risk that the financial state, that caption could have a misstatement notwithstanding controls, right, or controls being absent. So one has to kind of assess the inherent risk and the control risk before determining what is the level of risk of material misstatement. There are some factors which one has to consider when you look at inherent risk. And if you think about this, all of these are very logical, intuitive elements for that caption. Size and composition of account, the susceptibility due to misstatement of due to error, volume and activity and homogeneity of transactions, susceptibility to management bias or other fraud risk factors, nature of the account or disclosure, related party transactions, very important for us to think about, complexity in accounting reporting, relates to significant economic, accounting or other developments. Say significant development, labor code could be one of the examples there. Significant contingent liabilities, if there's any significant change, subjectivity. So if you think about all the captions, maybe we can take a few examples and think about what would be relevant, what would be not. Say if you think of a bank or NBFC, provision for ECL, NBFC, right? It may take many of these factors in terms of being complex, in terms of risk being high. So if you think about size and composition, the size of a ECL provision is always significant in context of a financial services business. Susceptibility due to error, the level of complexity in calculation, the assumptions involved, multiple spreadsheets, the susceptibility to error does exist, right? There is a susceptibility to management bias, yes, because there are a lot of assumptions and inputs which go into the calculation which are judgmental, and therefore it's susceptible to bias. If you think about no related party, complexity, of course, it does exist. There is also subjectivity, which includes judgment. So it may tick many of those boxes in terms of factors which we are considering, and there. Similarly, if you think of impairment of goodwill, right? Again, that's a classic example where you may have a lot of these factors ticking in, and therefore the inherent risk being high, right? So one has to think about the risk of misstatement and think of the inherent risks which apply and make a determination of level of inherent risk. Control risk we spoke of. Control risk will focus on primarily your expectation or your actual outcomes of IFC testing in terms of what is the, whether you believe that the controls are designed and operating effectively. If that is the case, then the control risk is low. If your IFC outcome is that it is not operating effectively, then your control risk will be high. Or for example, the IFC does not apply, and for some reason the auditor is choosing not to test controls, which normally would not be the case, but if that is the case, then again no reliance on control, and therefore control risk is high. Yeah.
For example, if you have seen our sample document, on the revenue side, Ind AS 115, most of you know, it's, we keep talking about it a lot, 5-step model, a lot of things. And what we see also in, some of the cases which we see is, sometimes the auditor just puts the list of the Ind ASs and says he is considered that, all that. And in some cases, for example, revenue, this particular example which you have taken in the sample document is of the pharmaceutical company. It's a simple revenue model which they have. For them, this all huge 5-step model, is really not applicable for them. So that is why Ajit very rightly was mentioning that first step when he looked at it, risk of material statement 1 and 2, which part of the Ind AS 115 is relevant for that entity. That is the one which you actually should look at. Here basically whether the transaction has occurred, is it supported by a document that there is the goods have been shipped and the contract exists. That's what is more important for that kind of an entity. Whereas, if you are doing say for example, a real estate, company's audit or the IT services audit, probably that 5-step model, where segregating the contract into different elements, timing of recognition of revenue, estimation of the, cost etc. incurred, those will become relevant. So that's why when you are looking at this, very rightly mentioned complexity in accounting and complexity in our transactions. So otherwise, many times we also keep saying, very good, standard is very good, Ind AS 109, we keep writing, but hardly the entity has any financial instruments. It has just trade receivables, but we go on writing too much about the ECL, fair value and all that. So that is not the kind of a thing which is required from an auditor's perspective. Of course, you need to know as an auditor, because if you want to do an audit of some specific entities, you need to do it. But otherwise, this is the way, this, try to correlate the business transactions to the accounting and see that which are the assertions which get affected and which part of the standard is important. And then you will be able to see, probably Ajit will explain now the, what could go wrong, etc. Yeah.
And a couple of things I would like to build on what Sir said is that, in the pharma example, one of the examples of complex situations is, in chargebacks or discounts or schemes is often complex in terms of both in terms of computation and tracking and implementation. Therefore, we do see a lot of situations where auditors identify that as key audit matters, and presumably then it could be potentially a risk of error or risk of fraud on their files as well. So that is something one should look at. And the other thing I would like to call out is we always think of risk assessment as a process which is based on discussions or reading, right? But a big element of risk assessment is also data analysis. So what do I mean by that? So for example, for you to think about what are the trends in your sales, one could take the sales register dump and analyze for trends. Are there any new customers? Are there spikes in sales to those new customers? Are there significant related party transactions compared to previous years? Are there spikes at quarter ends and year ends compared to other periods? Are there significant sales return at the end, immediately after a quarter end or year end? Some of those would only be visible to an auditor or clear to an auditor only if he or she is able to crunch data. It would not be based on just intuitive knowledge or reading of documents. So that is another important element which goes into the identification of risk of material misstatement, because unless we know, for example, if you are not able to validate that is there a spike in revenue recognition in the quarter ends and year ends, how would you identify a cut-off risk or a risk of material misstatement that sales are booked in the wrong period or incorrect timing of revenue recognition, right? Or for example, if there is a significant sales return after every quarter end, how would you identify that risk that sales booked are not appropriate, right? So therefore, big element of risk assessment is also crunching the data of that relevant caption, thinking about what are existing there. And the final point, and I'll repeat this again, is that the most important thing in all of this is that whatever we do has to be documented on the file, which is always a challenge for us when we deal with timelines, etc. But clearly what we do and is only validated by what we document. If it's not on the file, it's not considered as done, right? So therefore it's important that whatever we are saying, whatever we are capturing, so even if we did inquiries of management, it is important that the minutes are there on the file. If we did this data crunching, then the how we validated the source information, how did we do the data crunching, what were the trends which we identified, how did I then take it to risk of material misstatement, that trail has to be existing. Similarly, if you are reviewing minutes of meeting from a risk assessment standpoint, there will be several elements which are approved by the board, audit committees, etc. Right? So which resolutions or which items from the minutes did one consider, and how did one dispose of those items in context of either considering that in your risk assessment, or you said it's not relevant. Similarly, internal audit reports, these tend to be very high volume, a lot of items, not all are relevant. So therefore, how did we capture that in our documentation becomes extremely important as the analysis itself. Because if we are not able to present that in the file in a very clear, legible way for an independent person to understand, it becomes probably a challenge in terms of our audit file. Once we've identified the inherent risk associated with this, there is also a question of whether this is a significant risk. And significant risk, as you are aware, can be significant risk of error, it could be significant risk of fraud. Now, again, the factors which one needs to consider for significant risk includes related parties, is there a risk of fraud, and in context of fraud, the fraud triangle is also relevant. In your pre-read materials, the fraud triangle is also included as one of the items. So one must look at incentive, attitude rationalization, opportunities, and determine what are the specific frauds, etc. And if you remember, SA 240 calls out two default presumed risks of fraud. One is revenue recognition and the other is management override of controls. On revenue recognition, one has to be careful that one does not blindly rebut the risk of fraud. There has to be a specific rebuttal if we are choosing to rebut. Again, to say that there is no risk of fraud, especially in say listed companies, may be difficult. One has to be careful when you are doing that evaluation. The documentation should be specific. There has to be, even for example, we've dealt with cases where the file just says risk of fraud existed throughout the year. Even that is not a great outcome, right? Because without specific analysis, not being very specific about the risk of fraud is also a challenge, as much as rebutting it fully, right? So the answer is actually that the analysis has to be backed by data, it has to be specific, and the documentation around what is the specific risk of fraud has to be extremely specific and captured in the documentation. Only then your procedures can be tailored to what your risk is, because otherwise then the procedures can be very different in terms of what other compared to the risk. Maybe I'll pause here in case there are any questions, any comments anyone would like to make. Okay. And like I said, risk assessment is completely iterative and there are a lot of interdependencies. So for example, you are required to reassess materiality right at the end of the audit. And if there is a reduction in your materiality, you come back, it's like snakes and ladders, right? So right at the end, you're bitten by the snake, you come back to zero because you have to think about sampling, you have to think about the adequacy of your procedures and so on. So there are so many interdependencies that project management is extremely critical when we are doing an effective audit. Because unless we have visibility and clear planning that I have to check my materiality based on the final numbers compared to the budget, I have to see whether it has gone down, gone up. If it has gone down, I have to go back to the start and see whether I have sufficiently covered procedures or not. Similarly, for example, at the beginning of audit when I did risk assessment, I assumed or based on my past experience that controls are going to be effective. and I planned for the audit with a control risk of low, right? Now, as you progress with the control testing, as you tested samples for control testing, you realize that certain controls are not effective, which means control risk becomes high, your risk of material misstatement is impacted, you again go back to scratch, again think of the samples which you need to cover, you need to retailer your procedures accordingly, that again becomes critical. So one of the big elements of doing a effective audit is to be clear about the interdependencies, manage the project effectively. Someone has to have a line of sight in terms of what to track when. If the timing goes off, then it's a problem, right? So for example, if we do not complete our test of controls by, in context of a 30th April sign off or say 31st May sign off by end Feb, then you do not have sufficient time to react to it, right? And the other point I would like to call out on controls is the piece on automated controls. Because now as you see, as you encounter organizations, there's so many systems which are integrated to the financial reporting process, be it revenue systems, be it financial reporting, ERPs, etc. One has to be very mindful of the controls which exist. Firstly, one has to be very careful on scoping of those systems. When we do walkthroughs, one has to be mindful and capture accurately what are the systems which are involved in those respective processes. Then make a determination of, after all the walkthroughs are completed, which systems are actually impacting my audit and impacting the financial statement process. Once that is done, then the testing of general IT controls, where that would involve password controls, that would be change management. It is somewhat related to one of the questions which one of the participants asked on audit trail, etc. And then if general IT controls are effective, then specific IT application controls relating to each of the captions. This is becoming more and more critical as we progress because of the use of technology. Amitesh spoke of AI, but even without AI, if you think about the number of systems companies today are deploying and looking to automate almost every process, billing, collections, all of those are automated. And if we do not have a line of sight on what systems are being used, what are the application controls relating to my risk of material misstatement, how I will audit those, general IT controls, and most important, timing of testing of those controls, it is a challenge for us to do an effective audit if we are not conscious of some of these factors. I'll move on. So I just thought at the end of the discussion, I'll summarize some important points for you to consider. When we say eventually, now when you come to procedures, right, you will, what is the end objective of the risk of material misstatement is to tailor our procedures in accordance with risk of material misstatement. Like I said, documentation of your procedures, documentation of testing, documentation of exceptions, how we address the exceptions, all are very integral elements of how we do an audit. But having then concluded my procedures, the qualitative and quantitative factors of likelihood of potential misstatement has to be kind of considered, right? And even both at the planning stage and after completion of testing. So for example, if I have used sampling and I have had 2 or 3 errors in those samples, even though the size of those errors are not material in context of my materiality, the extrapolation of those findings in context of my total population is a very important step, without which I am not adequately considering considering my responsibilities as an auditor. Inherent risk is assessed along a continuum and involves professional judgment by auditors, of course. And likelihood and magnitude is assessed as remote or trivial, then it does not become a ROMM, no audit response is necessary, but one has to be extremely careful, not only the assessment, careful in the assessment, but careful in the documentation also. Because one of the pitfalls of this is that we got the assessment right in our mind, but in a documentation it's a very short kind of description without capturing all the elements, then it becomes a challenge. If the likelihood and magnitude is assessed as low, medium or significant, audit response is necessary. The significant risks require special audit consideration by more senior engagement team members. Here involvement of engagement managers, engagement partners, is extremely important. And again, evidence of involvement is as important as actual involvement. So that is also very relevant. And of course, the planning and performing the audit to obtain sufficient appropriate audit evidence and the related significant accounts is also an extremely important consideration in the whole scheme of things. So if I were to recap for you, I think the 2-3 important points which I would like to leave with you is that risk assessment has to begin at the right time. It has to continue throughout the audit. It has to capture both internal and external sources. And as we do these audits, we have to strive to obtain a very deep understanding of the business and the pressures on management and what external and internal stakeholders feel about the company which we are auditing. It is also important that documentation is extremely critical. Project management is extremely critical for the interdependencies on the what we do, because as you can imagine, there are so many interdependencies. We determined materiality on day one. We did sampling basis that. Now labor code came. Now I have to think about, I am not saying materiality should change, but it's a factor for us to think and document. Again, you may conclude that materiality should not change even though labor code came because it is an exceptional item, for example, or one-off item. But if that is not in the file, how will we be able to establish that we considered the fact and assessed as not impacting? So that's again extremely important, that not only the interdependency but again documentation. And of course the last piece is because of the interdependency, project management becomes extremely critical. One has to have a complete line of sight in terms of the how to manage the audit as a project and how to think about the various dependencies, starting from appointment letter to the issue of the audit report and then closing the file on a timely basis as well. Right? Would you like to add anything, sir?
If you see our sample document also, there is actually model also is given, like how do you assess, risk of material misstatements. For example, if you have to practically put it down, like there is an inherent risk, which Ajit explained the various factors, and maybe you have assessed that as say low risk or a moderate risk. And then you also assess the control risk by looking at what controls exist, and where you will also go through in that document lot of this control risk. When you come to, you need to assess it from, start thinking from what could go wrong. That's a very important question. You keep asking to ensure that whether the transaction has occurred. In that what can go wrong? Like can there be a bogus branch, bogus invoices which are there, like happened in some of the cases. So to address that, what controls the entity has. It may be an intentional or it may be unintentional also. Does the company has that this one? Maybe a company has this automated system, sales system, and maybe sales of April have got actually booked into the March. To ensure that it doesn't happen, what controls the company has. So this is the way that what could go wrong, addressing that is also very important. And one question I want to just pose to many of you, how many of you have seen those assertions? Do you actually use? Good. Yeah, quite good. It's good to see that many people have seen those assertions. So that is the basis, actually very important part, which the table which is showed. You must remember that if you look at their first, when you're starting your ROMM, your ROMM will go perfectly all right. And another point also, IT general controls and application controls, Ajit very rightly mentioned. The two questions which had come on the earlier. How do I ensure IT system is working properly or not? These IT general controls, like who has access to that, what controls the company has to user accesses, and including the some of the controls, I am sure these people verify on the physical controls as well, on the servers, etc. It is not that auditors do not look at it. What kind of a controls are there on the servers? Who has access to that? I know that kind of a thing. Plus, again, that application control, who changes this one. There are many things, many of these interest rate, prices, etc. They're all coming automatic. And who has those controls around that? Those are the things actually you look at it and then assess the control risk. Considering both of them, that table is also, we have given a sample table, but it is your professional judgment, you need to use it before you actually just multiply that and say that, moderate into moderate is moderate. It may not be like that. Because you will have to, on the ground, you will have to apply that. So this is one very important point just I thought I will bring in. And it has some implications, whatever he said in ROMM. It is not a document you prepared and showed it to NFRA and that is the end of it. No, it has a huge implication on the next stage of the audit, on your sample sizes, the nature and extent of timing, and all those things, it has a huge implication. Yeah, somebody wanted to ask a question there, yeah.
Can you wait for the mic, I think.
No. Yeah, sir, if a company is using an accounting software, purely an accounting software, so obviously it is not an ERP, and so there is a very low level of automation. Does that mean that the ROMM, obviously there is an ITGC, ITSC issue there. Now, will that mean that auditor has to go for more substantive procedures and manual control risk which is available and rely on that, or is there something which something else the auditor has to do along with that?
Yeah, I think the way I would think about it is that when we perform walkthroughs of relevant financial statement processes and the financial reporting process, we should capture all controls which the management is identifying as part of their walkthroughs, whether it is automated or manual. Now, in your example, what you are saying is that because it's a software and ITGC is not effective, you are not able to rely on manual control, automated controls. Then, after having completed the walkthrough, you evaluate whether all the manual controls which has been identified by you as part of the process and documented by management as part of their RCM also, is that sufficient to address the potential risk of misstatement? That will it prevent a material misstatement in those captions or in that process? If we feel that, then it is not a problem because the manual controls, and you should test it and it should operate effectively. If that is the case, then the fact that the software has GITC issue may not matter. The only thing I would add here is that because in your case it's an accounting software, the financial statements are prepared basis that, journal entries may be posted basis that, I would be very skeptical and careful when I am making that evaluation, because as you are aware, one of the presumed risks of fraud is management override of controls, and we test that through journal entries, and many frauds are perpetrated through journal entries, and this has a direct impact on that, so I would be careful about it, but that's how I would approach the situation. Right. And a couple of points I would like to add on the illustrative document. The objective of the illustrative document is to just illustrate examples of how to document. But for example, the risk of material misstatement identified in that document is most likely will not be always the same for your situation. So therefore, one should not just, the objective of the document is to illustrate how you should document and not pick the risks and not pick, like sir said, how to compute the risk, etc. It is just a framework for you to just use the same template to document your assessment. But each team, each auditor has to go through the process which we spoke of, identify specific tailored risks of material misstatement for their clients, and then take the process forward. And it is just an aid memo for you to kind of use, but not just kind of take the same risks and assume that in a pharma company always that would be the case. For example, the risks of fraud which are called out, there is one risk of fraud which is called out, there may be many more risks of fraud, right? And the other thing I would call out is this is revenue, it's presumed risk of fraud, an auditor should not lose sight of other captions and where risks of fraud exist. It's not only the areas which is presumed, which is revenue and management override of controls. There could be risks of fraud in other areas also, like in a bank you would have provision for NPA, or a ECL provision in an NBFC could be an area which may have a risk of fraud. So one has to be alert to where across captions where does risk of fraud exist as opposed to this. The other point on the illustrative document, that document illustrates the risk of material misstatement for a caption. But as you are aware, risk of material misstatement also exists at a financial statement level also. So you have to think about how you will document that. It is not to be extrapolated to all those situations as well. So therefore when one is referring to the illustrative document, there are some points at the background which are mentioned. Please do read that carefully, absorb that before you begin to use that document and apply in context of your audits. With that, I'll then request sir to, I'll hand it off to you. Yeah, sure, sure. Can you use a mic, please?
Yeah, I'll give.
You were talking about the walkthrough where we are going to talk with the management and understand the pressures under which the management is. And we are also going to do a fraud risk analysis where we say that, with emphasis on the management override of controls. So how exactly do you advise in case there is some kind of a conflict between the two, and you as an auditor is going to is put in a kind of a situation where you'll have to take a decision?
So when you say conflict, you mean different factors pointing in
exactly.
different directions.
Yes.
Right. So I think much of our work which we do as auditors involves judgment. Across, if you think about starting from materiality, thinking about what controls, thinking about whether the controls are operating effectively, designing procedures, identifying of ROMM. I think the key would be to consider all the factors which are there in the auditing standards. Many of those are illustrative or inclusive, so therefore we have to capture the essence of the requirement as opposed to looking at only the examples, and then document that judgment. I don't think we would in practice, we never have situations where things are very clear cut or very straightforward. It's always pointing in different directions, be it accounting or be it auditing or factors around auditing. So I think the key is to exercise judgment, use the auditing standards as a reference point whenever there is a judgment required to be exercised, and most importantly document that assessment and judgment and keep it in the file for reference.
So how do you actually, account for the assertions given by the management itself?
Yeah. So I think her question, I'll just repeat for benefit of others. Her question was, how do you account for the assertions given by the management during inquiries, etc.? We are required to corroborate that. We cannot take inquiries or the feedback received as part of inquiries from management at face value. We have to corroborate that with our past knowledge. We have to corroborate that with our auditing procedures. So for example, even like I said, when we do data analysis for risk assessment, if management provided me a sales register, does not mean I take that sales register as is and do the assessment. I still have to look at the accuracy of the details provided by the management, because it's an important step for me to perform the risk assessment. Similarly, in the feedback provided by management, I have to corroborate either through internal sources, if possible through external sources, and then make my decision and form my opinion on that matter. Okay. Any other questions before I hand off?
I request gathering to give a round of applause for the speaker. Truly exceptional presentation. Now I invite Shyam Tonk, Executive Director, NFRA, to present a memento to the speaker.
Coach than Andy Flav to RCB. I think the audience will agree he'll make a better coach of RCB than Andy Flav.
Yeah.
Thank you.
Thank you.
Requesting CA Naveen Hegde, Chairman, Journal Committee, KSCAA, to present memento to the speaker. Thank you. Now we head to the second part of the second technical session. It's an must awaited and everyone would be using it. Session titled Audit Sampling, Statistical Tables and Global Best Practices. I welcome CA Vidyadhar Kulkarni sir, NFRA faculty onto the dais and address the gathering, please. Round of applause for sir.
Good afternoon, everybody. So before the lunch session, so I'll be taking this little bit of a boring topic, sampling. Yeah, and before that I begin this session, I want to just my colleague Gaurav Saini was to join this session, and because of some emergency, could not able to join that. So I'll be taking you through this session alone. So as in the morning, beginning I mentioned, we keep talking about the reasonable assurance, lot of theoretical way. Similarly, there is a standard on audit. How many of you are aware of standard on auditing? Very good. And on sampling, which one is it? 530. And does it address the current scenarios of IT controls and many other areas? I don't think so, personally. And it was written probably about 30 years ago. It continues. That is the standard which we have. But here, many you keep hearing, आजकल सब IT में चलता है, everything is happening IT. Now, why do you want this sampling? Why do you want to do, etc. So in this context, the UK regulator or counterpart, Financial Reporting Council, did a study, thematic review of is it relevant audit sampling. It's a study done recently in 2023, and that paper is also available on their website. Very interesting one. They have done a study of all large firms where the companies which are involved are having a huge IT environment. There they have said that even with this, all this, many people talking about audit data analytics. Audit data analytics is something the earlier my era people will call it CAT, computer assisted audit techniques. Now the new younger ones call it audit data analytics, etc. So even with that, the sampling is an important area where the people are still using. For example, to give many times the reports are generated by the management. These are called IPE. Have you heard this in any of the standards or essays? IPE. What is it? Information produced by the entity. So, say for example, inventory aging report, trade receivable aging report, many other these kind of reports are there. These are information produced by the entity. Some of them could be manual, some of them could be IT generated. So to test those controls, what are those controls existing around that? And plus there are many other areas where the controls, etc. need to be tested. Or even in, for example, a substantive test if you want to do it, there looking at the volume of transactions like revenue, can you check all 100% of the revenue or a interest booked? You might do some calculation checking through systems, but the real part of it, that whether it is supported by an appropriate document or evidence, that test you will not be able to do it through the IT technology. You will have to then apply the sampling technique. That's why it becomes quite important. Now, coming to this, our SA 530, it talks about 4 or 5 different components, like starting from sample design, means what kind of a sampling you want to do, whether you want to do a particular financial statement line items, and which approach you want to do, etc. That is the one. Then most important today, which I'll be talking specifically about, is the sample sizes. How to determine the sample sizes. And then next stage comes, is very important, is selection of those. After you select the sample sizes, which are the items you are going to do? That is where it comes the stratification of the population, etc. Then performing tests, and then evaluating sampling results, projecting misstatements. These last two items we'll have after lunch. Arun Kumar will take that, how do you evaluate the sampling results. So now the audit sampling, what are the approaches? Two approaches which are broadly, even I think standard talks about it. One is the attribute sampling, which is primarily used for testing the controls. It means you are trying to see, is the control functioning? An attribute, it's called an attribute. In 30 years ago, when I used to work for an international firm, we used to call this test of control a test of key attributes. Means we used to identify these key controls, those are known as attributes, and we used to test them. That was the terminology. And this is primarily used for a lot of this testing the controls like revenue, payroll, purchases, these kind of ones. And if one wants to use the statistical samples, which I'm going to show you some of the tables. Of course, don't get scared by those tables. It is, my idea is to just bring to your attention that internationally there is a good material available, which we all should also be taking benefit of that. If something more, if we can do a refinement to that, yes, we should think of it. So I'm sure many of us have heard statistics, binomial distribution, hypergeometric distribution, etc. These are the models which are used for determining those sample sizes. And then the other one is the variable sampling, it's called. It's basically, you are trying to, it's used for substantive tests, and you are trying to ascertain the amount, the dollar amount or rupee amount of a particular revenue. Is it correctly stated? Is there a risk? Is there a risk of material misstatement in that number? To test that, these variable sampling approaches are used. There are this, you know, heard MUS sampling and, PPS sampling and all that. Basically, like if you want to send out a trade receivable confirmation, like somebody, in Delhi when in conference, they asked, BSNL has 5 million customers, sir, how can I confirm the trade receivables? Yes, you use the sampling, and out of million, maybe if you do it, we using this statistically, 1,000 customers or something, send a confirmation and get, and then your audit results will be, you can rely on kind of audit result. So another thing is the inventory valuation checks. You know the inventory valuation also large number of items. Or for example, if you are doing an audit of a retail bank, retail consumer loans portfolio, if you want to confirm so many mortgage loans, you will not be able to see confirmation for all of those. So use those kind of sampling techniques. And here the, basically the models are basically, the sample sizes are determined based on another, probability distribution theory is there, Poisson distribution. That's the one which is, used. I'm not trying to make you or ask you that become experts in statistics, like Dr. S.P. Gupta. Some of our seniors like Javli sir, etc. would know that we used to refer to that book when we were studying for CA exam in 1980s. Sir, nowadays students don't study. They only study the materials. ICA study material and that's it. Yeah. So now coming to the sample sizes, more specific to the topic which I'll be covering. For test of controls, we have a guidance note of ICAI, which is primarily meant for when you are issuing an opinion on internal control or financial reporting, what are the sample sizes you should be testing. And there are, of course, you know that control activities maybe happen annually or it may be a monthly, like bank reconciliation statement may be happening monthly, and some entities may have that, their accounts payable and receivable confirmation they take on a quarterly basis. So those control might be happening. And then there will be controls, especially where there are high volume of routine transactions like sales, purchases, and the payroll, other expenses, many of them daily there will be hundreds of transactions, a control will be performing. So that is the one which I am going to talk about. That is where there is challenges there. How to determine the sample sizes. And for that also the ICAI, this guidance note quotes some US internal, standard on internal auditing and says that if the risk is assessed, which Ajit was mentioning, ROMM, control risk, low, moderate, high, etc. If you consider low, then 25. If you consider high, 40. But the question comes to many of us is, when I show some other document, what about the, now we don't, if you see our document also, it is not just two risks, right? Low and high risk. We have moderate risk. We have a significant risk. Then what will you do for that? Second one is, if auditor, based on his past experience, expects some deviations in the controls, how do you build in that? That conditionality, how do you bring in? Another one is, look, based on your experience and the importance of the control, you might say that I am ready to accept some tolerate some deviations. Like you looked at that materiality, performance materiality, etc. It is actually the auditor's tolerance. Itna error hai to theek hai. If my sugar level is 150, okay, I can tolerate. Although it is, the people nowadays say 120 is zyada nahi hona chahiye. Like that auditor does this. How do you bring in those? So these are the questions in this table which are not addressed. So this material, this one is, and again, there is also a question comes, somebody might ask, what is the basis for 25 and 40? Is there a statistical basis for that? Or it was just a rule of thumb or something you heard and you did it? So when you have to move to the risk-based auditing, we need to have a scientific, rational way of thinking. So that is why this tables, statistical tables which I'll be showing will be useful to you. And again, from that I'm quoting from the Financial Reporting Council's study. When they did the study, they noted that the AICPA, American Institute, most of you, I think you have heard this name, they are the one long back, about maybe 20, 25 years back, they came out with this statistical table. They asked some professors in statistics, etc., and they, designed these statistical tables, keeping in mind those conditional probability. So they have come out with it, and this paper also says that in majority of other jurisdictions also, this AICPA guide has become really a norm if somebody is using these sampling tables. And many of these jurisdictions like us, SA 530, they are also using the ISA 530. So we should not have any hesitations in using, because our SA 530 doesn't give you any quantitative way of doing things. So now coming to a couple of these tables, which I'll be very quickly showing you. Like in the morning I mentioned, like if you want to have high level of confidence level, 95% confidence level, which means 5% risk you want to accept, or your test may say that you may conclude that everything is all right, but 5% risk is always there. So in that scenario, this table applies. And by the way, how many of you have read that pre-reading material, which we sent a couple of days ago? Good. Couple of people have read. Please read it. I have given those tables for you actually there. And that full material is about 200 pages AICPA material. I urge you, please, that is available freely. Of course, it is an older version, 2017 version, available there on the internet, Google. The address also which I have given. Read it, very nicely it explains the concepts, etc. Of course, how these numbers, these tables which are given, for that there is a technical paper which is available only for the members of AICPA. If you are a member of AICPA, you will be able to get it, understand how it is done. And if you want to incorporate those, some of you might be using nowadays the audit work paper, tools, etc. are available. Some companies like Idea, which is one of the, firm, world firm, which is actually giving these kind of IT tools. If you want to actually incorporate some of these, etc., you can use this kind of a table. Two things from this which are very important coming to this one. One is tolerable deviation rate. This is where your judgment is required. But many times we keep hearing whether to prepare work paper or do testing, that is my judgment, professional judgment. That is not your judgment. Here you use your judgment. What is it? You want 2%, 5%, or if you feel that the control I am doing, it's a less volume of transactions, I am doing substantive test, able to do it better, then you can accept 20% tak bhi mujhe chalega. Because statistically when you look at it, it still gives you a 95%. And then another one is, based on my past experience, what is the rate I am expecting, expected deviation rate, right? So using this, then this sample sizes are given. And in the bracket which is given is the number of errors, if you find deviation, control deviations, you can still accept the sample, conclusion 95% conclusion. So that is the way this sample is, table is designed. It goes on up to, you can expect deviation rate up to 17.5%. So as you can see, there is, both these are tolerable deviation rate and expected deviation rate. These are the conditions. You are determining a probability of 95% confidence level using these two conditions. This is the conditional probability formula. And now if you want to, say maybe you are not doing a listed company audits and unlisted company audits, so risk is less there. You want to have a 90% confidence level. So then again that table is given. One thing if we can notice from these two tables is, say for example, if you have a tolerable deviation rate of 2% and 90% confidence level you want to have, and 0% expect deviation rate, sample size is 114. Yeah? Go back for the same table. When you want to have 95% confidence level, the sample size is 149. If you see SA 530, it says if your confidence level, if you want a higher confidence level, you need to test more. If you want to lower, then. So this table actually is trying to help you understand the principle given in SA 530. And this was about the test of controls. If you are doing, you can use these tables. Now come to the other part of it, substantive test when we are doing. We also do this substantive test, asking balance confirmations or actually going and verifying the supporting document. Revenue, if you want to do it, is there a goods outward note is there? Is the goods received have been accepted by customers or not? Those kind of a substantive testing when you do, then there also you will again have this concept of confidence level and risk of incorrect acceptance. What is the audit risk? Many of us would know audit risk is, like Ajit mentioned, inherent risk. Then you have a control risk, right? And you will also have many of us which are not used to saying analytical procedures are also very important test. Of course, they may be in a limited situation, they might be used, but that is also a factor one need to consider. And then that gives you, after doing all this, there is always a risk of my audit may not catch the material misstatement. That is called TD. And now if you want to determine what is TD, tolerable, allowable risk of acceptance, its opposite is confidence level, then you change the formula, it becomes your audit risk divided by inherent risk into control risk and analytical procedure. And now next table you will be able to see, like this is all there in that American standard guidance. Unfortunately in India, which going more based on principle based, etc., we have made it so difficult for the people that sometimes the auditor actually forgets to read the standard because he is not finding much in that standard. So that is the benefit of this. For example, in this table, it talks about the control risk. 10% control risk is reliable, 30% is also could be there, 50, 100. So these you can compare to significant, moderate, low, high. Like that you can compare. And you will also have a, say, imagine you are doing an analytical procedure. So in that scenario, analytical procedure may give you only a 10% reliance, or it may give you a 30%. So based on your experience, you think what is the kind of a level you are going to get there. And imagine you have got your analytical procedure is giving 100%, it's not giving you it's not at all reliable. That is 100% risk is there, right hand side. And say imagine control risk is also not giving me a good evidence. There also 100% my risk. Then this table, according to this table, it says that you must have by substantive test 95% confidence level. It means your substantive tests, the sample sizes and the extent of testing has to be higher. On the other side, imagine if you have got this, your analytical procedure, only there is a 10% risk. And control risk is also 10% only. It means 90% you are getting a good evidence from those tests. Then you don't have to do any substantive tests. Unless there is a fraud risk or something which you have identified and you want to do it. Otherwise, based on that table, you don't have to do this. And these are the factors. This table actually goes into determining your sample sizes for substantive test. So this is again the UK paper told you, gave evidence that our standard 530, etc., talks in terms of significant risk, high risk, medium risk, etc. And how do you actually, if you are going to use the AICP paper, how do you link it? What kind of a confidence level? Because the AICP paper is talking about the confidence levels, 80%, 90%, like that. So this is the quite a useful link which is available. Now I come to, I will take just about 5 minutes, 5 to 6 minutes more. Now how do you actually determine the sample sizes? There are two ways of doing it. One is you use this formula. Sample size is population size divided by tolerable error minus expected misstatement. And then there is they have given the confidence factors. Again, they have determined using the Poisson distribution theory, what should be the confidence factors. And the other one is, you will actually, the table itself, there are tables itself, those give you actually sample size. Like test of control, I said, like that, it will give you a. Here, one question I want to just pose before you. Tolerable error or tolerable misstatement and performance materiality. Are they same? No? Or yes? Tolerable misstatement? Says yes. All of you agree with him? Some cases, yes. Actually, the standard also says performance material, normally it should be your tolerable misstatement, but based on your professional judgment, you find that in this particular region, in this revenue, I find a little higher risk. I want to test it more. So because of that, I will actually take a lower than the performance materiality, that is called a tolerable misstatement. In old days, when I used to do audit, that time we didn't have performance materiality term. It was only called as a tolerable misstatement. But the standard now talks about you can reduce that performance materiality to a lower level. Otherwise, it can be the same one. And again, I'll taking you back to this paper, AICP paper, which we have given a link to that. Chapter 4, if you read it, it gives you a nice table of when you can actually reduce the tolerable misstatement lower than the performance materiality. It gives a good indicative factors. What are the areas you should be actually considering if you want to use a different year. And now this is the confidence factors in the formula one when we want to use it, again based on conditional probability. One is if you want to have a risk of incorrect acceptance of 5% to 50%, you can go. Somebody might say that how can I accept 50% risk of incorrect acceptance? If your controls are very good, you can still have that, right? You can do a reduced testing in substantive because you have tested the controls, they are very good, right? So that is the kind of 5 to 50%. And again, you will have to your expected errors, ratio of expected to tolerable misstatement. Both these factors you can consider and you will have this confidence factor. I'll just show you in the next. In this table, how do we calculate this one? Say you have want to seek a balance confirmation for trade receivables. So 1.5 million, 15 lakh rupees is the population size, and number of debtors are 125. You don't want to do it for all 125, and you have determined performance materiality of 1 lakh, and you expect around 10,000 possibly errors when you accounts में 1 लाख रुपए उसका receivable दिखा रहेगा, but the debtor says that it is 90,000. So you might expect some kind of error. And then you want to have 20%, you are ready to accept 20% risk, it means 80% confidence level. Using, then the confidence factor becomes 1.89. And using that formula, 32 customers you send out the confirmations. And how to select those 32? You can actually, there is a stratification you can do, you can follow different approach there. And similarly, these other two scenarios also I have given. If you change this performance materiality or you change your confidence level, the sample sizes will change. This is a simple formula approach. Other one is मुझे formula नहीं चाहिए, मुझे तो सर sample size ही पूरा बता दिया मैं, if you want to do that, this table you can think of using. Again, it brings in one additional factor, tolerable misstatement as a percentage of population. And these are all tables generated based on the Poisson distribution formula, and a lot of theory behind this. Our Gaurav Saini did a good research on that and identified how exactly the formula they have done it. Probably you need computer software sometimes if you want to actually you can put it in your audit methodology or in your firm's this one. Or else simple, if you are doing, you can use this directly from the paper. So this is all these slides are just different levels of risk of incorrect acceptance and tolerable misstatement, different levels. How is it? See, one is our that I see a guidance note there. It only talks about test of control. It gives you a very limited, easy. That's quite easy. Appealing to people 25 or 40 ka khatam karo. But substantive test में क्या करना है ही नहीं. So these are the ones. And if you are using a different kind of a risk, like our paper talks about different risk level, ROMM of a different level, then this will be useful. And this is again an example which I've taken it from there. When you come out with a sample size, then there might be, your population might be of a different values, etc., right? So you can actually stratify your, group them into different buckets. Like you can do it based on the, amounts, etc. So this is one example which they have given. And this is taken from actually there is a software called IDEA. I think this is from the IDEA software, which actually using even the standard deviation concept also. They have allocated the sample, which are 209 needed to be taken. They have allocated across different subgroups. That means subgroups. So this is another very simple example. You can just club them based on the amounts into two groups. And this guide also says you can have up to 10. More than 10 groups is not a very good idea to do sampling. So this was the, all I just wanted to, draw your attention. Basically, the whole idea was to just bring to your attention that there is enough material available outside also. If you do in this world, interconnected world, its material is quite easily available, and we can use it. And this is what is all about the risk-based audit. Not like earlier we used to do 3 months purchases check kar lo, 2 mahine ka ye kar lo, wo nahi hai. That has gone. That was there in 1970s. Yeah, thank you. Any questions?
Yes, sir. Mr. Vidya, the question is, see, now the methodology of selecting the sample. So, as you said, the audit software may be able to generate random number tables, and I can, from the, if I'm using audit software, I get my sample, possibly. But if I'm not using audit software, and I have to justify that my sample is a random sample, how would NFRA, and how would NFRA, if an allegation against me is one is, how do you justify that this sample is a random sample?
Yeah, you just note down your population sizes, okay, in your work paper also. This is from serial number to serial number, so invoices are there, okay. I have picked up, say, serial number 10, serial number 50, serial number 20, this is your random sample. This is, you document that, this is the way I have done it. Or if you want to go a little bit,
the question,
because the sample size you have to determine using these tables.
No, I have determined table.
Yeah.
But how do I support that the sample selected by me is a random sample?
Correct. This is what I explained. You have now tested your population. You have made sure that all the invoice numbers which are there, you have listed them down. And you have not used that any particular bias towards selecting any particular number. You just said that invoice number so and so, invoice number so and so, I used it. So that is a random sampling.
Management may give me the numbers.
No. You have no. Management, don't go. This is one error. This is this is actually.
Nobody knows it.
That is what you have to test your population, whether population is correct or not. That is where you need to test it, and don't accept. Management will give you invoices or the payroll which they want you to look at. You say that no. You give me your how many invoices are there, what is the serial number. You see that serial number and you select on sample basis.
Yeah.
And other one also you could be.
Kulkarni ji, just one here. Just one suggestion there. Whenever you use random sampling, use random tables, random number tables. Generate it. It's a simple thing. Every Excel has it. Keep it with your audit file and link your random numbers with the population. That's it.
He doesn't want to use. He doesn't want to use the random number table.
There should be a source and a verified source even for the random number table. So there should be some source which auditors can use.
Yeah.
Probably NFRA can host a random number generator on its website.
But more than the random number generator, sir, it is important for you to actually ascertain whether the population is correct or not. The population number, invoice number, etc., that if you are able to do it, one is this random number this way, other one is sequential sampling, you use it. Like 1000 invoices are there, I want to test 40, 1000 divided by 40, what is the number it comes? Every 250th item I am going to select. You document this. This is how we used to do. Not necessarily using the random sample. Even when we were doing in a big firm, this is the way we used to do it. And that is the way you document it. Otherwise, don't say that management gave me 10 invoices, I checked. Then it is a problem. Yeah, can be.
Check. Yeah. Let's assume there is a audit work paper in front of you. We just discussed about 25 samples, 40 samples. Let's assume based on any of those variable sampling methodologies, they concluded that the number of samples is 60. Does NFRA say that, okay, the auditor has verified more samples than expected, that is good, option A? Or are you going to say option B, oh no, the auditor is trying to hide something, he found something that something could have gone wrong and that's why he has selected more samples and that's why this is something negative. So what kind of a stand do you take?
This is actually a psychological question you are asking actually. Actually, probably I may not be able to answer that.
Okay. Thank you all.
Thank you.
For further questions, we can have it during the break time.
Yeah.
As the time is pressing, we would like to now move upon. Sir, 2 minutes, sir. 2 more minutes. Thank you, sir, for your insights on the audit samplings. The statistics shared with us along with the global best practices will probably be helpful for all of us. Now, I would request CA Hiramba Hegde to present a memento to CA Vidyadhar Kulkarni, sir, as a token of appreciation, sir.
Thank you.
I once again would like to remind you all that we have our annual conference coming up on Feb 27 and 28th at Prestige Center of Performing Arts, Konankunte Cross. We request all of you to register for it. And now we break for the lunch. Please assemble back at 1:45. We have the next session coming up by the by Shri P. Daniel sir, full-time member of NFRA at 1:45. Request all of you to be on time in the hall.
You will find KSCA membership. Do scan it and register.
Audits exist for one fundamental reason: to support trust, the trust of investors, lenders, and the public at large. When audit quality is high, confidence in financial reporting is strengthened. When audit quality falls short, the consequences are far-reaching: market instability, reputational damage, and erosion of confidence, not just in individual firms, but in the profession as a whole. As a regulator, our mandate is very clear: to ensure that audits are conducted with professional skepticism, technical competence, independence, and integrity. Audit quality inspections are one of the primary tools we use to assess whether this mandate is being fulfilled. Let me now tell you about the overall objectives of inspection, which is to evaluate compliance of the audit firm or auditor with auditing standards and other regulatory and professional requirements, and the sufficiency and effectiveness of the quality control system of the audit firm or the auditor, including, number one, adequacy of governance framework and its functioning, effectiveness of firm's internal control over audit quality, and system of assessment and identification of audit risks and mitigating measures. Now let me describe the framework and the methodology that we have adopted at NFRA. Firms are inspected periodically depending on various factors. From the inspections conducted so far by NFRA, 12 inspection reports are on the NFRA website. 2 reports of 5 firms, namely Walker Chandiok and Company, Deloitte Haskins and Sells, SRBC and Company, PW, BSR and Co., and 1 report each of 2 firms, Loda and Company and MSK and Associates, have been completed till now. We are now into our 3rd round of inspections, where we are inspecting 10 firms. So apart from Walker Chandiok, Deloitte, SRBC, PW, BSR and MSK, we have also added this year Uma Maheshwari Rao and Company, Singhi and Company, BDJ and Company LLP, and CNK and Affiliates. We hope to complete these our 3rd round of inspections by this financial year. Now let me tell you what are the focus areas of the inspections that NFRAs conduct. You know, in 2022, our inspections focused on the quality control systems of audit firms, and for the individual engagement selected, we concentrated on 3 key areas in 2022, that is revenue, trade receivables, and investments. In 2023, while we continue to examine firms' quality control processes, our file reviews shifted towards internal controls over financial reporting, specifically in relation to revenue, related party transactions, and impairment of assets. In the current inspection cycle, we are again assessing firms' quality control, but in addition, we are focusing on revenue, loans and advances, and 1 engagement-specific high-risk area for each audit selected for review. Now let me come to the utility of audit quality inspection reports for auditors. You know, audit quality inspections, such as those by NFRA, provide an independent external validation of the audit firm's performance, enabling you to strengthen your audit quality and address identified deficiencies. NFRA inspection reports offer valuable insights into compliance with independence norms, firm-wide governance, leadership, and oversight on quality of individual engagements. Progressive coverage of areas by NFRA, if seen, will enable a 360-degree view of audit firm governance. High-risk areas identified in inspections, such as revenue recognition, related party transaction verification, internal control over financial reporting testing, impairment, estimates, and judgments, which warrant priority attention in your audit procedures. Then you can do a comparative analysis. You can benchmark your audit firm's profile, the client size, industry and complexity, against inspected firms and map firm-wide quality control deficiencies such as EQCR shortfalls or documentation breaches to your audit execution, ensuring tailored remediation in your engagement procedures and remediation trends across inspection reports to identify persistent quality risks requiring systemic improvements. Now, the International Forum of Independent Audit Regulators, the IFIA, was established in 2006 in Paris. It has now 56 members, with India's NFRA being admitted in the year 2023. IFIA's mission is to serve the public interest, including investors, by enhancing audit quality oversight globally. IFIA has laid down 14 core principles for independent audit regulators. 4 of these principles that relate to audit quality inspections are shown on the slide. The Principle 8 deals with audit regulators should at a minimum conduct recurring inspections of audit firms undertaking audit of public interest entities. Principle 9 talks about audit regulators should ensure that a risk-based inspections program is in place. Principle 10 talks about audit regulators should ensure that inspection should include effective procedures for both firm-wide and audit engagement file reviews. The Principle 11 talks about audit regulators having a mechanism for reporting inspection findings to the audit firm and addressing remediation of findings with the audit firm. We as a member of IFIA keep these guiding principles in mind in focus while planning and executing audit quality inspections. Now let me, in brief, give you a few takeaways for empowering auditors. Let me briefly mention some of these potential takeaways. Number 1, independence of auditors. You can evaluate the non-audit services provided by your firm and your network to ensure compliance with independence requirements and address any potential threats to audit independence. Related party transactions. Strengthen the audit procedures for identification of related parties and transactions with them, ensuring robust procedures are in place and adequately documented. Regarding impairment of assets, enhance audit procedures for identification of impairment indicators and ensure that processes followed for measurement and recognition of impairment are sound and well evidenced. Regarding integrity of audit documentation, to ensure audit documentation is adequately evidenced and demonstrates how you challenge assumptions, reason through key areas and draw appropriate conclusions. Loans and advances establish robust procedures to verify that proceeds of loans and advances are utilized for their intended purposes with appropriate controls and documentation. Then maintenance of confidentiality. Implement measures to safeguard the confidentiality of sensitive information assessed during the audit, both during and after the engagement. Professional skepticism. Document the extent of reliance on management explanations and key assumptions. Ensure that you have raised sufficient questions and documented your evaluation process to support your conclusions. And finally, revenue recognition. Implement robust audit procedures to ensure revenue is correctly recognized in accordance with applicable accounting standards with documented evidence of your verification procedures. You know, India's capital markets have grown rapidly in scale, complexity, and global integration. Indian companies do not raise capital not only domestically, but also from foreign investors who rely on the credibility of the audited financial statements. Hence, maintaining audit quality is foundational in retaining investor confidence, market integrity, financial stability, and ensuring India's reputation as a trusted investment destination. Audit firms are central to this ecosystem, and their effectiveness directly influences audit quality outcomes. Audit firms that actively engage with inspection teams and embrace regulatory guidance are better positioned to strengthen audit quality, enhance financial reporting integrity, and reinforce stakeholders' confidence. NFRA would like to continue our discussions with audit firms in the days ahead with a common objective of enhancing the quality of financial reporting. We look forward to a continuing constructive engagement with auditors as partners with the objective of strengthening India's financial reporting ecosystem. Thank you all for giving me a patient hearing. Thank you.
Thank you so much, sir. That was engaging, insightful, and the key takeaways, how we should be ready when there is an inspection and beyond that. Now, having completed the first stage wherein we looked into strategy, then we moved on to assess the risk of material misstatement. After that, audit sampling. Now we move to third and the most critical section, which is concluding audit. We will be looking into two things. One is looking into audit results, and second, the summary of uncorrected misstatements. And for that, I request Heramba Hegde to introduce the NFRA faculties, please.
We have two speakers. C.A. Arun Kumar. He is a fellow chartered accountant with over 24 years of experience in audit, management, finance, accounting, audit regulations, and information technology. He was involved in various policy level matters at the state and national levels and held the positions in multiple committees of government. He is also a fellow member of a prestigious Shining Financial Services Leadership Fellowship of British government at King's College London. His work in NFRA includes the critical area of audit quality and other regulatory matters. Welcome you, sir. Another speaker we have Sri Shashank Jain brings a unique blend of technology, taxation, and regulatory experience. An engineering by qualification, he has over 15 years of professional experience and currently serving as an assistant manager in NFRA. He spent more than 9 years with the Income Tax Department working in assessment investigation of a tax evasion. With his strong ground level enforcement exposures and regulatory insight, he offers a valuable perspectives on the audit quality and oversight. We are delighted to have you with us. Thank you, sir. So we request you to occupy the chairs, and the dais is yours.
Am I audible? Yes. Thanks. So before I start, I request all of you to scan this QR code, because we will be having some questions on the go, and also there is a survey at the end. For that, this will help. And the customary warning that the views are 100% personal. Particularly, we are not going to give our 100% views because 51% of our executive body is here. So to be on the safer side, we will be limiting our personal views. Now, in the morning, we have seen two sessions from two important stages of audit. That is from from planning stage, we have seen the strategy. From the execution stage, we have seen the sampling procedures. Now from the conclusion stage, we will also see some examples of how do you conclude an audit. And at the outset, let me, since this is a concluding session, let me tell you why we are here today. outreach event titled Essential Habits of Effective Auditors. And what is a habit? This is a question which we try to answer through these initiatives. In the morning, your president, KSCAA president, rightly said something called internalization. When you internalize something, the audit quality factors, that improves the audit quality. And our chairman also talked to you about three ways of regulatory approach. One is an enforcement approach, second is an inspection approach, that is a combination of all these two. Now, why somebody complain with something? Our role is to enforce complaints, monitor complaints, and the question is why somebody comply with something? Why do you comply with something? It's a general question. So there are three ways to view it. One way is you comply with something because somebody enforced it. And why somebody comply when you enforce? Because you fear a punishment or you expect a reward. These are the two aspects of enforcement. You either out of fear or out of expectation of something you comply. And the moment this fear goes or that expectation goes, that compliance level comes down. Here comes our second approach, inspections. Here you comply because of something called identification. In inspections, what we do is we publish our reports. We show you the good practices and the best practices. Using this method, this outreach also, we show you the best practices, how the gap between the practice and the theory is filled. This is what we demonstrate here. And this is something called identification in psychology, where suppose your neighbor is doing something good. You also start imitating it. He is keeping his yard clean, so you also start keeping your yard clean. This is identification, and this is your opportunity to identify the best practices and discard the bad practices and start complying with the best practices. This is a second way of doing it, and these two are enforcement and this inspection, and these workshops are our role as regulators. But the most importantly, compliance will sustain only when you internalize it. Otherwise, it will go. The moment enforcement fear goes, it will go. Identification is also not long-lasting. When you find something which is more convenient, you will go behind that. But the moment you internalize something, the moment you make it part of your DNA, it will sustain. So the majority part or the most important part of compliance lies with you. It is when and only when you internalize something, all our efforts will have an impact. Otherwise, all these efforts are of no use. Now, in the coming 45 minutes or 40 minutes, we will take you through some aspects of SA 450, which is specifically on conclusion. And continuing from Kulkarniji's morning presentation, we will also take you through one aspect of evaluating misstatements, which is a continuation of sampling. Sushant will take you through some of the theoretical part, and I will take you through some of the practical examples and case studies. Next slide.
Hello. So today we will cover this SA 450. Basically, this SA 450 deals with what is the auditor's responsibility in evaluating. What is the auditor's responsibility in evaluating the misstatement? Means as the audit progresses, we may come across many misstatements. So how to deal those misstatements are covered in this SA 450. So here our objective is once we identify the misstatements, what is their effect on our audit? Do we need to reconsider the audit strategy and audit plan, or it may continue? This thing we need to keep in mind. The second thing is, once we identified the misstatement, and some misstatements remains uncorrected by the management, so in the end, what will be their effect or impact on the financial statements? Will the financial statement reliability or accuracy will get impacted or not by those incorrected statement? This is the two objective of this SA 450. Here, so what is misstatement? Misstatement in simple language, if we say, misstatement is the difference between what is there in the financial statement and what should have been there as per the applicable financial reporting framework. So what does the framework says and what is given by the management? If there is a difference, this is called a misstatement. This misstatement can happen in the amounts, it can happen in the presentation, disclosure, or classification. These four parts misstatement can happen. What is the source of the misstatement? Misstatement can arise due to error or it can arise due to the fraud. If it is arise due to the fraudulent activities, we must deal it with as per the SA 240. But if it arise due to the error, this error can happen either in the collection of the data or processing of the data while preparing the financial statements. Or this misstatement can also happen when there is a misinterpretation in the accounting standards. Or the misstatement can also happen when there is a difference in the opinion between auditor and the mismanagement. Means as per management, the accounting statements are correct, accounting estimates are correct or accounting policies are good, but auditor thinks these accounting estimates are unreasonable or applicable accounting policies are inappropriate. So because of this, misstatement can happen. And as we discussed earlier, what is uncorrected misstatement? Uncorrected misstatements are those misstatements which are remains uncorrected by the management. Means in auditor's opinion, these are the misstatements, but management thinks it will not have any material impact on the financial statements. So those misstatements are called the uncorrected misstatements. So while going through the audit stages, we may come across many misstatements. So what is our responsibility is when we come across the misstatements, we must accumulate it. And while accumulation, we must introduce some mechanism so that it can be accumulated centrally. Means since multiple team members are involved in our audit processes, once we come across the misstatements, it should be there in the centralized manner so that no misstatement can lose out. Because in the end or during the audit progresses, we have to evaluate it. So while doing the audit, we must introduce some kind of systematic collection. Because of this systematic collection only, our financial statement remains accurate. And while accumulation of the misstatement, we must ensure that whatever the clearly traceable thresholds, misstatement below the clearly traceable thresholds, we may avoid those misstatements. The clearly traceable thresholds have been already covered by the earlier session, in earlier sessions. So whatever the misstatements we have accumulated, we keep it on records. So misstatement can be of 2-3 types. First is the factual errors, factual misstatements. Factual misstatements are those misstatements which are based on some facts and cannot be disputed. Another misstatements can be categorized as a judgmental error. Judgmental error, as we say, there is a difference in the opinion between the auditor and the management. Another misstatement can be categorized as differences from the ARP. ARP is analytical review procedures. Means as per analytical procedure done by the auditor, it may come across some figures and the management has come across some figures. So there is maybe differences between those two items. Those are called the misstatements.
So there is a Slido question which you might have received on your phone right now. This is a question to understand how do you deal with a misstatement arising out of analytical review procedures. Please try to answer this question. If you are not able to get Slido, you can go to slido.com and give this code which is shown on the screen. Slido.com, just type on your browser and give this in number 2827705 so that you will get this question. Question is this: which of the following statements is true when the auditor identified a misstatement, an error, or a probable error from analytical review method? Option A is auditor obtains explanation from the client and substantiate it. Option B is they extend the substantive test for the relevant account balance or class of transactions and disclosures, or take unresolved differences to summary of uncorrected misstatement. This we will see at the end. Option D is A and B are mutually exclusive. Option E is all the above. So this is the answers which we are 25 people so have answered. Please try to answer maximum. I assume that there are close to 150 people here.
Hello. If it is not accessible, go to the slido.com and enter the code 2827705. $2827705.
Anyone want to explain this question? I think we can stop answering, but you can continue answering, but the majority is coming, ET extends substantive test for the relevant ABC or TOD. I'm asking what about why you don't want to obtain an explanation from the client beforehand and substantiate it? So you see, the answer lies slightly tricky. So when you have a difference in analytical review procedures, it not necessarily indicate a misstatement. It may or may not be. So the first thing which you will try to understand is why that difference happens. You need to go deeper into the transactions. For that, you invariably has to talk to the client and get an explanation. And if that explanation substantiates the difference, then there is no further procedures required. You can stop at that level. If it is not substantiated, that client's explanation is not satisfactory to you, and there is contradictory evidence available in the entire audit documents or available with you, then you need to extend your substantive procedures for the relevant account balance and class of transactions. So the answer here is A and B are mutually exclusive, either A or B. If A satisfies, it stops there. If not, you go to B. Now, ongoing strategy, audit strategy review. This is again a fallout from SA 450.
So far, means we have discussed about the misstatements. So now as the audit progresses, we go through execution stages and we identify some misstatements. So what is the auditor's responsibility? He should not wait till the end for evaluation. During the audit progresses also, he must assess it. In assessment, what he must do as per the SA 450 is, first he must assess the nature assessment of the misstatements. Means what is the cause of that misstatement, why it is there in the financial statement. Because if we find out the cause, it will help us to determine, is there a potential of further misstatement in the financial statements. Because the misstatement can happen because of either it can be systematic, it can be intentional, unintentional, or it can be an isolated occurrence. If it is an isolated occurrence, okay, it's fine. But if it is a systematic, means so many other misstatement can also happen if a similar situation occurs. So these cause of the misstatement is very much required for the assessment. Second is materiality monitoring. Materiality monitoring means once we identify the misstatement and it is below the materiality, but if we aggregate it and it is approaching towards the materiality, then the auditor must have a responsibility that there is a possibility that there is a greater than the acceptable lower level of risk. Means in audit planning stages, he must have set the acceptable level of risk. But if during the misstatement identification, if it is approaches toward the materiality, then auditor must reconsider its audit strategy, because sampling risk and non-sampling risk also may help us, means we miss some detection of the audit misstatement and it may breach the materiality. The third step that he has to do is additional procedures. Means once we identify the misstatement and we have informed the management and the management has corrected some of the misstatements, So once the management has corrected the misstatements, our duty does not end here. We must perform the additional procedure to identify if any further misstatement remains. So this is a three steps that we need to perform.
So now, further coming to evaluation of, now we are in a stage where we identified a misstatement. Now we are evaluating that misstatement. So the first step here is to identify the root cause. Why that misstatement happened. You need to ask all the whys. Why it happened, why it happened, why it happened. Then finally you will arrive at the root cause. Then you, in between, and you discuss with the client, find out whether it is intentional or not. If it is intentional, you take a different route. If it is unintentional, then follow the next step. Here also we have a question. In a sample testing, now this question points to another type of misstatements. In a sample testing, identified error because of using selling rate instead of buying rate in a foreign currency transaction. So this misstatement, so the previous slide, you identified the root cause, and root cause came to be the use of buying rate instead of selling rate. So this is come out of a sample test. Now what is your action? What is your subsequent action? This is a misstatement, it's a factual misstatement. It happens because of this particular reason. How you will proceed further? Please try to answer. Option A is project the error to the whole population and do the further procedures. Then option B is review similar circumstances and items. Option C is review ROMM, revise ROMM and expand the sample size or ask the client to make necessary corrections. Think carefully. Think carefully. It's a IIT grade question because you may feel that all answers are right. Okay, the issue here is there is no doubt that the client should correct it, or if he do not correct it, there are other procedures. But before that, you need to identify whether this is a systematic error or not. For that, you need to understand the similar circumstances and other items. Because the reason here is somebody applied buying rate instead of selling rate. Is it comes out of a system issue or just a random error? So that is the first checkpoint, whether it is a systematic error or not. So this takes you to another type of errors, which is called systematic errors, which is an error which is expected to occur in every similar circumstances. So in the previous example, in this example, if this is repeating in the whole population or not, it came out of your sample study, but you need to first understand whether it is repeating in the whole population, because it is all about application of a formula. It can be a systematic error. So the first checkpoint is whether to identify whether it is systematic or not, then go for the next steps. Now come to the other category of unintentional errors. So these are type of errors, it's apparently random. It's causing, it is purely unintentional. In the morning, we talked about something like somebody is correcting a lot of journal entries, going back and correcting. Those are lot of sort of intentional acts. So then, as somebody rightly pointed out in the morning, the examination of fraud angle, everything will come into picture. But unintentional errors are apparently random, it's isolated occurrences coming out of your sample testing, and then you need to project it to the total population. Once you are clear that these are apparently random errors. Now we will take a case study where the root cause factor, how do you analyze the root cause and how a root cause analysis has been done in a particular case. This is an actual case. So I'll explain this case to you, and finally you need to tell me what is the right approach. So this is a simple test of bank reconciliations. Now bank reconciliation is one of the controls which the auditor identified as preventing fraud. It's a fraud prevention control among others. And the frequency is monthly for all accounts. Invariably for all accounts, they are doing bank reconciliation. Now company has multiple accounts with several banks running into say 30 or 40 accounts. Then the auditor noted deviation in one, they did a sample testing and they noted deviation in one bank account for 1 month out of a sample of 50. So this is actually what happened. Then in the total population, when we examine further, we will also find that in the total population, bank reconciliation statement was absent for 2 consecutive months for the same bank. So one auditor identified, but actually in the total population, this was absent for 1 more month for the same bank. And also we found later that a substantial misappropriation of funds by the top management happened during this 2-month window in that particular bank. Now this is the actual scenario. Tell us where the auditor did not obviously identify this case, or he skipped this case. Why that skipping happened, or what would have been went wrong in this case? Any idea? If you've been the auditor in this situation, what you will do? What is your most important checking points here? Anyone want to attempt? So auditor missed it. Why the auditor missed it? The auditor missed that there is bank reconciliation statement absent for 1 more month, and some important transactions happened in that month, which later proved to be a fraud. What would have been the reason why the auditor missed this important thing? So here comes the root cause. When you find that there is, in 1 month, there is bank reconciliation absent for one particular bank, you need to understand the root cause. Why that happened? Is it because apparently a random thing, or is it because of a reason? And here comes the most important point. When you check a sample from a population, you need to first ascertain the completeness of the population. Here the completeness of the population is what? Number of bank accounts into 12. That's it. If you have that much of bank reconciliation statements with you, your first check is over. Then immediately at that stage itself, you will identify that there are 2 statements missing, because your population will be short by 2. That part was not done. Second, the root cause analysis. Why that happened in that particular month alone, that investigation would have prompted the auditor to see the next month also, because usually if 1 month bank reconciliation is absent, it will be addressed in the next month bank reconciliation. That is also not done. The root cause is not done, the completeness of population is not done. So the entire thing went out of the radar of the auditor. And what happened is a closure of an FD during this first month, and the FD principal amount went to someone else other than the company. Interest came to the company's bank account. So had the reconciliation been done in that month, this interest would have been come as a difference, and then, the principal would have been come as a difference, because only interest came to the account, not the principal. Obviously that question of where the principal has gone should have been come, and the fraud would have been came to the light at that month itself. It did not do. So this is a sort of, there is a very reason to believe that these 2 omissions in that month is intentional. Then the moment auditor understands that, his investigation shift into another angle, because this is called an intentional error. So this is the reason why root cause is very important. Completeness of population is very important. Now we will go to the next thing, which is quantifying the finding, projection of errors. So Here, once you have the misstatements with you, errors are to be quantified either by specific identification or projecting the samples result to the whole population. Specific identification, again, this all depends on the cause of the errors. You need to identify whether that same errors are repeated in other transactions, it's a high value transaction or not, like that. And then you specifically pinpoint the errors and find it out. Depending on your population, your procedures, etc., this will come. Projecting sample result has, again, when you have a small sample, you project it to the whole population and see what is the total projected errors, then you plan your subsequent procedures. And here, we are focusing only on this projecting sample result, one practical case today. Statistical and non-statistical methods are there. So this is a follow-up of what we saw in the morning from the audit sampling team. Projection of errors and statistical sampling. When we say in auditing, statistical sampling means, for instance, random sampling. It's a statistical sampling method. Statistical sampling method. But when you apply it to the auditing scenario, if you are not projecting your errors, not statistically, then though the method is statistical, you cannot say this, the audit procedure is statistical or the projection is statistical. That means it is considered as a non-statistical sampling procedure, though your sampling method is statistical. Then in statistical sampling method, you always give an allowance to the sampling risk. You quantify the sampling risk and project the sample. That is called statistical. Both are accepted methods. We are not trying to say one is superior to another. No, that is not the case. It is absolutely your professional judgment which one to use and which one not to use. Both will give you the same result in some case, but it is your choice, depending on the circumstances. Now we will see one example of non-statistical projection, and we will see one example for statistical projection so that we will understand the difference. Now, in this example, auditor is using the MUS, monetary unit sampling method, which is very widely used by many of the auditors. Here, the evaluation is subjective. That is why it is called non-statistical. And now, these are the examples which I take. The objective is to verify the property, plant, and equipment. Population is the total book value. That is, we are assuming it as 50 lakh for this particular example. In MUS, the total population is the total value. Now, sampling interval here, again, that comes from the statistical sampling method, 2 lakh, and they selected 25 samples for testing. Here, if you see that it is 25 into 2 lakh will give you 50 lakh, but in MUS, it is not that always it will be 25. It can be less than 25 also. That is a different topic. But for the example, I'm making it simple. So they tested 25 samples and found errors in 4 samples. So like this. In 4 instances, book value was found to be different than the audited value. The error, what I noted as error, is the difference. Book value was 10,000. There was a difference of 2,000. And the percentage of error, or the tainting percentage, is 20%. That is nothing but 2,000 by 10,000. So when you project subjectively, you directly project this error to the whole population. Here, 40,000 is the projected error for the first sample. It is nothing but the sampling interval, which is 2 lakh into the tainting percentage, 20%. So in MUS, again, you are projecting based on the sampling interval. 20% into the sampling interval will give you 40,000 projected error for the first sampling item. Like that, for the 4 items, if you add the all projected errors, you will get 3,60,000 as your total projected misstatements. Now you will check whether this is above or equal to your materiality or approaching your materiality. Then based on that, you will proceed with the further testing. If it is clearly below your performance materiality or whatever materiality thresholds, you can ignore and close the case. Now here the question is, do you have reasonable assurance to conclude about the population as a whole. The sampling is this, the sample results are this. Can you still say that the population as a whole is free from material misstatements? If you are confident, go ahead. So this is non-statistical, very simple, straightforward. Now come to statistical projection. The same example, no difference. 50 lakh, 2 lakh, 25 individual assets tested for selecting. 4 errors were found, same example. Now, this statistical projection is a 3-step process. The first step is to calculate something called the basic precision. So here, again, in statistical, we are giving an allowance for sampling risk. So now, what is basic precision? Imagine your sampling test do not reveal any errors. Still, there is a possibility that the total population is misstated, right? Because it is all about sampling. Even if there is 0 errors, there is a possibility that the population is misstatement. That is called the basic precision. If no errors were found, what is the chance or probability that the population is misstated? Here, this is again based on your confidence level or risk of incorrect assessment. You need to find out something called the risk factor. And for that, in the morning, you saw the ASCPA guide. From that, you can pick the appropriate tables. This is for specifically for monetary unit sampling. Confidence factors are given in that particular table. Now, just a question, because I just want to check whether you followed Kulkarniji properly or not. Why 37% risk of incorrect acceptance here? What would be the reason? Morning, he elaborately talked about that. Why it is 37%? Why not 5% or why not 10%? And what is the implication of this 37%? Anyone? The answer is there on the slide itself. So see, 37% is directly a fallback of your risk assessment. You assess this particular risk to be very low. If you see this table, you can see that the number of overstatement, that column row heading, risk of incorrect acceptance, 5% is the first one, where your risk ROMM is very high because you need a confidence level of 95%. Here it comes at the other end of the table, 37% and 50% means you are, that particular caption, you assessed it to be a very low risk. And this, I specifically asked this because people usually ask us, why you are focusing so much on these ROMM procedures? What is the importance for it? We are in any way doing substantive testing properly. We are doing full substantive testing. Then why you are focusing on ROMM? This is one of the reasons why we focus on ROMM. It is not because that you are not doing your work properly. You can do your work more efficiently and more accurately, and you can save a lot of time if you do a proper risk assessment at the beginning. Now, this is assessed to be a low risk item, and you will see in the next slides the difference between a low risk item and a high risk item. Now, here 37% is the risk of incorrect acceptance. Corresponding to that, the risk factor here is given in the table. It is against number of misstatement is 1. So here we are calculating the basic precision. Basic precision is what when you have no misstatement. So here the number of misstatement, we take the value against 0. And the basic precision factor is 1. You multiply it with your sampling interval, this will give you the basic precision. So this means even if you do not have any errors in the sample testing, there is a possibility that your population is misstated by 2 lakh.
Arun, just one.
Please.
Very rightly he had asked a question. It is ROM 37%. Can you recollect slide 12 of sampling table, where it actually talked about control risk and the analytical procedures. Yeah.
Is okay. Huh? So from there, this 37% or 33%, which Arun was trying to prompt you, so you determine based on that table, and then you will actually come across whether it is 5%, 10%, etc. So it is the combination of a control risk and whether your analytical review procedures give you any comfort or not. That is the whole formula behind this 37%. Yeah.
Thank you. So here if you see one more thing, see the 5% risk factor. Against that, the 5% risk of incorrect acceptance, the risk factor coming here is 3%. We have taken 1 because it is the risk of incorrect acceptance is 37. Had it been 5, we would have taken 3 and multiplied 2 lakh by 3, we will get 6 lakh. There is a difference between 2 lakh and 6 lakh, huge difference. Suppose your materiality is 5 lakh and your risk factor is 5%. For the same example, you would have been doing additional procedures because it is a high risk item. You got a high error quantification. But here it is a low risk item for the same sample testing, same population. Since your risk assessment is low, you got a lower basic precision, which is 2 lakh. So this is how it affects your audit procedures. Now you can stop at this stage if there is no sampling errors because your basic precision is also coming below your materiality. This is how it saves a lot of efficiency, or it brings in a lot of efficiency to your audit work. Now, this is the first step, you calculate the basic precision. The second step is calculate something called incremental allowance. Now, we have seen we had 4 errors. For each errors, you need to calculate something called incremental allowance. For that, you need to find out something called incremental factor. Again, comes from the same table. Incremental factor is nothing, but for each identified error, you need to find out what is the incremental confidence, incremental factor. Here the factor for 0 misstatement was 1. The factor for first misstatement is 2.14. So the incremental factor, when you have 1 misstatement, 0 to 1 is 2.14 minus 1. It is 1.14. For the first misstatement, you got an increment factor as 1.14 by simply deducting 2.1 from 2.14. So the basic principle behind this incremental factor is that the moment you identify a misstatement, the probability that the population is misstated is increasing. The moment you identify 2 misstatements, again it is increasing. So now, more the number of misstatements, the probability that your population misstatement is high, it is going high. That is why this incremental factor is given, and the incremental incremental allowance is calculated and built into your formula. So for each misstatement, we will find the incremental factor from the same table, incrementally going down the line, and then multiply it with the projected error, which we already projected in the other table. 360,000, you remember, you non-statistically projected. Multiply it with the incremental factor, then you will get the projected factor. Sum it up, then you will get the total incremental allowance. Now you got 2 values, basic precision and the incremental allowance. The third step is calculate the upper limit of misstatements, nothing but add these 2 things together, 360,000, 2 lakh plus 42,000 is what we calculated from here. It is nothing but difference between 360 and 402. So add all these together, you will get 6 lakh plus. This is your projected misstatement in a statistical method. In non-statistical, we found it to be 360 for the same population, same sample testing, same result, but in statistical, it is slightly increasing to 6 lakh. Now, depending on your materiality, again, you will do the procedures. And here, this is a statistically defensible formula. Even if something goes wrong at the later stage, suppose something is missed out, but the auditor is safe. Now again, we will go back to SA 450, evaluating uncorrected misstatement. This will take us to another practical example of summary of uncorrected misstatements.
So far, we have identified the misstatement, we have categorized them, we have assessed the root cause behind that misstatement. Now we have reached the final stage where management has corrected some of the misstatement. Now some misstatement still remains, which we call it as uncorrected misstatements. So once we reach up to this stage, the foremost important step that we must take is reassess the materiality. Because the materiality that we initially determined at the audit planning stage is based on our budgeted financial statement or our expected financial statement. But once we reach up to this stage, that means we have already actual financial results in our hand. And based on that actual financial results, what is the materiality? So based on that new materiality, we will evaluate our uncorrected misstatement. So this is the first step that we need to do. Now we need to assess each misstatement one by one, and we see whether it is having a material effect on the financial statement as a whole, as an individual, or as an aggregate. So while doing this, making this determination, we must perform two steps. First step is identify size and nature analysis, and second is prior period effect. In size and nature analysis, what we need to do is not only as a financial statement as a whole, we must see the misstatement, we also see the misstatement effect on the relevant classes of transaction, account balances, or disclosure. As a financial statement also we need to see as a whole, but a particular class of transaction, what is having its effect, that also we must see. Whether that any materiality, if we determine for that particular class of transaction, has been exceeded or not, that also we must see. Second aspect is nature analysis. Nature analysis means we have done the quantitative aspect of the misstatement. We must also focus on the qualitative aspect of the misstatement. Whether because of that misstatement any key ratios are getting changed, means it's possible on quantitative basis it is not crossing the materiality, but due to its specific nature, it is having a significant impact on the key ratios, or any covenants are getting breached. So this nature analysis also we must do. And the third step that we need to do is what is their circumstances of their occurrence. Means in what circumstances this misstatement occurred. Whether because of this misstatements any regulatory compliances are getting affected, or it is having any effect on the management compensation, or any particular party only having a misstatements, that party may be related party also. So what is the circumstances of their occurrence, that also we must see. Second step that we need to see is prior period effects. Sometimes we forget about the prior period. It is possible that in the previous year we've identified some statement and that are not having any materiality effect on the financial statement. But in the current year, we must also take into consideration about those prior period effects. What are the misstatements that remain uncorrected in the last year? We must also take into account this year also, whether in combined they are having any materiality effect on our financial statement. That steps also, how to do it, we will discuss in the next slides. So now in the another steps on the evaluation of uncorrected statement, once we analyze each misstatement individually and aggregate, we must write it to the management. Whether what is the misstatement that have been remained uncorrected so far, what is the effect on their financial statement, and whether it may affect our opinion also. So that letter we must write to the management and ask them to correct it. If they correct it, it's okay. If they do not correct it, we must get a written representation from the management. Why do they think this is not having a materiality effect? So that management letter we must have in our documents. And in final documentation, for documentation purpose, we must include what our misstatement that we have identified, whether corrected or uncorrected. We must include those misstatements, what is their effect on the financial statement, and what is the management says about those uncorrected statements. That must be part of our documentation. Thank you.
So finally, we are coming to the summary of uncorrected misstatements. This is again coming directly out of SA 450, where it says all your uncorrected misstatements. Client may correct something, may not correct something. It should be accumulated and finally evaluated for your materiality and all those things. It need to invariably should consider current year impact as well as previous year impact. I'm going a little bit faster. It also should consider what is the impact on the various captions and is it poses a fraud risk or not. And this is, many people call it different names. Some call it SAD, Summary of Audit Differences. Some call it Summary of Uncorrected Misstatements. Some call it Summary of Misstatements. We would like to call it Summary of Misstatements. And this is just a template, a very simplified template, how you can present this Summary of Uncorrected Misstatements. Here you can see columns for description of the misstatement, and whether it is coming out of a factual error or judgmental error or analytical error, then what are the impact on various captions, debit and credit impacts, then which are all the captions as affected. Most importantly, reason for not correcting, why the management choose not to correct it. Then the implications. Here comes your overall analysis. Now you accumulate all these errors together, analyze for any fraud risk, analyze for all the implications, analyze for the control evaluations. If something is required to do more, do that, and then finally you can conclude. And here the second part of it, why we call it summary of misstatements, because we would try to include the corrected misstatements also. Some misstatements may point to more deeper issues like internal control issues. So here the misstatements which are corrected, which is coming in the second part of this documentation. Then finally, the third part is your evaluation. Here you will ask all the pertinent question, prior period audit misstatements considered or not. Why prior period is important, I'll take you in the next slide. Then implication of current control testing, if any implication is there. Again, separate work papers will come for all this. These are just conclusions. Then implication of your audit opinion. So in this particular example, these misstatements were found to be having impact on deficiencies or material weakness in controls. So ICFR is modified. And then finally, your conclusion statement and sign off. Now, why past errors still matter? Because we see this summary of audit misstatement in many audit files only covers the current year misstatements. In this particular example, I have taken a very simple case where the previous year materiality threshold was 10,000 and PPE was understated by 5,000 at the year end. So it is below materiality, it is ignored, and client did not correct it. In the current year also, you found another error. This time materiality is 12,000, but the audit difference is 10,000 understatement in PPE. And the net effect is 15,000 misstatement current year, because this is a carry forward item. So the net effect is 15,000 misstatement, which is above your materiality. That is why these prior period items become important. Now the final, you come to the conclusion, after all evaluation, if the aggregate differences are not material, quantitatively and qualitatively, the conclusions statement explains this judgment based on all relevant factors, and you accept it, close it. If there are material issues, then again it takes a different route. Now there is a simple case study. Do we have time, or we'll skip this? 5 minutes. So this is a case where two auditors treated the same issue in two different ways. Company A, auditor A, and company B, auditor B. Same situation, actual case, practical case. So in first case, a whistleblower complaint alleged some fraud in loans. And in the second case, instead of a whistleblower, a joint auditor alleged fraud in loans. In the first case, auditor examined the matter, called for all the details and action taken by the management. Auditor examined it. In the second case, there was a continuing auditor or another auditor. He makes no communications, no additional details asked for, no communication with the management or TCWG, and he just wait. In the first case, auditor writes to the board and audit committee for independent forensic audit. In the second case, the board or TCWG asked the auditor to do that work. Then in the first case, it was a qualified opinion even after all these efforts. In the second case, it was an unmodified opinion with a specific remark that there is no fraud in the company after investigation by the auditor. Now, from this thing, do you have any comments to make from these two cases? How do you see this particular case? Whether the first auditor was right in qualifying this audit report, or in second case, whether the second auditor was right in issuing this unmodified audit opinion? What is your take? Quickly, please. If you feel that the first auditor was right, then you should tell me why he issued a qualified opinion. Anyone, please? So since no one is forthcoming, again I will attempt to make an answer. Please, sir. Thanks.
This is again an example from a branch audit where we found in our audit report 8 accounts which had a problem. We gave a qualified report. Next year's branch auditor came, gave unqualified report. So who's right?
Okay, so I'll take that question personally later. Let me explain this now. So in this case, the first auditor issued a qualified opinion because of an important provision in our standards which says if you are unable to obtain sufficient appropriate audit evidence, you need to qualify or issue an adverse opinion. This is coming directly from SA 330. In this case, the management commissioned an inquiry, but that inquiry was not complete. And there were a lot of loose ends remaining in that inquiry. So the auditor decided that I don't have sufficient evidence to conclude that the particular loan item is true and fair. So he qualified. In the second case, the auditor himself conducted an inquiry. Then management, given that finding in the inquiry as a disclosure note, he came back and audited that finding and issued an unmodified opinion. I have no comments on that. It is already on NFRA website. You can read that order. Now, first thing is acceptable, second is not acceptable. Now I am skipping this one because of time. And that is it. Any questions specifically on this one? Thank you. Thanks for the patient listening. And thanks to KSCAA for giving this opportunity to stand before you for the second time.
Hello. I have one question on the previous slide where 10,000 example you have taken.
This one?
No. The prior period impact, why it is important. So here the first one I'll keep it same, but second, if I'm doing a quarterly review and my quarterly materiality is only 2,500. So year end we agreed, okay, it is below my materiality and we have taken to SUID, summary of unadjusted. But when it came to quarter one, then the discussion with management becomes difficult. Okay, year end we have taken to unadjusted, but quarterly you are saying it is above your materiality and you want to modify your opinion. So how do we deal with this kind of situations?
So in the first quarter or irrespective of the first quarter or last quarter, that caption is materially misstated or not. That is your whole testing, right? The previous year it was misstated, but not materially.
Right.
In the first quarter also you identified a new misstatement.
No, same misstatement, which is carry forward.
No, it's not the same misstatement we are talking about. If that is, again, your quarterly materiality would be different from your final materiality. Changes. So depending on your materiality, you always take a call. There is no issues in that. Because previous year it was material at not material at the closing. This year also in the quarter, if it is not material, you can go ahead.
Yeah.
Vijayama sir, do you have any other view in this one, please? Thank you. So, shall we close? Yeah, thanks.
Thank you, sir. Sir, we request you to be on the dais. Thank you. Thank you, sir, for enlightening us on the misstatement and sample testing with the real-time questioning using the technology. I request CA Prabhava Hegde, Chairman of AI and Technology Committee, to present a memento to CA Arun Kumar. And I request CA Vishant BL, Treasurer, to present a memento to Sri Sushant Jain.
Thank you, sir. We will break for the tea now, for quick 10 minutes break, and we'll reassemble back at 3:25 sharp. A quick means quick.
government company and an author of several authoritative books on IFRS, Ind AS, and key audit matters. He combines a deep technical expertise with practical insight. His balanced perspective makes him ideally suited to moderate this panel on raising the bar in audit quality. Let us begin with the standard setting perspective. CA MP Vijay Kumar, a member IFRS Interpretation Committee. CA MP Vijay Kumar has been a forefront of shaping accounting and reporting standards in India and globally. A member of a IFRS Interpretation Committee of the IASB with over 30 years of experience as a CFO and director. He has contributed extensively to ICAI, NACAS and SEBI committees. His insights helps connect high-quality standards with high-quality audits and transparent financial reporting. A CA Archana Bhutani, expert faculty, is a distinguished audit and technical advisory professional with over 23 years of experience at BSN Company. She is specialized in complex accounting, auditing standards, and corporate law, and is widely respected for her thought leadership and mentoring. Her work focuses on strengthening audit quality through a sound professional judgments and meaningful regulatory engagement. Finally, the industry perspective. A CA Ravi Anantaramayya brings a crucial user of audit perspective with over 28 years of global finance leadership and currently serving as a global controller at Wipro Enterprises. He oversees the financial operations across more than 20 countries. His experience highlights what industry truly expects from audits: credibility, robust governance, and confidence in financial reporting. With this diverse perspective, now I request all the panelists and the moderator to occupy the dais. Let us start the panel discussion. Mohan sir, it's over to you.
So good evening, and we know that we are in the final, though not a technical session, but final panel discussion. One small correction I had to make: Archana is not from BSR; she's from Deloitte. So I needed to correct that before I start. Very happy to be here. Thanks to KSCAA for here and for this discussion on raising the bar on audit quality. I could not have probably got, my job is very easy, just ask the questions. I could not have got a better panel of people. I'll start with MPV. Needs no introduction to anybody here, right? About a week or 10 days back, I messaged him and asked him, we're doing this, can you come? And his response was, I'll be in Singapore, but I'll ensure that I'm there. So he came in last night from Singapore. And morning, he attended a meeting, and then he's here. So thank you, thanks a lot. Archana, of course, known her for a very long time now. We've been discussing so many things on. She comes from Deloitte in Delhi, and she was also very happy to be here. She comes with a lot of perspective on audits, major audits. She's also been doing some work with the NFRA also for quite some time. So thank you, Archana. And today in this room, we have got regulators, we've got chartered accountants, we've got stalwarts like MPV. We have only one person from industry. That is Ravi. Yeah, MPV also double up as an industry person, right? And we also need to give a round of applause to the chairperson who's been here throughout. He's been here throughout the session hearing and all we have to say. So I know we are a bit short of time, so I'll quickly start with a common question to everybody. I'll start with MPV, of course. if you just take a pause today and look at audit quality, and where are we in terms of audit quality today as we speak today? And what do you think we should do going forward? It's a very quick, two questions.
Okay. So good evening to all, and extremely happy to be here. On behalf of the profession, thanks to NFRA Chair and NFRA Senior Management for participating and hosting this jointly with KSCAA. So as far as the present audit quality is concerned, this is completely my personal view, just like all the NFRA gentlemen have said. And I think I need to put it in perspective. As far as quality is concerned, it is more to do with the experience. You can't measure it, you can't measure it like you are 98.5, 99. It's not an SLA kind of a thing, 3 nines, 4 nines, 5 9 SLA. It's not something like that. So it is, quality is something which is to be experienced, like a photograph, you see it and you feel it's good, not good. It's taken nicely, not taken nicely. So you need to make that kind of a judgment. We need to pass an opinion on the status of audit quality, looking at all the macro factors which are there, which are equally important for how audit quality happens. You can't do a very qualitative job in isolation of the macroeconomic environment. You need to take all those factors and all. So my journey of 3 days, I think particularly the last decade, the quality of audit has only been getting better year on year. I don't see a concern where, so I'm not seeing a concern where there is a deterioration, where people are less objective, people are not independent. I'm not seeing those things. Whether it is the senior audit practitioners or the younger lot who have chosen audit as an area of practice, they're all taking up audit on a very serious note. They are committed to deliver quality. There is this external environment and certain other limitations in terms of how the information flows, accuracy of information, the ability to understand the business environment, etc. There are some limitations. Park all of those aside. I think it is heartening as a nation, which is developing. In developing, I would still say that we are probably at the lower end of the developing. We are not at the top end of the developing state. We are in the lower end of developing. I think the audit quality has only been getting better year on year. And as long as the profession and the industry, very important industry also. In fact, why I am saying the quality is getting better, credit is not only to the audit professionals. Credit is also to the entrepreneurs and the businessmen, whether it is the second generation or third generation who are pretty much more educated, more evolved, seeing the outside world, or the new entrepreneurs who are coming and toiling to build wealth. All of them are also expecting good audit quality. They are also collaborating. There will always be 10-20% of black sheep. We have to admit that. But question is, together as a nation, is the good substantially greater than the bad? Is it substantially higher than the bad? I think that's the way we need to measure. And I think that positivity certainly exists. We should just do whatever it takes for the good to grow much more than what it is now. That's my view on current status of audit quality. I'm not too sure if that is your experience, but it's my experience of the entities I see, my experience of being in the institute, the disciplinary cases which I've seen. That's my assessment of what is there. The second question is going forward, what needs to be done? Going forward from audit point of view, you may not like my answer, you may not give that same applause which you gave me for the previous one, but still I need to say this. for audit function to be done or audit quality to be done, it's very important that as practicing members, we need to acknowledge that audit is a scale job. It's a job of scale. You can't be a boutique firm, niche firm, and say that I'll be in audit. Audit, you can do it only if you're doing it on scale, because the audit calls for investments which are substantial, whether it is investments in terms of people, technology, process, SQC, whatever it is, there is substantial amount of investments to be done. If those investments have to be monetized, you need to do it with scale. You can't have a SQC1 implemented in your firm, and I'm talking about public interest entities. I'm not talking about audit of private limited. I'm not talking about the audit of 18 lakh companies in MCA. I'm talking about public interest entities, listed companies, and companies with net worth above 500 crores or 250 crores, the public interest entities. I'm not talking about companies which are just formed for holding a family asset. Exclude all of those stuff. I'm just focusing on public interest entities. For these public interest entities, if you want to do audit, if you want to have a separate engagement team, engagement partner, review partner, and ensure that there is domain knowledge. If I'm doing an NBFC audit, I require deep domain knowledge. Without that, I can't do it. Mutual fund, if I do audit, I require deep domain knowledge. All of those require investments, and you have to monetize it across multiple audits in that sector and across your overall audit function. Only then it will succeed. And it is a minimum 15-20 year game. You can't say that I'll be in audit profession and make reasonable net income in 3 years, 5 years and all. It's just not going to happen. It is a scale game, is my very strong view. And only if you do it at scale, even the client will get quality. Even the client will get quality only if you do it at scale and you're doing the right kind of investments. That's my thoughts on these first two questions.
Thank you, Anthony. Thank you.
You can still clap if you want to.
So, Archana, same question to you. Just to sort of give you a perspective. Many of the people in this audience, small and medium practitioners, apart from large firms also. Where do you think we are and what do you think we should do going forward?
I should add one thing. I've known Archana for a little over 20 years. So some of you, if you think she's a young practitioner and all, please don't think so. She has equal 30 years of experience in the audit and accounting.
I think on where we are, I'll not, in the interest of time, not repeat. I totally agree with MPV. I think the quality is, it is something that you experience. I would say it's an intangible, but it's an intangible now, which we're now trying to recognize just like any other on the balance sheet. Yeah, so now we're trying to measure it through the AQMMs and so on. But yeah, totally agree on that. I think what I wanted to focus on was more in terms of where the focus in terms of audit quality needs to be. We are, I mean, obviously we all are experiencing it. We're living in a disrupted world. You're looking at evolving business models. There's geopolitical uncertainty. You look at digital transformation, even, the emerging risks like cybersecurity and so on. So when you put all of this together, actually audit quality is no longer just a technical aspiration. It is now something which is required, it's a societal expectation. So in the morning I was reading a speech by the PCOB chair, and if I can just read out he said, like a sentinel standing watch, the financial statement auditor is indispensable to the capital markets. So I think that just kind of underscores the relevance that we have. And also, while we may have done well till so far, I think audit quality is something which is a continuing journey. It requires a high quality audit. Continuing to do that requires significant attention and investment. Now, when we talk about high quality audits and how do we raise the bar, etc., each player in this ecosystem will need to do its bit. The industry is here, so I'm not going to say what the industry needs to do, but if I look at the other aspects or the other players of the ecosystem, first if I was to look at this, the regulator, individual. And of course, then, like I said, the management and the audit committees. Now, from a regulator perspective, and I'm taking the benefit of NFRA being here today, I think we're looking at a strong, unified, proactive regulation. And that would obviously require that there is, unified regulation, there is focus on convergence, I mean, if you have regulatory clarity, you would generally see it's easier for practitioners to make the required investment. And also, apart from, like I said, the three elements, I would say convergence, unified, and the third I would put focus on is on proactive support, rather than just a reactive punishment. So if I look at the recent years, I think NFRA has been doing that in terms of playing that proactive support. You look at this workshop, you look at the circulars, etc., which are coming out, they do provide even the inspections. I feel the inspections are also a way wherein you do get their inputs, from a best practice perspective as well. There is focus on the way we see as a practitioner, the way we see is that there is proactive regulatory support. There is focus on behavior-based oversight. And when you look at the discussion also that we had today on professional skepticism, on judgment, all of these put together, I think that's going in the right direction, and we will need to kind of continue this momentum. From a firm perspective, I think you need focus on a strong system of quality control, ethics and integrity. You also need, to see what the emerging challenges and opportunities are. So if I look at today, all said and done, one of the main or the rising opportunities and challenge is AI itself. So how are we dealing with it? It comes with its pros and cons. How do we kind of leverage that? And third, when I look at it from the perspective of maybe the engagement team or the individual practitioner, their role in terms of audit quality comes by focus on timely direction, supervision, and review. Again, focus on professional skepticism, focus on making sure that they have the right time, they give the right time and resources for the engagement. And of course, I can't forget what we discussed today in the first half is understanding of the business processes and operations. I think all of these require their attention to make sure that we're able to execute a high quality audit. And therefore, if I was to say, going forward, what is needed with all of these things happening, there is a need for agility. There is a need to be able to adapt and be nimble and adapt to the changes, but I would say with responsibility. So especially, for example, with AI, you need to kind of embrace it, but in a responsible way. So that's where I would see the focus areas to be.
Thank you. Ravi sir, you've been dealing with a lot of auditors over the last so many years, different types of auditors. Are they asking more questions? Are they asking more fees? What is happening?
I think...
no, you can forget the fees.
Absolutely. I think thanks, Mohan, for this question, and thanks a lot for NFRA as well as for the Karnataka State CA Association for inviting me again second time for this event. Very learning and very, I think, interactive, kind of an experience I have here, I take from here. And I think we live in the UCA world, which is running at 10x speed today. So I think you are asking about the changes, right? I think if I were to levitate a bit and then have a look at it, change is the only thing that is constant, and the rest all is temporary at this point in time when we look at it. Look at what's happening, at least from an industry point of view. I think while I resonate quite a bit with whatever the the audit practitioners are saying, you look at the world, what is happening today. The wars are already looming. Tariffs are happening. And if you look into the manufacturing sector, if you look into the service sector, you do not know when that Hire Act will come into picture there, causing uncertainties there. Right? You look into the regulations, in a spate of around last 4 months, you had a major GST changes, you had labor codes which were lying for 5 years coming and hitting us, and then you have opening up of the nuclear sector, as well as the FDI coming into 100% in the insurance. I mean, the speed at which we are moving is mind-boggling, and especially from the industry side, we really need to grapple with it and then give a view to the our leaders here as to, hey, where are we? The tariff got changed from, say, 25% to 10% to another 25% to 50% in a span of 4 months. And there were two, periods in which we had to report our, impact there on that. How do you really take a view on that? At least thankfully for the labor code, at least there is a FAQ that has come, which is clarifying how do you really account it. But, these are the things that we really need to take a view on that. So are all of us able to really invest time into it and then, in fact, as well, form an opinion on this? I hope, my take on that saying that probably, there are 3 areas where people need to work from my perspective. One is definitely the mindset need to really get tuned to this. Mindset in the sense that as an audit profession, how do I add value to the business here? I am getting a tremendous value. I think, to be very frank, with the team that I work with, smaller audit firms or the bigger audit firms, because auditors have also a very vantage position of being objective, right? Not really involved. How really continue that objectivity and frame an opinion. I think this is the mindset shift that need to happen. The second one is the tool set. What is the tool set that we are using today? I mean, the old, world playbook, will really not work. I mean, are we really, the data is the oil of the new economy, has been told for last, so many years. Are we really able to use the data today? Because everybody has moved. In fact, the regulators, the government, everyone has made everything digitized, right? Without that, we wouldn't have been digitized, digital economy. So with that, are we really able to, really proactively use the data, proactively use the analytics? Similarly, when it comes to, the frameworks, are we really, this is again another tool for us. Are we really looking into the frameworks, like, into taking into the consideration while performing the audit? I think NFRA has done a human service by, publishing the audit committee interaction series. It's a wonderful learning experience for us to go through that. It's, just take that and then, and then you will be able to learn on the complicated standards, how do you really apply on that? And the third thing that I would say is that the skill set. I think the panelists already talked about it. The skill set also need to change and align. How do we really make use of the AI? AI doesn't seem to be a bubble, at least as yet. I think everybody's talking, the fact that everybody's talking about it as a bubble itself shows that, there is already, it's not a bubble. So I think, how do you really make use of it, in terms of our own, audit profession? That need to happen. How do we really make use of it in terms of not only the AI, even the frameworks, to enable and to be effective in the audit is something which we really need to, be much more, rigorous in terms of adaptation. And I think with this kind of sessions which are happening, I think there is another saying that goes there. I think a wise man actually, points out at the moon, but not so wise, look at the finger. But, these kind of gatherings and these kind of, I think events really, ensure that all of us look at the moon and not at the finger. I think, that's how, I feel about it.
Thank you, Ravi. Okay, so I think generally the consensus seems to be that audit quality has improved. Can we? Improving. I'll just take one quick vote from the third umpire. You agree, sir? No. So third umpire has not agreed. Okay. I will go back to MPP because Ravi just touched upon this topic, and I think there's no better person than MPP to talk about this because he is on audit committees of many companies, including recently Mahindra and Mahindra. And I think the NFRA has given this set of questions which the audit committee should ask the auditor. And he's in a position wherein he can actually tell us what do you think actually should be done in terms of this. I mean, we have a lot of content on that. Is this actually happening on the ground, or how do you think we should react to that? Or is there any, 4 or 5 points you can give the auditors the way they should probably talk to the auditor?
No, actually, it's been getting better. See, my experience of journey, it's been getting better. But one point I want to caution is the kind of boards I am in versus the other boards. I don't have that expression. So I need to look at the organizations where I have not had any such governance challenges or any issues which you come across. You are able to implement the best practices. So other organizations, I will have a lesser understanding. Is post NFRA giving these circulars and asking the auditors to present it to the audit committee and take it on record in the audit committee that it has been presented. I think it has helped a significant amount of awareness, and even the other directors in audit committee are spending a little more time than in the past on the various matters which are being brought to the attention. My view as far as audit committees are concerned, there are broadly three things which we have to look at. It's my experience, the way I have been going about. One is we have what we call as the pre-audit committee meetings which are there, no sitting fees for that. So pre-audit committee meetings which are there. And as audit committee chairman, more importantly because of your own reputational risk and the fact that you want to do well, you need to spend that 1 day of time every quarter additionally, 1 day of time minimum, interacting with the management, interacting with statutory auditors, interacting with the internal auditors, so that you get a good sense of the entire process which has gone through for financial reporting, so that other members of the board, they're actually looking at your understanding. While they have equal responsibility, they generally look at the chair as to whether the chair has actually spent time and has got that understanding. So that's one practice which has evolved over time. It's almost become a mandatory one. The second practice is there is a meeting independently with the auditors without the management and the other non-executive directors. So even in the PSU companies I have been able to implement that. So even though this is not mandatory, so you give time to the auditors to express themselves. I've seen first 2-3 meetings, they don't tell because they're not sure whether what they tell we will go back to the management and people will read and all. But over time when you build confidence and they know that we have the ability to filter and handle it with management properly, they are opening up their voice and saying that here is a case where probably IT control has to be strengthened. Here is a case where the quality of people involved in the controllership function is not so good, you have to do it. These are 1 or 2 subsidiaries or associates where impairment you have to be little careful. People are opening up. So that's the second set of meetings which are helping. That's the second one. The third element which I have done is I have segregated audit committee for financial statements approval and audit committee meetings for all the remaining items. So typically tendency is to have one audit committee where all the items are taken up, whether it is related party, whistleblower, this approval, that approval, and financial statements. And financial statements, many places what they do is, they combine it with the board. They do it a joint meeting. And in that joint meeting, there's very limited talk. You start comparing with the budget. So what I have done is, I've said even though it is cost, and when I join a board, that's a pre-negotiated item which I negotiate. It is 2 audit committee meetings, 1 audit committee previous day, where you take up all the other items, whether it's the internal audit report or whether it is related party, and there are so many LODR requirements where audit committee needs to approve. Take those items on one particular day. The second day, do an audit committee for financial statements, and this audit committee discussion on financial statements should not become operational in terms of comparison with budget. Why are you 84%? Why are you this percent and all? It is focused more on understanding sequential variance which is there, year-on-year variance, and whatever accounting practice policies, whether they have been applied correctly, etc. So the discussion is only on that. The budget-related comparison, that becomes an agenda for the board meeting, not for the audit committee. So I don't allow that to happen in the audit committee, that goes. So if the 4 audit committee members have to listen once more, they listen. So it's a pain, but you have to go through that pain. Otherwise, in audit committee, you lose the focus on the accounting aspects. So accounting normally at the audit committee, you don't do substantial one, you basically do analytical kind of a thing. So last quarter this, look at line items, look at the various information available and try to ask relevant questions. So these are three things which I have been able to do in organizations where I've been there over a period. It's not like the day I joined I did this, I did it over a period of time. And credit to those managements and promoters that they have also accepted these procedures over time. That's part one. Second is in the audit committee on financial statements when you do, I think questioning around accounting policies compliance, audit team composition. We agree on some audit quality indicators in terms of the profile of the people who will be involved in it. You are paying for it. Ultimately, you are paying for it. You should ensure that the right kind of people are there. And one standard question I ask is, how many engagement partner hours have been spent? How many hours have you been there? And I corroborate it, I cross-check it with the management separately. So for me, that engagement partner's time is very important. I don't want, rest of the team is important, but unless the engagement partner brings his wisdom and spends time there, I'm ready to pay extra fee, but I don't want to compromise the quality of audit because there's so many people relying on these financial statements. So these are some aspects which I have done it. There's a long list, but I think for now this should do.
Segregating the segregating the financial statements discussion and the other things in the audit committee is really a good takeaway which you've got. Very progressive measures, absolutely, sir. Absolutely, sir.
The other thing I still the NFRA chairman over lunch. See what's happened around COVID, everybody has got used to these VC meetings, radio meetings.
Even Hyderabad.
And all the entities I'm there, I have literally persuaded them with lot of perseverance that it has to be only in-person meetings, even if it is 2-hour meetings. In fact, for example, every year we have meeting with rating agencies and all. Rating agencies come and interact. So all those only in-person because in an in-person meeting, the chairman's ability to understand what's happening, even from those who don't speak at the meeting, that skill set helps a lot. That's extremely important. Those who speak, communicate. Those who don't speak, also communicate. Those who don't speak, communicate through their body language, their eyes, their spontaneous reaction when an item comes up. All of those are extremely important. So, in fact, I was telling him that at some point in time, while VC is good, at least in director's report, we should have a small table to say that attended in person, attended on VC. So that it's an external force to reduce the VC meetings. VC meetings have to come down because audit, like in Indigo pilot's cabin, it says flying is a serious profession. Audit, whether it is auditor or audit committee, is a serious one. You can't take it lightly, saying that network is not working, I got disconnected, it actually distracts the whole audit committee once. Very disrespectful to the shareholders. Forget about disrespectful to the chair and the people present. Disrespect shareholders because shareholders have appointed you with responsibility. So I encourage only in-person meetings. In fact, I've come across, don't mistake me, I've come across a few auditors also who tell, sir, I have one more meeting, can I join on VC? Sorry, you have to be there in person. I have not encouraged that as well. Of course, there'll be exceptions, but they're rare and not routine.
Okay, so yes. So Archana, I'll come back to you now and so quality is always technology, and morning we had requests saying that there should be a tool developed by NFRA or KSCAA, which is not going to happen, we know. But what do you think about technology, especially for the small and medium enterprises? Is it something, I mean, obviously they have to do something on technology, but what are your best suggestions on this technology for audit quality?
So I think, like I said, it seems to be one of, when you look at technology, It's one of the biggest challenges as well as an opportunity. And there is a report by the World Economic Forum on future, I think it's called the future of jobs. And there, if you see, it says that audit and accounting professionals is where they actually expect a decline. Now, on one side, you're going to have a decline in terms of the number of professionals, but on the other side, areas where assurance and this focus on quality and the need for assurance is increasing. So it's quite a balance, and that is where I think technology also comes in, because not just, there are two aspects to it. One is the efficiency, and through the efficiency also how you leverage it for the audit quality both. So again, when you look at technology, because I understand we're looking at all levels of companies and what may suit one may not suit the other, but there are three levels, at least for me, as a layman, I was trying to understand for myself, is like you can do a basic data analytics. I think that can be generally applied. Then you've got the Gen AI, and then you've got the agentic AI, right? Now each has its own benefits, and some of the places, like we're also trying to see how can you, it's like I said, there is a need for building efficiency and kind of even using technology to see, can there be, wherever there could be lapses, or I won't say lapses, there can be gaps, or how can you even minimize those biases or gaps. So it's a continuous process, right? And therefore, technology as well as methodology will go hand in hand. So just to take, for example, some of the practices that we're just trying to see how we can kind of leverage technology. So one is in terms of the methodology itself, it's a continuous improvement process. So let's say we've been discussing risk of misstatements in the morning. Now let's say you've got, in a large audit, let's say you've got one person doing understanding of the business, then you've got another person looking at fraud risk, and you've got a third person doing, let's say, the actual account balances testing. Now, if these are three different people, and the way the risk is being considered by them, what if there is a gap, right? How do you ensure there has been, the risk has been consistently considered by all three? So if you do, when the work is kind of not really connected in the sense of an automation connection, while of course you'll have other ways to kind of through review process to make sure it all ties up, I think if there can be something which can throw up a check, nothing like it. So for example, now we're trying to see, you kind of combine the understanding of business and fraud risk, and the system will ensure that if risk has been identified, let's say a fraud risk relating to, we discussed revenue, let's say fraud risk relating to revenue was identified, it will automatically get mapped into the account balance. So the person who's testing the account balance will not be able to miss it. So automatically that risk kind of goes and sits in the account balance testing. So this is where you ab initio trying to kind of identify the risk. And there could be, same, going forward, there could be additional situations. Let's say, we also, I think when we were discussing, we said it's an iterative process. You kind of keep on reviewing it and so on. So let's say based on further, as in when you're progressing into audit, you identify another risk, or let's say not another risk, but you've identified an additional procedure to be done. So like I said, there should not be a gap. Now the person who will, the engagement team member who's going to identify, let's say, an additional procedure or an additional risk, it will automatically move into the account balance procedures to be. So these are ways wherein you can leverage it to make sure from a technology level, but there should be at least, practitioners can consider how they can, or what checks and balances they can put in place to cover these kind of situations as well. So that is one, like I said. The other is we're making sure that before independence is really signed off, you're not even able to start work in your audit file, so that's the kind of importance and the check that you can, that way you ensure that discipline as far as independence testing is concerned. And we've been talking about risk assessment. Again, you can use technology for guided risk assessment. We've been talking about the geopolitical situation. We had the Venezuela situation recently. There could be implications on the oil prices, etc., depending upon which sector you're in. I think this guided risk assessment also helps you identify and will populate some of the risk factors, which may otherwise, if you leave it to human judgment, may get kind of missed. So it kind of, the focus is on consistency. So that the quality of audit is the same irrespective of who's performing and which is the audit client. So that is where it comes in. I think there is a lot of scope. If you were to just have a discussion today and kind of take ideas how to use technology, you'll get, I don't know how many ideas. And right now also, for example, we've just recently finalized some and still work is going on. Just in terms of the ideas where you can use these tools. So for example, regulatory compliance testing is a big issue. So when you're reporting in CARO, for example, you've got to report on whether PF, ESI dues, statutory dues have been paid. Now, if you can have a system wherein, which will, you put in the data will do all the testing in terms of, looking at the payment receipts, etc., and then generate an exception report. So that is also doable. So that kind of, brings in efficiency. As well as, like I said, minimizes any, chances of not catching any exception. There's scope for that. Some of the interesting uses of technology, if I may share, is, today you've got, let's say you've got a lease contract, right? And it could be a 50-pager. You've got tools which will summarize the key requirements of that lease agreement for you. Similarly, now recently, in fact, one which we were discussing yesterday only, I think with some of my colleagues, is like a tick and tie, wherein the tool will actually not just do your casting, it will also do your cross-referencing. So let's say you've got a number sitting in your financial statements or in a schedule, and it's also coming in your notes to the account. So how do you ensure that the number is the same, there's no gap, right, inadvertent? Or let's say you get multiple versions from the client of the financial statements. You get one, then certain changes are made, you get another one. How do you ensure, or how do you keep track of what changes are made? So these tools will kind of help you keep track of the changes that were made from one version to the other to make sure there is nothing which gets skipped in terms of the review. Many other, potential this thing. I think one, if I may share again, because we've been discussing risk assessment, is that there can be a compliance monitor, and it's, I think, quite frequently used by some of the companies, even for their internal controls purposes. So that looks at all the legal compliance requirements which are applicable to a company, and then kind of throws up the exception report. And also a risk management system, which effectively what it'll do is, kind of review all the information which is available either in the annual report or let's say in the public domain about a company. Let's say I'm auditing company X. It will review everything which is available relating to that company in public domain as well as in the annual report, etc. And then identify from there what are the risks, the financial business risk, all of them get identified. So while you may do your own risk assessment, let's say these things may kind of help you identify additional risk factors as well. So there are many, I can go on in terms of, I can go on. The 2 points I wanted to make here is that, one, needless to say, the use of AI comes with its own, challenges. There are concerns, of course, about whether it will impact professional skepticism and how you really use the results. So I think use of this AI responsibly, again, like I said earlier, becomes very important. And the other, if I may add, is it's not just us as auditors who are talking about technology. We've got industry here. Industry is using AI. So there was a time when you did all manual, you did not have IT controls. When IT controls came in, we as auditors had to test IT controls, right? Now, if AI is coming in, as far as clients are concerned or companies are concerned, you'll also have to have procedures to do AI assurance. So just like you're testing IT controls, you'll need to even test those. So I think it just is a very evolving scenario right now. Yeah.
All right. Ravi sir, are technology more being used, or what do you think?
I think probably I'll just refer to the Gartner survey which got published in October very recently. Finance and accounts is the profession which is highly skeptical of the AI and which actually has adopted AI much lesser than other professions. Like you go to manufacturing, they use AI very, in our own company. Like preventive maintenance is on AI. Like I know exactly when my shaft is going to break, because all the sensors are put there. And then, the replacement of the shaft happens, as a preventive maintenance, not as a breakdown maintenance. So it saves a lot of money for us. So I'll expand to what, Archana just talked about. I would rather classify AI into, say, 3 horizons. One horizon is the automation, which is slightly a graduation from the RPAs, what we have, right? The automation is something where we can use, AI, like you use an engine for OCR, right? I think, that can pick up intelligence. So now for me, it has helped me a lot because I am able to really pull, say, Vietnamese invoices or a Swedish invoices, those kind of things. I'm able to pull it and convert it and get it processed, right? Without any errors. Today OCRs are giving 99% accuracy. That's because of this AI, right? Automation is something which is easy, adoptable. I think most of us have adopted AI in automation. Second, horizon in AI, the way I look at it is, the intelligence layer, where you talk about the variances. I think Archana again referred to that. Can we do, say, P&L variance, through the AI, right? So I think there it is being tried already. I think it saves a lot of, I would rather say, time for us, as well as the qualitatively it's able to go deeper and then get something, but you need to have it with a review. It is just getting done, right now. And I think, again, here, if you look into non-finance have really gone ahead. We can generate our, in fact, proposals to the customer, through using AI. They're, I can say that they're pretty much open to the changes, but finance fraternity is very, 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 conservative in using it. The third horizon, where AI, we are very, very skeptical, is, the judgment is involved, right? That's the third one. Like, I'll just give you an example, which I, in fact, experienced here. Is that recently we had a major bank, having an accounting issue. All of us know what it is. I just fed into the, to AI, saying that can I get complex accounting entry through using AI? I fed it into, I think, Gemini, and I fed it into Cloud. Both are wrong, because probably it doesn't have such a, experience that's coming in there. Then I had to really iterate. I mean, finally, I think the human application there, is much better vis-a-vis AI coming in. Similarly, M&A proposal. Can I just feed in the data and then get the M&A? Probably no. I think where judgment is involved, I think that is the third horizon. Where AI will come there, AI will get into AI there, but probably it will take 3 more years for us to get there in AI. That is how I see it from the AI point of view. But coming back to, I think I just wanted to add one more thing on the, coming to the audit there. I do not know how exactly we are really making use of the IFC here in the audit. Right, I think that is something which I feel, I think it strengthens the audit profession very strong, I think humongously, as well as, a preparer's point of view, my, job also becomes much easier if I really apply ELCs. In the beginning of the year itself, it's obvious, generally ELCs are done, when I go to, my senior leaders who really need to respond for the ELCs, they say, hey, we'll do it in the month of March. But, if you were to do that in the month of October, it's vastly different. So how do you really apply? There are available, tools are available for us. The regulation requirements are available for us. Can I do ITAC? I was just doing the ITAC, requirement, the kind of digital transformation that is taking place inside the company, and with the audit trail requirement coming in, it was mind-blowing for me, because I know that 5 of the, the applications have become redundant. I have added 10 more which touched my ICOFR. I mean, this is the realization for me, because, it has passed obviously through the IT security approvals, but for me, it is an eye-opener that, hey, I think it's going to get into my, audit trial issue. It has to pass that test as well now. But thankfully, I was able to do that before, March, in the month of, December and January, Probably these are the questions, if, as an audit fraternity, I think one asks, probably it helps the auditee as well, that's how, I look at it.
Sorry, if I can just add, not related to that, but I just wanted to say that while it may seem okay, all these technology tools, I mean, from a SMP perspective, I think it's not that everything is very expensive. I think there are some, depending upon the size of the client, etc. I think there are some which can be developed. I mean, it is doable even in terms of investment at various stages.
Can be purchased also.
That I don't, I'm not getting into that, but I'm just saying it's not that it is to think that it's out of the reach of everyone. So I think it's at various levels depending upon what utility you're looking at. But I just wanted to kind of everyone to think that it's doable. Yeah.
Thank you. Fair enough. Okay, I think we are running a little bit short of time because we have a Q&A with the chairperson and NFRA, and Shyam sir has also been requesting for a group photograph with everybody. So all of you should stay back for the group. Is it still on, sir? Yeah. Okay. So please stay back for the photograph. But I will quickly want to wind up by asking 3 bullet points from each of the panelists about audit quality. It doesn't matter past, present, or future. 3 bullet points.
So for those who are in audit, my strong recommendation is try to understand the industry which you are auditing, whether it is manufacturing, whether it is mutual funds, whether it is bank, whether it is an NBFC. I'll tell you why it is very important. In fact, morning also, among the discussions, I think that was one of the questions. If you don't have a deep understanding of the industry, the laws and regulations applicable to the industry, there will be a knowledge arbitrage between the management and the auditor. So management's engagement with the auditor will shrink. Because if the moment the management knows that auditor's understanding of industry is less, understanding of economic environment is less, etc., that engagement stops, So what is extremely important, and I find that as a serious deficit, very serious, people are happy to come and talk on tax, GST, this notification came, this, it's okay, fine. But the management's engagement will come only if you have an understanding of the business industry to tell that pharma company, peer company in Germany did this, your company is doing this, develop that conversation, only then you will be able to get to a good, people will listen, people will get a seat at the table where you'll actually listen, otherwise it's a checkbox. So I would strongly encourage, there should be no knowledge arbitrage between the management team and the auditor engagement team. That's one thing which we have to invest very seriously. Second is, whatever work you do it exactly as per the audit standards. Audit standards can be strong, they can be weak, doesn't matter. Do the work as per audit standards and have evidence to the fact that you did work according to those standards, and that will ensure a particular level of quality, but more importantly, that's your best insurance. That's the best insurance. These are 2 points I can share with you.
Yeah. So one I would say is to play the long-term game rather than the short-term game and make your decisions accordingly. I think that always is at least what I would go by. The second is that I think we've been talking about the kind of investment high quality audit requires, and we also spoke about remuneration, and therefore I think choosing the right clients is very important to what kind of culture you're able to build. You've got the right clients, you're able to ask for the right remuneration, hire the right type of talent, etc., and make the right investment. So I think these two, and the third is, as much as it may sound boring, it's like I always say, professional skepticism. That's the biggest, I think, tool that we have. It's trite, but it's true. And if I can just, like I said, I was reading this article by the PCOB chair. If I can just take the example from there, I'll just be quick. He's taken the example and he's kind of elaborated on the concept of that one more degree. And if you look at water, the water boils at 212 degrees, and then that it produces steam. So they say at 211, it is just hot water. So that 1 degree makes a difference. And therefore, when you apply this 1 degree concept in audit, it could simply just mean that asking that one more question, and that one more question can maybe pull the thread, which will help you maybe uncover maybe a accounting error, misstatement, or even a fraud. So I think that 1 more degree concept I really liked. Yeah.
Thank you so much. Ravi sir.
I think when I think for these 3 bullet points, I just got the acronym I know you. Okay, the first one is invest in concepts. I think that becomes extremely important. I think that is something which we really get operational a lot more times. Start with the vouchers and start with the substantive. I think coming from the framework would really be I think useful for everybody. I still was talking to an auditor. He was already doing the sustainability audits, and when I just questioned him, hey, which framework are you using? He said BRSR. I said, hey, why? I'm a private company. Why are you using BRSR? And only region where private companies are required to comply with the sustainability audit requirement is Europe. So you should be using CSRD. So then, I think they went back and they said, oh shit, we should have done, CSRD, not BRSR. So this is something which, really, need to be, coming from the framework. I think, Sir said just now, come from the, auditing standards. I think look into the frameworks. That really gives us a lot of, like that's investing in the concepts. Second thing is no. No is saying no to some of the things will actually enhance the respect, to the auditor. I'll tell you, I think I was asking, one of the, I think, I have quite a few, Indian, small audit firms which sign our stat financials in my subsidiaries. I requested him, hey, can you sign my IFRS, financial group financials? He had done the work and he saw that there is no difference between Ind AS and IFRS. But he came and said, Ravi, I can't sign. I asked him, what happened to you? You're now going back, you've done all the work. He said, look, SAS 600 is different from ISA 600. As a result of which, I have not done, as a group auditor, I am accountable and responsible under ISA 600. I know this was a very contentious topic in the last 1.5 years between NFRA and ICAA. But, but he said that, look, I can't sign it. I do not know where are you going to produce my, statements, but I can't sign it. So the fact that he said no, and it was a big assignment. He's a small auditor, and I trust his judgment. So
now you should agree, sir. Now you should.
So
you get to see only bad cases. We get to see
good and bad.
So this is the one. The third one I just want to say is basically update oneself constantly. I was just talking with the chairman, sir, and I said that, look, NFRA has begun the year with a bang, coming with a circular in the first 7 days. I don't know what's going to happen in the next 51 weeks. So updating, that's extremely important. I think these are the three things, is something which probably would help all of us as well. Yeah.
Thank you very much. Thank you very much, sir. Over to the audience. Thank you.
Let's give a thunderous round of applause. This discussion surely took our Indian practice in terms of audit quality to the global level. Now, I request CA Arun Kumar from NFRA to present mementos to panelists as well as moderators. I now invite CA Vijay Kumar M. Patel, immediate past president KSCAA, to present memento to moderator CA Mohan R. Lavisa. I request CA Nagraj, Chairman Sports and Cultural Committee, to present memento to MP Vijay Kumar sir. I request CA Babita Ji, Chairman Representative Committee, to present memento to CA Archana Bhutani ma'am. I request CA Harsha Shesham, Chairman Indirect Tax Committee, to present memento to CA Ravi Anantaramaiah sir. Starting from audit strategy, risk of material misstatement, going into audit sampling, then concluding audit. After that, addressing the gap, bridging the gap when it comes to Indian audits. Now, it's time for the most awaited discussion of today, Q&A session with NFRA. So everyone have your questions ready. We have open Q&A session with NFRA Chairman. I invite Shri Nitin Gupta Ji, Chairperson NFRA, to come on the dais, please. Round of applause, everyone. I request Shri P. Daniel, sir, full-time member, NFRA, to come on the dais, please. We would be having Q&A session exactly for 15 minutes. So have your questions ready. I would request everyone to jot it down, and parallelly, we'll have an engaging discussion. So mics are there on left side also.
Good evening, sir. Yeah. My question, firstly, is based on whatever statistics Nitin sir have presented in the morning, that in the last 3 years, there are a lot of restatements which are coming in PCOB, where PCOB has published the data. So even in Indian scenario or in outside India scenario, there are a lot of restatements happening. But how would the regulator look at such restatements for the professionals? For example, we have financials which are audited and submitted. Say, for example, the previous auditor has given a clean report, and the financials are subjected to the re-audit or restated financials, and subsequently, how is the regulator looking at previous auditor and the current auditor? What are the implications? I have one more question. Yeah. Okay.
In my inaugural address, I have already told that we don't have the data of restatement, and that's the data of PCAOB. We would like to go into that. See, our bandwidth is limited. We are doing whatever best we can with the limited resources, but definitely we would like to go into that, and let us see how this pans out in future.
So my question is also in relation to Indian scenario also, sir. For example, the previous auditor wouldn't be, coordinating with the current auditors to provide some working papers and all of that. So, and the current auditor would be mostly giving the modified opinion itself, right? In terms of, it will be impacting the shareholders also for the lack of documentation. For whatever reasons the restatements are happening, it could be the current management's bargaining power to take over the stake. It could be several reasons, but ultimately the radar is on the auditors for giving the opinion.
See, these are the finer aspects. Don't ask the regulator in the beginning. So I think let us wait for some more time.
Sure, sir.
Let us reach the bridge, and let us see what happens. But there are guidance available. There is guidance available for the outgoing auditor, and so follow that guidance as of now, and let us see what happens in future.
So the next question, it's just wanted to understand, we have other professional bodies like ICSI and CMAs also who are directly or indirectly related in financial reporting, where the statutory auditors are dependent on their reports in the incidental ways. So are they going to be brought under the NFRA radar as well?
I don't know policy level discussion. You should talk the MCA for that. We are not aware of any such development as of now. No discussion, nothing I'm saying with 100% transparency so far as this aspect is concerned. Nothing at our discussion stage even.
Sir, I have a question related to, we especially in, I don't know about other states, in Karnataka, whichever party is in power, certain MLAs who can't get the minister's berth are made chairman of various corporations. Now, it never mattered because it was more of status earlier. But recently, I find that the chairman is drawing twice the salary of even the managing director for just rendering the services of a chairman. So, when it comes to related party disclosure, should the auditor insist that the party in power be disclosed in the financial statements as a related party?
Line item.
I think it's a loaded question.
Let us not talk about
I don't
the line
think so.
item
I think in
issues.
the present scenario, I think to be practical, I don't think the answer should be no.
Whether the auditing standards or the accounting standards. Based on that, you need to evaluate whether they are related parties or not. Not necessarily because he belongs to that political party, becomes a chairman, you can't say that he is related. You need to apply the test there. So using that, then if it falls into that, then you need to report in the public sector as a related party. But only thing, my suggestion there is, let's not get sort of swayed by a political party and he belongs to that, he's there. That should not be the way of looking at it. Yeah.
Auditing is apolitical. It is apolitical and apolitical, non-secular and secular, sorry. So
Apolitical and what we find is the management override happens from the ministry level. And whatever the ministry says, automatically the lower officials just comply. And so the party in power is definitely in position to influence the actions of the PSU. And in the context, the learned NFRA, which is also in charge, I think, of notifying the standards also, and that is auditing, accounting standards also. If you are, you may have to consider this particular aspect.
Next question.
So I had three questions actually. The first question is, what will be the status of the standards on quality management? Because the Institute announced SQM1 and SQM2, and the Institute has told that it's applicable from 1st April 2026. But there's confusion as to whether the Institute has the authority to announce it or whether it should get notified by NFRA. And therefore, what will be the status from 1st April 26 as far as the SQM1 and SQM2 applicability are concerned? That is the first question. The second question is in terms of the group audits, which is the issue between the SA 600 and ISA 600. Whilst NFRA circular came out in terms of explaining better how the SA 600 should be applied, there is also talk that there will be complete convergence with ISA. And in fact, not only for SA 600, but across all the standards. What is the status on that? Because audit profession has to prepare themselves if such a change were to happen. And the third question is, in one of the earlier, circulars by NFRA in terms of the audit committee auditor interactions, audit committees were told that if the auditor is getting appointed for the first time, and that means it's new auditor, the audit committee should inquire with the incoming auditor whether they access the work papers of the predecessor auditor. Now that's also an area where there's a disconnect with the institute, because the institute is saying that work papers are confidential property of the auditor and that cannot be disclosed to anybody succeeding also. So what happens to access of work papers? Because that seems to be a sort of a theme which NFRA wants to say, that access to work papers is always available to the successor auditor, but that is not actually getting practiced in profession. And therefore, what are the consequences there and how will NFRA look at it? These are the three questions. Thank you.
I'll take the second question first, that SA 600 revised and 299. The NFRA has already recommended to the Ministry of Corporate Affairs last year means in 2024, and these recommendations are pending at the end of MCA. Let MCA come out with a notification and then it will be applicable. So we have seen at times the MCA has extended the date as well. So let us wait till MCA comes out with something. So that is the thing. On the first question was about SQM 1 and 2. I think that is also recommended. That is also pending with the MCA. And we had our discussions with the MCA, again awaiting the issue of notification at the end of the MCA. So let us await that, because ball is, we have already done whatever deliberations were needed at our end. The third was about working papers. I think Kulkarni can, if he can. Access to working papers.
It is very clearly clarified, that the access to work papers, there is no complete ban on that. Even if you look at the schedule to the Chartered Accountant Acts also, the council also never said that you don't completely share the work papers. You have to actually, if it is required, then you have to actually take the client's permission. And if you are a group auditor, and if you need it, like the very good example Mr. Anantramaya gave, you take a permission from the client and you can share it. All along what we have been told is that you don't have an access to the work papers. But that is the wrong position, which has been amply clarified even in the exposure draft when we issued from the SA 600 and in other circulars. This is clarified. So there is really no ban on those work papers. And especially even if you look at the Companies Act, which clearly tells the auditor, if the person, for example, other auditor doesn't give you access, then the auditor has, a group auditor has a right to ask the subsidiaries to look into the records. And then obviously based on that he will charge extra fee, then management will definitely make sure that the auditor gives you that information.
So this was with respect to incoming auditor, not the group audits.
Yeah.
When there's a change of auditor.
Both, yeah. It covers all.
Yes, sir. A small question. Our entire audit revolves around the nature, timing, and extent of the audit procedures, be it at the planning stage, be it at the execution stage, or while performing the audit. So the nature, time, and extent is what is considered. But when a regulator looks at the file, when they are looking at the file, a professional auditor, whatever documentation also covers the nature and timing and extent. But when regulator looks into it, why this aspect is gone, because the file review takes quite a lot of time. And as I said, the constraint might be there in the audit team as well as per the profession, but even if it is happening at the regulatory side as well, why don't we have a fixed time for a review of work paper? Let's say if you have a listed company, when you perform the audit, probably 2 months, 3 months, and depending upon the team size. But when it comes to a review of these regulatory work papers, why is it that it's so much of time, 8 months, 6 months, 7 months?
How does it affect you?
It's not affect, because when you're performing
then
the audit...
why this question?
Yes.
If it doesn't affect you, then why this question? Frivolous question should not be entertained.
No, not as this.
No,
I'm
please.
trying to understand.
If it is not, it's a frivolous question. We'll not entertain. No one should entertain a frivolous question. Why, how does it affect you? Tell us. I'm ready to answer that.
Yes, of course. See, when you're doing the nature, if you're saying that when you're doing auditing standards, give set of standards. Let me take, these are the procedures which you have to follow when you're doing an audit. Be it a primary confirmation,
Do you want to put the regulator at the same level as the auditor is?
No. I'm just saying how is it?
Please sit down. Please sit down. No frivolous question. We are here to do serious business. We are spending our Saturdays here. We are spending time here. It's not a small joke that there are 150 people sitting.
It's not about the time.
No,
it's about the
sorry. You come to my office and I'll tell you. I am inviting you to my office.
very interesting experience I had recently with the audit committee. And they referred to a letter. And they were discussing the audit. And then I asked, what letter? Then they pointed to the audit report, to the members of the company. So they saw the audit report, the chairman audit report of the audit committee saw the audit report as a letter from the auditor. So we find our communication is very, very, very verbose. So can you think of a simpler method of communicating the findings where only the first page of the audit report comes as audit report, and possibly a suggestion can be made, all the other things can be given as a separate, what should I say, information to the government or to the regulator or whoever is interested in all the SCARO and all those things. Basically, the simple thing is whether the accounts present a true and fair view. If they don't present a true and fair view, give the reasons why.
Can't say, let there be consensus, let it come through some association, not as an individual. I would request you to, at least the Karnataka State Chartered Accountant Association, to consider what the member is referring to, what way it can be helpful. We'll definitely examine, let it come. It's not a thing that regulator will come forward with such a thing. It's a countrywide, not only countrywide, it affects the profession as a whole. So let us do some more groundwork onto that. Let President do the needful into this direction.
So far as the earlier supplement made by Sir, according to the Indian Evidence Act, the professional who has obtained the information during the course of the discharge of the duties is protected from disclosure to the others unless it is demanded by the law. If that is one view, when the particular situation applied to the advocate, the same thing will be applied to the chartered accountant also.
This is the same question on work papers you are...
Yes, I am saying.
Actually, this is one very interesting thing. Actually, our schedule also, the council guidelines, they are very clear. They talk about if you have got if the law requires it for sharing the work papers, then you must share it. For example, in the Companies Act now, standards on auditing since 2013, they're part of the law, right? If they require you to share the audit work papers, you can't say that I'm not going to share it. That's one part of it. And second part of it is, I will just mention to you, the auditors and the lawyers, they are two different, standing. The best example for you to actually look into this is, in US in 1975, a case happened. Supreme Court of US said, because one of the firms, large firms, they refused to share the work papers with the revenue authorities there, saying that I also have the same protection like a lawyers there, attorneys, so I'm not going to share the work paper. Supreme Court said, no, you are an independent auditor, you hold your accountability towards the shareholders and public at large. Whereas the lawyer, he actually has to protect his client. That is why you are not on the same footing. So we cannot apply the lawyer's logic to this one. So that's why this is some corrections actually in India through our orders and circulars we have actually made on this one.
We would be taking last one question. Last one question.
Okay. Yeah, I'll just keep it brief. On the improvement efforts from the auditor's side, is NFRA planning after a year or maybe 2 years so, suo motu submission of files by the auditors and NFRA being conducting a review of those? Or as PSU have the expert advisory committee, does auditors can expect to have a separate department from NFRA to whom the grievances and redressals can be expected from the auditors?
See, NFRA has been evolving over the years. We are a recent organization, came into existence in 2019. And even the resource base we have been building it up. Even the resources are quite limited and all that. So as I pointed out in my talk this afternoon, initially in 2022, we began with a few firms, then we started with more firms. This time we have extended to 10 firms now. So this is how we are doing the audit. And even as far as, as I told you, as per the IFER principles, we select firms based on risk-based selection. Audit firm, that's what we select. So those firms, those whom we select, those firms we expect the audit papers and others to be given to us. So if all auditors, they start submitting, then that will be a problem now. But maybe in future with AI and other things, let us see how it evolves and all that. But as of now, I don't think that will be in the pipeline.
Amazing discussion. Thank you everyone for such a great enthusiasm and participation. I now invite EC members of KSCAA, past presidents of KSCAA, office bearers of KSCAA, and special invite to Mohan R. Lavi sir to join on the dais and let us felicitate NFRA chairman and full-time member. Puranik sir.
sir, last year, change. One second.
I now invite CA Arun Kumar, faculty NFRA, to conduct feedback session.
Rahul, is this computer is coming now? Yeah, okay. But it is not moving. Now the second question is about the pre-reading material. But it will come in your phone. It is not coming on the screen. It will come in on your phone. Already 14 participants answered about the pre-reading material. Now the third question is on the structure of our workshop. Is it appropriate? Do we need to follow a different structure or not? I'll stop when the participation crosses a mark 30, 40 plus. So next question is on contents and presentation in the technical session. The first session was risk assessment. The second session, risk assessment. Great, 50 people answered. Now the second session, audit sampling. Now this is an open-ended question. You can give your suggestions for additional topics for inclusion in the workshop. Rahul, can I get on the screen? Because the last question I need to display. Can I either get, no, the screen should move. It's not moving. Next question is on the overall rating. This is what I wanted to get on the screen because you can also see. The last question, overall rating, I would like to display it, whatever be the honest opinion. Yeah. So it's a star rating, 5-star, 4-star, 3-star. Unfortunately, it's not coming. I think it's a 4.3 rating, which we have got now. Thanks. Thank you. Thank you. That's all.
Thank you, sir. That was engaging. I now request Shri Shyam Tong, sir, to come on the dais. I request CA Siddharth Javli, Secretary KSCAA, to present a memento on behalf of KSCAA, please.
So I'm being rewarded before doing my job? Yeah.
Good evening.
We are very grateful to NFRA chairperson for his inspiring inaugural address and visionary guidance, which set the tone for the profession's role in strengthening financial reporting and corporate governance in our country. My sincere thanks are also due to NFRA full-time member Daniel sir, whose presence and thoughtful contributions added immense value to the program. The sessions on audit strategy documentation, primer on ROMM and audit sampling, global best practices, and concluding audit have provided practical insights that are directly relevant to the challenges faced by audit practitioners. The panel discussion on raising the bar in audit quality, global best practices, and Indian regulatory expectations highlighted ways and means to improve audit quality and encouraged to adapt to technological change and global best practices. This workshop showcased the collaborative success of NFRA and KSCAA in knowledge sharing. This also demonstrated that the practitioners can be equipped with essential tools, regulatory updates, and best practices to strengthen audit quality and financial reporting in India. We extend our profound gratitudes to Chairperson NFRA for initiating this outreach series, Creating Better Financial Reporting System, and joining us here today in this program, sitting all through the day. We are grateful to Daniel sir, our full-time member, for his gracious presence and address. Sincere gratitudes to CA Shiv Prakash ji, President KSCAA, Sunil Bhandari ji, and the team for all the hard work in organizing this outreach in collaboration with NFRA, and also for delivering the welcome address today morning. It was not a usual welcome address. I think it was an inspiring address by Mr. Yeah. We are also thankful to CA MP Vijay Kumar, CA Amitesh Datta, CA Ajit Vishwanath, CA Mohan Laviji, CA Archana Bhutani, and CA Ravi Anantramaya ji for delivering insightful sessions and constant encouragement to uphold global best practices in auditing. Their presence has added great weight and perspective to today's deliberations. I stand here to extend my sincere thanks and appreciation to NFRA officers, Arun Kumar ji, Vidyadhar Kulkarni ji, Sushant Jain, for delivering such engaging and practical sessions. Your efforts have provided every participant with meaningful learning and actionable takeaways. Our heartfelt appreciation also goes to KSCAA and their entire team. I think they deserve one round of applause again. All their executive members for their valuable support in making this workshop possible. I wish to thank the entire NFRA team. You only see faces here. There are faces who do the background work. So I thank the entire NFRA team for contributing in organizing this event jointly. All praise to and appreciation to the masters of the ceremonies, CA Rahul and Siddharth, for guiding today's proceedings. We also wish to acknowledge deep appreciation to the venue host for the excellent arrangements and warm hospitality. Finally, a very special and big thanks to all the esteemed participants whose interaction and commitment has made today's discussion so engaging and meaningful. One big round of applause for the participants. Thank you all for coming and joining us. As we carry forward these learnings, let us reaffirm our commitment to upholding audit quality, strengthening financial reporting integrity, and advancing the profession's role in nation building. Navu KSCAA ge Rita Purvagi Dhanyavadagalu. We, on behalf of NFRA, wish all the professionals a happy new year and continued engagement. Thank you. Jai Hind.
One final announcement. If you are a professional or having an institution, do register, enroll yourself with KSCAA. This will be your companion in your professional journey upcoming. Many such programs and events are coming. 2 programs. Tomorrow we have sports and cultural meet. And on 27th and 28th, there is annual conference where members not only from Karnataka, but across Karnataka and neighboring states would be coming. I request you all to be member and participate engagingly. I thank my online audience. This session was live and it will be hosted on YouTube for your future repository. So do access and share this information with everyone. Thank you. You all had been a wonderful gathering. Thank you, dignitaries on the dais and off the dais. I request everyone to assemble on the stage. We'll be having 3 lines, one a chair behind that and in front of that. We'll quickly take one photo and then conclude it. Thank you, everyone.
Yes.